All right, we got a minute and a half. We're going to get an opening bell then, but let's squeeze in a mad dash. You want to talk Disney and a Cowan piece that I'm looking at?
Disturbing piece. Cowan, talking about the mixed legacy of Iger and a very deuce back. And I'm going to read this to you because I don't want there to be any words mixed. Fox constituted 77% of Disney's total investment in M&A under Iger. That's Pixar, Marvel, and Lucasfilm combined only accounted to 17. The deal impaired Disney's balance sheet, diluted its focus on branded family entertainment, and significantly increased the company's exposure to linear and streaming content aggregation assets. Basically, what he's saying, it was a significant strategic error.
The Fox deal, which you've brought up any number of times over the last year or two.
No, not any. I rebel against
consistently, you brought it up as a valid question.
Okay, that's good. But I did feel that this was, my charitable trust owns it. I wanted to buy more. I read this. I think it could go lower, and then we will buy more. Because I believe in Iger, and I think he's coming in at a good time. And I think that all this is priced in, and then I want to buy Iger. I want to buy Iger right here. I-G-E-R, not D-I-S.
New ticker, I-G-E-R. Let's get the opening bell here on the CNBC Real Time Stream. The big board is slammed in a luxury fashion based in Shanghai, celebrating its listing via SPAC at the NASDAQ and software development platform GitLab.
GitLab is good. SPACs have been uneven. David's often pointing about how SPAC performance has been uneven.
Pretty weak.
Yeah, uneven is a nice way to put it. Yeah.
But GitLab had a great quarter.
I haven't taken a look at this one.
MongoDB had a great quarter, and I went over that Datadog quarter. I want to be very careful.
Got another upgraded dog today.
Yeah, the cash flow is very good. So those are survivors. They're pivoted. I was too critical of Datadog. There were companies that tried furiously to buy Datadog before it came public. And if it went down too low, you have a nice put. Not unlike Tom Bravo and Coupa. Remember, Tom Bravo's got that money burning in his pocket.
Well, they're putting it to work pretty quickly.
They are. And
yeah, the Coupa deal was only a few days ago, Monday morning. It does seem like a long time ago already at this point. But your point's an interesting one in terms of at least some value that the private equity firms do see, and whether they're public or private companies. Vista's another name we've mentioned many times, although they came in with a cover bid on Coupa. They were not there at the same value as Thoma Bravo.
But you need a willing seller, and none of the companies I just mentioned really feels like it's time to cash out.
Meanwhile, Jim, what do you look for today when you think about a day, reaction to the Fed? We've already spent 15 minutes talking about that. What do you want to look for?
I'm looking for bargains. I'm looking for companies that I believe, like Disney, are going to have a better year in 2023 because they have good management, better management than they had, and they're going to figure out how to make more money because maybe they can go and talk to talent. Talent knows what they do. I don't want to buy companies directly in the crosshairs of the Fed.
Mm-hmm.
I mean, for instance, I don't want to buy traditional cyclical companies that are not related to the infrastructure giveaways of this administration.
Right.
When you say giveaways, you're not suggesting we don't need infrastructure activity.
Well, our country is well behind infrastructure, but I'm saying that typically you would do those things when there's enough workers, when there's enough steel plants, we don't have enough of any of that. So those companies are all going to be very inflated, and they're going to be a great place to be on earnings because you can't believe that they're going to have such great numbers. I think Caterpillar is going to shock you. Cummins will shock you. I think that Deere will shock you. These are must buys. Eaton could shock you. They're must buys. I like that.
Right now, nothing's working. All sectors are red. Financials down, industrials down. Jim, this Goldman sell call on Western Dig is going to make that your worst S&P ladder.
Well, they're doing terribly, and I think the inventory glut that a lot of people thought was going to end at year-end is not over. There's a semiconductor there's a glut of tremendous proportions for semiconductors, and yet these analysts keep trying to jump the gun and say the glut is over. None of the companies are telling me the glut's over. I mean, I speak to the companies. I say, hey, well, how's the glut? I guess it's going to be in. I'd like to make a year-end call saying we're okay. And they're like, no, don't do that.
Takes us back to what Sienna said last week. We have no problem getting the semis we need.
It's no problem at all. I mean, there's a couple stocks. I'm just watching the tape. T-Mobile, a fantastic note, JP Morgan, about how well T-Mobile's doing.
Yes.
Great note about how Mondelez is doing. People like chocolate. I think Hershey's going to do well. But when it comes to anything connected with semis,
Yeah.
it's a bad day. There's too much. There are too many, and that's also China's not using it as much as we thought.
No, although speaking of China, we saw earlier many of the China-related stocks were up.
Yes.
It is worth mentioning a release out from the PCAOB. It's the Public Company Accounting Oversight Board. And you may recall, as a result of something called the Holding Foreign Companies Accountable Act.
Yeah.
Remember that Congress passed? The PCAOB wanted the right to actually inspect all the books of these Chinese companies. And they put a release out saying, hey, you know what? So far, so good. It's the beginning of our work to inspect and investigate firms in China, not the end. We're continuing to demand complete access in mainland China and Hong Kong moving forward. But it's important to understand that today's announcement's about one question and one question only. Is the PCAOB able to inspect and investigate firms in mainland China and Hong Kong completely at this time? The answer, following thorough and systematic testing, is yes. And so that's being seen as a real positive. They did get access that had been promised in the way it was promised.
Usually positive. So were the answers that I got from David Calhoun when I pressed him about China. Seemed to think that China could be doing some business. Certainly didn't want to slam a client, a gratuitous slam that I was demanding. I do like the idea that we have any conversations with China because China, this is the worst it's been since pre-ping pong with Kissinger. And it'd be great. I don't want war.
Yeah.
What is that good for?
Nothing.
War. No,
Absolutely nothing. Yeah. Say it again.
War.
Huh.
That's very good. I like your peculiar chainsaw
like my
effect there. But look, I think that we're in a situation where the enterprise software stocks could come down again. But I want to buy some of those. They've been, look, the stocks that are down 50 to 60%, they were reflecting this. So now we have this, and I'm thinking about what's going to happen after this. I'm not doing one of those things where, like, guys, right here, do you think rates are going to go higher? Not rates. I'm just saying that if you look at big tech's been crushed. Now, a lot of them still won't be able to make their numbers. But let's take Meta. I mean, Meta has had giant cutbacks. They still haven't monetized WhatsApp. I think that, David, if Congress goes against TikTok,
yes,
Meta goes to 130.
We mention it almost every day. The latest is a bill, I think, out of the Senate.
Yeah.
Thanks, Carl, that would ban TikTok on all
government devices.
Thank you. Hasn't hit the House yet. It's not a ban on TikTok for users,
but that's very significant.
But it just continues to sort of be a reflection of sentiment in the legislative bodies that this is a possibility. And to your point, Jim, if in fact you were to see TikTok actually banned by the U.S. government, that would be a major benefit for Meta.
In the many times that I've goaded them into trying to say something, they've been diplomats and will not give me anything.
Who, Meta?
Yeah,
to say something against.
Yeah, they will give me no ammo.
There continues to be real questions about the safety of the platform and concerns about ByteDance, the owner of TikTok.
Look at the stupid things they have on TikTok.
Oh, yeah.
They're like idiotic things. They ought to just say, listen, we can't allow TikTok because we're trying to get SAT scores up in this country.
Yeah, that's for the individual parent certainly to battle. No doubt you're right.
No, I'm definitely right.
And then there's mental health issues that are just staggering, unfortunately.
But why don't people talk about that? Well, I mentioned that to Zuckerberg because my daughter was in the business of trying to save people's lives.
Yeah.
And the first thing you have to do is you have to take away Facebook.
You take away all social media. Yeah.
What's between Facebook and fentanyl, which is worse?
When
it comes to suicide.
I don't.
Let's
you really
have that debate.
You want me to ask that question?
If you don't talk about either
we
one.
don't talk about a lot of things enough. You're right.
Facebook's safer than
fentanyl is a horrible thing going on in this country right now.
If we had talked about opiate, maybe we could have taken down Purdue before they took down our country.
You're right. We have over 300 people dying every day of drug overdoses in this country.
Everybody's role to try to stop.
That equal to how many people die every day of COVID. I'd like to see that in the newspaper right next to it because it is a crisis. All right, moving on.
How about drug stocks?
Moving on. No, how about Netflix? Did you notice it's getting hit on some? Carl, I don't know this publication, Digiday. is
What?
the name of the publication. It's saying Netflix is failing to meet its viewership guarantees that it made to advertisers on its new ad-supported tier. And may, in fact, even be offering to return some funds to advertisers for ads that
But
haven't
this
yet
was
run.
what moved the stock up so big, David.
Yes, I don't know day, but I'm repeating what I'm seeing it reported because, of course, you can see it's having a real impact on the stock.
The stock is doing so well.
Yeah, well, it happens. So is our parent company stock until Charter decided to increase its CapEx budget enormously.
Maybe the new Netflix, most recent Netflix, aren't so good.
But yeah, Netflix is getting hit way worse, by the way, than Warner Brothers Discovery, which once again writes down some of its content. It's a non-cash charge, but apparently, as they look at stuff even more, they like it less. They're like, you know what? Let's just give it back to the producers.
Well, that was.
Run it on third parties. So
Were you
that
referring to the producers like?
Zero Mostel producers?
Yeah. No.
The companies, but maybe that's
Sure
what it would
seems
be.
like it.
Springtime.
I
Yes.
have 10% of everything they make. How about you? We should
Maybe
go
that-
back to something. Can we
Maybe
just go
that'll
back?
work for them. But Warner Brothers Discovery is down about 2.6%. Why? Well, again, non-cash, but their pre-tax restructuring charge now seen at 4.1 to 5.3 billion because of additional charges related to content impairment.
Well, can't they look at all that right now and come up with a determination?
Maybe they're done.
Maybe they're done. Hey, you know what? I want to talk about something.
Tesla shares are actually up.
Well, I think I'm so glad you mentioned that because Phil LeBeau and I going back and forth. Can we, the people who are saying that Musk's eyes off the ball? I mean, you know, if you were right now, Mary Barr, Jim Farley, Jim Ford, I mean, they know his eyes not off the ball. His numbers are really good. They are selling a lot of cars. I think that this man is underestimated. I do think the problems in Twitter are underestimated. But if anyone thinks that this is that Tesla is going to somehow be hurt by this, other than the stock, oh come on, Tesla's a good stock right here. You just need to see him stop selling.
Well, we got to 152 pre-market, and as we've reminded people, 150 was Adam Jonas's bear case. Wonder if we bounce off of that.
That's interesting.
Yeah. You think stock would rally if they named a new CEO at Tesla?
No, I don't want
not?
him to do that. No, I just want him to. I suggested on Twitter that he picked John Ledger as CEO. I thought that made sense.
Wait, for
And
Twitter
I-
or for
no.
Tesla?
For Twitter,
For Twitter.
He needs to find someone like John Ledger to run this Twitter. Just say, hey, listen.
His plan was to be Twitter CEO for a number of months and find somebody to permanently run it. I believe he's still saying that will be the
change
case.
his mind. He needs to go back to
Changes
Tesla.
his mind every hour.
Well, all right. So he's not as consistent as we made.
No, but he also lets you know about all his changes instead of just
He plays with
being
an open
quiet.
hand.
Jim, the other thing is the fresh wave of downgrades on travel today.
Oh,
Marriott, Allegiant, JetBlue, Delta, whether it's Barclays or Cowen or Evercore.
well, I mean, only JetBlue is bad. Try to book a plane. Try to book a hotel. Other than JetBlue, they're staggeringly good. I don't understand where these people. I mean, I remember talking to Brian Chesky and saying people are saying that you're saying that the high end is bad, and he said to me in an interview I did with him, he said, "What are they talking about? The high end's good." So people want to be too negative, David, on industries that are actually doing well.
Right.
Aerospace is doing quite well. There's a dearth of planes. People need planes. Are you listening?
I'm trying to listen to Chip tell me something. I don't know.
saying-
My hearing's
Carl,
going.
I'm
Is your
sorry.
hearing going?
No, I mean,
I
well,
think people are too negative.
I think, Amex
just-
is a great example. Almost back to the 50-day this morning. That's going to be, that's a 1 month low, a little bit more on AXP.
Steve Spruill, the unbelievably good CEO of American Express, just told Mark Benioff, business is quite good, Mark Benioff with Salesforce. I mean, I don't know. Like, travel is good. Hard goods, not so good. Although, did anyone see the note upgrading Gap stores and Foot Locker?
No, missed that one.
Well, that's a good. It was a good note.
Something I didn't miss, and I want to get to, guys,
You ought to look at that.
is well, quick divergence into activism world here. FIS.
Yes.
You may know that company. Hey, it's a $48 billion company.
Go ahead.
D.E. Shaw has been an activist. So they own the stock for a period of time. They got bigger in it. They seem to have engaged with the company over the last few weeks, quite in a positive manner. But we got an announcement from FIS, Fidelity National, this morning. You know, they're in all sorts of different areas of payments, obviously, also merchant acquisition. A big company had been a lot bigger. You can go back and look. It's been cut in half over a certain period of time. But the announcement this morning, a couple important things. Gary Norcross been is going to depart from the company as its board chair. He's going to be replaced by Jeffrey Goldstein, who's lead independent director right now. Now will be independent chairman. They've moved up the appointment of the new CEO, Stephanie Ferris. She's coming in basically as of now. She starts tomorrow. It's only she was going to start January 1st, but perhaps the more important thing is they put out two separate releases. Is part of the second release, or what I'll call the second release, in which they say the following. The review, they're going to undertake a review, a comprehensive assessment is what they call it. And the review will also evaluate FIS's business structures and portfolio of assets to ensure optimal configuration and deliver the greatest results for their clients and shareholders. This assessment will complement and enhance the ongoing enterprise transformation program. What does that mean? It means they're taking a look at whether it might make sense to break the company up. And that is a number of analysts have been out with some of the parts. D.E. Shaw has made the case, is my understanding, that a separation would allow each individual business, and here we're talking about 3 different businesses, perhaps as many as, to be valued what they say appropriately by the market, which could be perhaps as much as 50 to 60% higher. Would be tax compliant, a number of other things as well. 3 franchises in banking solutions, merchant company, which would be in merchant acquisition, and then a capital markets company. Will they do it? Who knows? Probably take a quarter or 2 to review, but it is a possibility now, and it does appear that, in fact, D.E. Shaw's involvement, which also actually extends to getting 1 new director on the board, a gentleman named Mark Ernst, will also be joining the board as a director. Could be something worth watching. The stock has underperformed, as you see, over a period of the last 5 years, guys. And again, broadly speaking, payments is what we're talking about here.
Services under pressure everywhere, whether it be, Toast, which is not Toast. They're okay.
Right.
To payment, Square, PayPal. These are all stocks that were part of the November pivot against. And there's been, fintech in particular, if we look at stocks like Affirm or Upstart, do you think they don't reflect what's been going on in Washington with the Fed? I just find people are too negative because they don't realize, lo and behold, these stocks have already reflected a lot of what Powell has done, Carl. I just think that people are just saying, holy cow, it's bad. It's been bad for a year and a month. It's been 13 months. When you get away with people and ask about the stock market, the first thing they say is, can I not hear about it? Do you mind? I'll talk about anything. People are willing to talk about teams like, I don't know, the Houston Texans. I'd rather talk about the prospects of the Texans.
They came pretty close.
They did.
Yeah.
Well, I mentioned that.
That was impressive.
But I'm saying, that people would rather talk about anything. Argentina, Croatia. Please don't ask me about stocks.
Yeah. We are down 500 almost on the Dow. Only one component in the green. That's Verizon on the Morgan Stanley upgrade. Yeah. Let's get to Bob Pisani. Hey, Bob.
You guys, the soft landing crowd is having a really tough time of it this morning. Retail sales missed, Empire Manufacturing missed, industrial production missed. The ECB is raising the inflationary outlook. So the good news is the dollar moves down, rates are moving down, but it's not helping the markets. Look, retail's getting hit again. Nike is weighing on the Dow. And what I call the risk-on stuff, metals and mining, that China trade is sort of fading. That was a big mover a few weeks ago, not anymore. Arc Innovation, another kind of risk-on, risk-off, down 2%. Semis are down 2%. Semis have had a decent run. They're kind of sideways for the last few weeks, but a few of them, NVIDIA has just had an amazing run. It was 110, 115 in the middle of October. 170 now. It's really quite around. It was higher than that a couple of days ago. So maybe it's time to cool off a little on semiconductors, particularly on NVIDIA. I'll tell you what the main problem is in the last day since Powell is there's a real valuation problem on Wall Street right now with the S&P 500 because the prices are too high. So the strategists, the top-down guys, you know, the Mike Wilsons of the world, they have been very aggressively reducing their earnings estimates in the last month or so. Right now, an average of 17 strategists I did yesterday had earnings down 6% for 2023. Now, these are strategists. The analysts are a little more optimistic, but down 6%. The problem is if you put a forward multiple on that, down 6%, you have 19 times forward estimates for the S&P 500. That is a big problem because the historic average is 17 and multiples over 18 are extremely rare. They happened during the dot-com bust in 99, 2000. It happened briefly in 2017, briefly in 2020 during COVID, but that's about it. It tends to just fall back. And when you start arguing now, all of a sudden you have a 19 multiple, and this is flat for 2023, assuming prices don't go up. If you want prices to go up, now you have to start assuming the earnings are down. You have to assume that we're going we're going to be very, very aggressive in terms of the economy and do a lot better. That's really hard to argue in this kind of environment. So this is the valuation problem that Wall Street's got right now. We're going to get a lot of volume tomorrow, folks. This is the quadruple witching. It's the quarterly exploration of stock and index futures and, of course, single stock futures and options. We also get the rebalancing at the close. A lot of heavy volume right at the open and at the close, Carl. These are not as important as they used to be because there's a lot of different kinds of options, monthly and weekly options, Carl. But we're going to see a lot of action right at the open. Back to you.
Biggest expiration, I think, in 2 years tomorrow.
Yeah, I'm not ready for that.
Bob, thanks.
Okay.
As we go to break, watch bonds. Certainly not the activity we're seeing in stocks. Down 540 on the Dow, but the 10-year, the 2-year, they're down, but not quite to levels that we got earlier in the week. We'll be back in a minute.
is he at?
Take a look at some NASDAQ 100 laggards this morning. We mentioned Netflix, but the semis are not far behind. Marvell, NVIDIA, Micron, ASML. Plenty of laggards to choose from on the NDX because only 7 components are in the green. We're back after a break.
At KiwiCo.com.
Jim, what's on Matt tonight?
S&P Global, Doug Pearson's done an unbelievable job. So is Doug Pearson, by the way, and the Jaguars just haven't seen the turn yet. And then Ritchie Brothers, we're very interested in the industry that is Carvana, that is in Carvana, and they do an auctioneer for cars. So I think Carvana's worth keeping an eye on, just so you know.
Maybe your own auctioneer business gets a little activity.
I miss the days.
He's a good one.
I miss the days.
Kramer's
I got
a
30
great
back. I got
auctioneer.
30 back. What do I have in the front, by the way? You're supposed to do the cadence, and you do not get caught up. When you say, I got 1, I got 2, you don't do that 1, I got 2. That's not the way a real auctioneer does it.
Jim, we'll see you tonight. Mad Money, 6 p.m. Eastern Time. Continued weakness this morning. Dow down 600. Coming up, Gary Black, one of the Tesla investors who has been outspoken about Musk's focus on Twitter. Don't go away.
Good luck.
TD Ameritrade, this is Anna.
Hi, Anna. This position is all over the place. Help.
Hey, Professor. Subscriptions are down, but that's only an estimated 15% of their valuation. Do you think the market is overreacting?
How do you know that?
The company profile tool in Thinkorswim.
Yes, I love you. Please ignore that.
TD Ameritrade, award-winning customer service that has your back.
To adapt in a fast-changing world, you could hire a professional pit crew.
Oh, okay.
They deliver real-time data and business forecasts when you need it.
think it was fine how it was.
To help you stay ahead of the curve. Or you could use Workday, the finance, HR, and planning system that helps CFOs make better decisions faster.
On the other hand, we had a great fourth quarter.
For an accelerate your decision-making world. Workday for a changing world.
Lily, welcome to our third Barkery.
Oh, I can tell business is going through the roof.
But seriously, we need a reliable way to help keep everyone connected from wherever we go.
Well, at AT&T, we'll help you find the right wireless plan for you, so you can stay connected to all your drivers and stores on America's most reliable 5G network.
That sounds just perfect.
Terrierific.
I Labrador you.
Round of applause.
AT&T 5G is fast, reliable, and secure for your business.
Did you know your health has more to do with your zip code than your genetic code?
Doesn't seem fair.
We agree, but where you live determines access to doctors, green spaces, and fresh food.
That's why we grow our own.
Smart. We don't think it's right that some people are healthier than others just because of where they live. That's why we're delivering food to areas with less access to it and helping schools teach kids about gardens.
Wish they taught gardening in my school.
You would have aced it. Introducing Elevance Health, where health can go.
Check this out. This is Venom Go by Hyperice. You stick this pod on this pad, boom, instant relief wherever you need it. With 9 different variations of heat and vibration, you can soothe your sore muscles instantly. The tight spot on your neck, that little knot on your back, that shoulder that always bugs you, and your tight calf after a ride, say bye-bye to the pain and soreness. Heating up 6 times faster than any other heating pad. Ooh, that's hot. It's designed to get you out and moving. What are you waiting for?
CFOs, this is for you. Join the CNBC CFO Council. Monitor trends, manage risk, and transform your business. Get a seat at the CNBC table. Scan this QR code or go to cnbccouncils.com/CFO.
Good Thursday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber here at Post 9 of the New York Stock Exchange. Morgan Brennan has the morning off. Got some continued selling in the wake of the Fed, the ECB, the Bank of England, as more recession fears accelerate, given some of the prints we've gotten today. Retail sales, Philly Fed, and industrial production. In fact, there's more business inventories. Let's get to Rick Santelli. Rick?
Yes, this is another one to put in the weak category camp. We're looking at our October read on business inventories, expected to be up 0.4%. And it's up close, up 0.3. However, up 0.3 is actually the weakest month-over-month business inventory growth, going all the way back to April of last year when it was actually a minus number. So whether you believe that's good or bad, it is at the smallest rate of change over month. And the high water mark was 2.4 in March, highest since 82. Why do I bring that up? March is when all the PPI metrics, all 6 of those metrics peaked. So it's something to pay attention to. Maybe this is something the Fed will like. David, Carl, back to you.
All right, thanks, Rick. Rick Santelli. We are 30 minutes into the trading session. We're going to get to Tesla shortly. Let's give you a look at some other movers that we're keeping an eye on this morning. Let's start with Lennar. It's sliding this morning after forecasting a slowdown in orders for new homes. That stems from higher mortgage rates, of course. Also, the company did report lower than expected earnings. Revenue was slightly above, though, what the street at least had been anticipating. You can see that stock fairly down. Novavax, though, is down a lot more. Let's see just how much. Yeah, almost 19%. This after announcing a $125 million common stock offering. It also added a $125 million offering of convertible debt. And we're going to end on Warner Brothers Discovery. It's raising the projected costs for scrapping plant content by $1 billion. It's another $1 billion, basically non-cash charge. The company has been implementing a series of cost-cutting measures since the merger of AT&T, of course, Warner Brothers unit with Discovery. I can imagine. It still was only earlier this year, Carl. It seems so long ago at this point, certainly for suffering shareholders.
No doubt about that. Meantime, as you know by now, the Fed raising rates to the highest level in 15 years, indicating the fight against inflation not over yet, despite recent promising signs of easing. Our senior economics reporter, Steve Leisman, of course, in the room yesterday, joins us with more, given some of the prints we've gotten since, Steve.
Yeah, that's true. Economic data coming in weak. The Fed's 50 basis point rate hike and sharp upward increase in the rate outlook coming up against a market has rate cuts priced in for next year and potentially making the Fed's fight against inflation even harder. Take a look. The Fed has raised rates by 2 percentage points since September to 438 now. And the Goldman Sachs Financial Conditions Index, that's driven by higher stock prices and lower bond yields, it's fallen 0.3%. So financial conditions have eased. It's down a full point since early November. You can see the disagreement between the market and the Fed in the outlook for 2023. The median forecast for Fed officials for the funds rate next year rising to 4.15. It had been 4.6 in September. But Fed futures, they're trading at 4.37 for the year and 4.38. That it cuts and has cuts built in after a few more hikes. This might not be a problem now since the Fed and the market, well, they're in good agreement through the spring. The Fed said it will slow down and feel its way to the right level, probably shifting to quarter-point rate hikes. But it could be a problem if inflation persists and tighter financial conditions are what's needed to bring inflation down. Other central banks on the move this morning, joining the Fed and raising rates. What's a global battle against inflation? The European Central Bank, Bank of England, Swiss National Bank, all hiking by 50 basis points today. The Norwegians went up by a quarter. Data this morning did show emerging weakness, more in line with the market's outlook for the economy. November retail sales falling 0.6%. That's doubled expectations, though. Some economists saw it as a result of falling goods prices and a give back from that strong October number we had, where we had early discounting, maybe pulling Christmas sales forward. December, now the rubber match in the contest for the holiday shopping season and the year-end growth numbers, guys.
Steve, I'd love to get your take on, we mentioned this with Kramer in the last hour. That was Morgan Stanley today saying it's difficult for us to follow the logic of the changes to the SEP and the chair's comments, both of which appeared inconsistent. Our strategists turned neutral on all their trades and will reevaluate in January. Did you think yesterday was more confusing than most?
I mean, I didn't find it confusing in the sense that they brought down their growth outlook, they raised their inflation outlook, they raised their unemployment outlook, and they increased their Fed funds outlook. I think all of that was consistent. There are just two different theories of inflation rolling around there. The market has it rolling over with a recession, perhaps. The Fed doesn't necessarily have a recession built in, has very weak growth, but they have it coming down as a result, or they see the need for rates to go considerably higher from where they are right now. What I thought was not confusing but remarkable was the unanimity on the Fed, Carl. You look at it, 17 of 19 folks over 5%, 7 of them over 5.4%. This is a Fed that, at least right now, means business for next year when it comes to raising rates.
Indeed. Bank of England, 6-3. A lot more uniformity on the FOMC, as you mentioned, Steve. Thanks, Steve Leisman, as we're now trying to hold 3,900 on the S&P. For more on the sell-off today and what Fed policy means for investors, let's bring in BofA Securities' Jill Carey Hall, and here at Post 9, Morgan Stanley Private Wealth Management's Sherry Paul. It's great to have you guys. Thanks for coming in. What do you think's going on? Why the reaction function to this particular FOMC meeting?
Yeah, I think it's great to be here. Thank you. I think it's really important for investors not to get lost in the Fed sauce at this point and to really stay focused on how every market reset presents basically a corridor of new investing opportunity if you engage the market with a capitalist mindset. And so as a portfolio manager, very different than a forecaster, right? Forecasters and economists tell us the conditions in which we're building portfolios. But the greatest threat to portfolio outcomes is indecision. And right now, investors should be decisively looking at healthcare, utilities, consumer staples, building cash flows within portfolios, and then a weighted out strategy, a time in the market to let the miracle of compounding returns deliver over a time set. And that's the key right now in this market.
Is that actually, are your clients listening to you? I mean, you know, you're a wealth advisor, right? You got a lot of clients. I would assume you got some of them 60-40. I mean, it's been a brutal year, whether you're in equities or debt. And I just wonder, you're making that argument. Are they saying, no, I'm not interested? Or are they actually doing what you tell them?
Well, thank you for that. History makes the argument for me. I just listen to the science of investing as a senior portfolio manager. But you're right, I'm also a private wealth advisor. So I take into account the totality of the client net worth in terms of moving them through the economy in these market cycles. So fortunately, yes, I'm thankful that clients do listen to me. This isn't the first time we're going to see a market like this. I mean, I go back to 1998, looking at 01 and 02, 2008, 2009. Now we're coming out of a 100-year pandemic. I don't think anyone should really be surprised that we're facing a profit reset. I just don't want that to feel, especially for newer investors, to create indecision that keeps them out of this market, because there's plenty of opportunity if you can take on the time horizon.
Yeah, I asked the question only because I'm always interested in sort of the sentiment of a client base like the ones that you have, because it can be instructive for what we're going to see. So how would you characterize the sentiment of your clients?
Well, I think the sentiment of clients right now is more concerned and it weighs heavy on the heart geopolitically than it necessarily does with the market. And I understand that, because psychologically, when you look at this sort of geopolitical setup for deglobalization, which presents its own structural and supply chain inflationary pressures in the market, the war in the Ukraine, and then ongoing sort of political discussion and discord in the U.S., that really weighs on investors more necessarily than the markets. We want to separate the two, right? So how we feel about things is also not an investment strategy. And so my job is to really help people, connect to that in a meaningful way in their own lives, to find joy and happiness, frankly, as a private wealth advisor. And yet at the same time, make sure that their money is speaking both to their mission and to good money outcomes in this market.
Yeah, that's full service.
Yeah, joy and happiness. I like that.
Okay.
Jill, I'd love to get your take on where we are at the moment. I know your focus is in small caps, but we talked about history and looking at past lessons. What do you say to people who say history is less meaningful if we are really graduating to a different structural period of rates and inflation and alternatives?
Right. Well, I think it's important to look at both. It's important to look at, what can historical context tell us? And, there are many things we draw from that today, that if we are in a period of, a leadership shift, that the old leadership, things like tech and growth, are unlikely to be the new leadership. But we also like to look at, what's different this time. And obviously the rates backdrop, as you mentioned, very different, playing into our views on some of the mega cap tech and growth stocks where we're more cautious. And I think today's backdrop, we're now in an environment where we do think, given the Fed continues to hike and battle inflation, as you saw in the 1970s, this is a backdrop where we do expect the economy to slow. Our economists are looking for a mild recession from the first quarter to the third quarter of next year. And, we do expect there could be downside risk to the market first before it bottoms at some point in the first half of next year. So, I do focus on small caps, as you mentioned, and that's one of the things we've looked at is, typically history would suggest you don't want to own smaller stocks going into a downturn. But, today, when you think about that backdrop of high inflation, high but slowing inflation, small caps have actually done well in those backdrops historically. They were the best performing global asset class in the mid 70s to the early 80s. And right now, in contrast to heading into prior recessions, they're pricing in the risks much more adequately than they typically were historically. So that's one segment of the market we've been relatively more cautious on, even going into this soft patch in the economy.
So pricing in the risks more, why? Just the multiple is much lower? Give us the sense is what you're talking about.
Yeah, I mean, small caps have been trading at dramatically lower price to earnings multiples. Obviously, we do expect earnings to come down across the market, but we think small caps are pricing in a much more dire scenario than the mild recession that we're expecting. So they're trading at the same multiples they were during the global financial crisis. Meanwhile, we think there are some positive macro fundamentals for small caps right now. Services spending holding up better than goods spending, which usually happens during a recession. COVID was sort of the main exception to that when everyone was home buying goods. But typically that's what happens in a recession. Small caps are more exposed to services right now. They're also more geared toward corporate spending on CapEx. And CapEx spending, we think, will be much more resilient this downturn. You have underinvestment by corporates for decades, but now you also
Tesla actually having a reasonably good day, especially given its recent history. You can see they're up and bucking, of course, the overall market trend. Still, though, the stock is down, about 55% year to date, and that has left some investors raising questions over CEO Elon Musk's obligations to another company he runs, namely Twitter. And new SEC filings overnight revealed Musk sold roughly 22 million shares. That was earlier this week. $3.6 billion taken in for an unknown purpose, although perhaps related to Twitter as well. But there are polls still out there, of course. Oppenheimer, Morgan Stanley called the stock a top pick into the new year. And there's always Kathy Wood out there buying the dip. Our next guest says Tesla is one of his top holdings. He has been critical of Musk in recent days, though. Joins us now to discuss. Gary Black, Future Fund Managing Partner. Gary, good to have you. And of course, our viewers may recall you have been somewhat critical of these dual responsibilities, really more than that Musk has, but in particular what he's doing at Twitter. What would you like to see here?
Look, if you look at the fundamentals of Tesla, they haven't changed at all. This company is going to earn at least $7 next year. It's growing volumes at 40%, earnings at 50%, and yet it's trading at literally, my numbers, 22 times earnings. So it's just above the S&P. And I would argue there's a ton of catalysts in front of us. They got Cybertruck. They have a $30,000 model coming out. We think they're going to have a $10 billion buyback next year. The IRA, which is $7,500 EV credit, is going to kick in next year. So the fundamentals are extraordinary. The problem is all the noise. And, what we would like to see is that, Elon bring in a CEO for Twitter who's from the social media space, give up running Twitter, and refocus again on being 100% Tesla's CEO. And I believe that the board is probably pressuring him to do that, because I can't imagine a board letting him spend so much time, rebuilding the company from the ground up.
Yeah, I mean, you could argue, I would think for the longest time during Tesla's history, there was a Musk premium. Do you think there's now a Musk discount?
I don't think so yet, David. Look, the problem is with him insulting his customers. And so he took over Twitter and he immediately said he's going to name and shame the advertisers, which pissed off all the advertisers. 50% of them left, and Amazon and Apple have come back. So I think that's turned the corner, because he's kind of stopped that. But lately he's got this woke mind virus rhetoric that I'm sure is not making his EV customer base that happy. These are the same people who are buying EVs, and I know you pointed that out. And I think that's just a big mistake. So I would hope that some of his advisors are saying, "Hey, Elon, you're brilliant. You've created so much value, but stop pissing off all of our customers, because that's not going to help the EV business." Do I think people are actually canceling orders because of his woke mind virus rhetoric? I don't believe so. People still love buying Teslas. They're the best cars on the market. They're the only ones that can, give great performance, great battery range, great technology, and safety. And those are the four elements that people look for when they buy an EV. And so I think that this is just a pause. This is price. It's not value, right? Price has fallen, but the value really hasn't changed. If you look at estimates by the street, they really haven't changed all that much, despite all this noise, for lack of a better word.
Yeah. But if it continues, does it change your opinion? I mean, to your point, he seems to be antagonizing the very buyers of his of Teslas, perhaps tarnishing the brand. I mean, is there a point at which you just get so frustrated you say this is a long-term issue and I no longer want to be a shareholder?
Look, let's see where it goes. What I found with Elon, he recognizes very quickly when he makes a mistake, and then he pivots. I have to believe that the board is pressuring him to spend more time at Tesla and find a CEO for Twitter. So that'd be the first catalyst I'm looking for. The second catalyst, he's really got to just stop politicking and again, insulting customers. And I got to believe that somebody on the Twitter board, at least is saying to him, or on the Tesla board, stop doing that. And I bet that you'll see him calm down. I saw him calm down with Twitter. I speak with a lot of advertisers. We own Google. And, look, people still believe in Musk. They believe he's disruptive. They believe he's innovative. He's got some really great ideas for increasing MAUs at Twitter. And I think he's smart enough to realize that he can't keep going down the path he's going. So therefore, I think he'll bring in a CEO. I think he's probably interviewing CEOs. I don't know who it'll be, but it'll be somebody who's from the social media space, who gets advertisers, but who's also innovative, who's tech driven. And I'm hopeful that people on the Tesla board are guiding him and saying, look, here's how you need to behave if you're going to keep, being CEO of Tesla and CEO of Twitter at the same time for the next few months. So to answer your question, no, we're not ready to give up. The fundamentals are just extraordinary. I went through all the catalysts. We have a $550 valuation on Tesla without really heroic assumptions. What Tesla is doing is just basically leveraging the global EV adoption, going through the roof. We're at 10% EV adoption in this year. It'll be 60 by 2030. And in the meantime, 30, 36% by 2026. We have earnings of next year of $7 going to about over 20 by 2026. Even if you just let's just put a 40 multiple on Tesla, which is 2 times growth, future growth, that's still an $800 stock. That's $3 trillion in valuation. So we just think the opportunity in front of us is extraordinary. Elon's just got to focus on Tesla and stop talking politics would be my advice.
Gary, your tweet suggests you think he's done selling for now. That the cost drain over at Twitter has been satisfied for now. I guess I'd ask you about that. And how do you evaluate competition like the F-150? We mentioned earlier in the week, Motor Trend Truck of the Year.
Yeah. Look, it's hard to know when Elon is selling. If you look at his past pattern of selling, so he sold in April, he sold in August, he sold in November. Normally, he does this where he'll sell for 3 days, and then you have to file within 2 business days after your first sale. So his first sale was Monday. He filed last night. That fits the pattern of what he's done in the past. In the past, he's finished selling. He's filed his Form 4s, and then he stops. And that doesn't mean he's done selling forever. He made the mistake in August of saying, I'm done. And then again, he sold in December. When a CEO says he's done selling, it just means for now in his tranche. And to your point, Twitter's turned out to be more of a basket case than I think he realized. And we didn't want him to buy Twitter. We were very, very vocal back in April. Please do not buy Twitter. You don't know anything about advertising. You don't advertise. You're an engineer. You're a product guy. And, Twitter's all about placating advertisers and getting them to spend more money. And yet he bought it. He tried to get out of it, as you know. We felt very strongly the Delaware court would force him to do it. So he had to buy it. And, we're at this point now where I think he's trying to make the best of a bad situation. The good news is he got rid of about half the staff, or they left, but that cut a couple $1 billion of expenses out. So when we look at the burn rate now, the cash burn rate, assuming he's lost 50% of the advertisers, which is probably too high, because Apple coming back and Amazon coming in, they're bellwethers, and a lot of people look at that. We estimate after the $1.2 billion of interest expense is going to go out the door, we're looking for about $2 billion in cash flow going out the door in 2023. Now, to your point, that $2 billion could have already been funded. He sold $4 billion of stock back in November, but I think he's going to use some of this to pay down debt. You look at his tweets the last week or so. He's talked about not having debt, not having debt if you're going into recession. And so I think some of it's going to go to at least getting rid of some of the most expensive debt, which is, the bankers are holding. And if somebody came along and said, hey, we're going to take this off your hands, some of it, at even 80 cents on a dollar, I think they'd be thrilled. So I would expect to see some of it go to pay debt.
Yeah, I think, Gary, that's a good point. I think Morgan Stanley and the other banks would most likely at 80 cents be sold to you. And to your point, he would then reduce his overall interest payment. But again, I guess just the larger question is you want him out of Twitter as soon as possible in terms from a management perspective. You seem to be indicating a belief that there are board members at Tesla who are pressuring him to do that. Do you know that, or is that just a guess on your part?
I don't know that. I've been on boards before. I've been on public boards before. I know the way boards operate. And I got to believe, because I talk to a lot of individual shareholders and I talk to a lot of institutional shareholders, there's immense pressure being directed at the board to do something. The fact that they've let Elon basically buy another company and spend whatever percentage of his time, 70, 80%. Most boards would not allow that. I got to believe.
Does he listen to his board, though, Gary? Does he listen at all? Does he care what they have to tell him?
I think he used to listen to Larry. I'm not sure if he still listens to the board. I got to believe he does it. Look, what people tell me who know Elon very closely is when he realizes he makes a mistake, he will pivot much quicker than other CEOs and say, This is what we should be doing instead. And I believe at the end of the day, he's brilliant. He's made a lot of money for shareholders. He's a great visionary. He's the visionary of our times. People still love his cars. I think he's going to realize the mistakes he's made, because I've seen him change even with advertisers. He's changed his whole approach to them. I think he's going to realize he's made a mistake with his rhetoric and everything, and he'll stop. But I think the bigger issue, which will make me and other shareholders feel better, is he gets out of Twitter, lets somebody that he trusts, works 24/7, his same vision, take over Twitter so he can go back and focus on Tesla. Hey, can I throw one more thing at you guys?
Gary, we really got to go, so make it quick.
Okay, so I don't believe he would have been allowed to sell shares last night if he had any MNPI. The trading window for Tesla closes on Friday. And if he knew that there was something bad coming up, like a fourth quarter volume miss or something, I don't think the board would have allowed him to sell shares. So I think that's a positive you could look at in him selling shares right before the trading window closed.
Well, it is the first day that we've seen that stock actually up, in particular on a day when we have a broader market decline. Gary, great stuff. Very, very happy that you were able to join us today. Thank you.
Sure. Thank you.
Meantime, the Fed's latest rate hike signaling some trouble for housing. Home builders trying to navigate what is obviously a cooling market. The iShares U.S. Home Construction ETF, ticker ITB, losing more than a quarter of its value this year. Barclays writing this week that valuations are already priced in for a sharp recession in housing. And as you know by now, Lennar lower than expected earnings for the latest quarter. They forecast higher mortgage rates will lead to a decline in new home orders, trying to make some gains in the last 3 months of trading. We've been watching shares of Lennar year-to-date charts, so you can see gains of nearly 20%. I think it was Jim yesterday said the best soft landing chart you can find at the moment.
Yeah, talking about it this morning, saying it's not what necessarily Mr. Powell wants to be seeing, that 6-month chart. All right, when we come back right here, the co-founder of Ares Management, David Kaplan, is going to join us. We got a big show for you still ahead. Don't go anywhere.
TV.
I'm Christina Partsinevelos, and here's your CNBC News update at this hour. The Kremlin warns there could be consequences if the U.S. gives Ukraine sophisticated Patriot air defense missiles. Multiple reports say U.S. officials are poised to approve the transfer as early as today. The Kremlin spokesperson did not elaborate on what those consequences might be. Tornadoes touched down in the south for a third straight night. One hit New Orleans, causing widespread damage to homes and buildings. Across Louisiana, the death toll from the storms has risen to 3, with at least 30 people injured. And near Orlando, Florida, it's always Florida, a dinner delivery ended up being a tasty meal for an unwelcome guest. A black bear was caught on video swiping a bounty of Chick-fil-A before it could be brought inside. The homeowner said the bear made off with 30 nuggets and a large order of fries, but did not touch the salad. What a bearish appetite. Back over to you, Carl.
Christina, thank you. Christina Bartzanevelos. About an hour into trading this morning. Obviously, the selling accelerating here. Dow is now down 700 points, trying to see if we can hold 3,900. Bob Pisani's with us, going to break out some of these big movers. Bob?
Well, the important thing here is it's a lousy day for the soft landing crowd. So we had the retail sales numbers were lousy. Industrial production was lousy. The Empire numbers were lousy. The ECB is raising its inflation forecast. Remember, there's a whole crowd out there that's watching the strategists and analysts lower their earnings estimates for 2023. They're actually negative. Most of the strategists have negative earnings estimates for 2023. That's not good for valuations, but there's a whole crowd playing against them. That's why prices are so high right now. They're saying, we're going to have a soft landing. The strategists are all wrong. The earnings are not going to fall apart in 2023. Well, you get this data today and it says, this is not good for the economy. Maybe they're right. So people are lightening up on positions. And this is what I call the valuation problem for the market. Prices are high, but earnings are coming down. So strategists think earnings are going to go down 6%. That's a forward multiple of 19. That's a problem. When you get over 18, you have major problems because the historic average is 17. And when you're over 18, it's .com. It's 99, 2000, 2017, 2020. That's about it. To have a multiple at 19 or 20, you've got to argue that the economy is improving. You've got to argue that earnings are going to be improving. You certainly can't argue earnings are going down and the economy is going down and I deserve a 20 multiple. They're going to think you're a crazy person. So you see today, Carl, really right across the board, we're down just about 2%. Yes, some of the more defensive areas, like consumer staples, are down 1.5%. But don't kid yourself. This is just a lightening up right across the board from all of those people who are out there saying, no, the crowd that thinks we're going to have a harder landing is completely wrong. It's going to be the soft landing. And now it's a little harder to make that argument.
Appreciate that. Good setup for our next guest, whom you know well. Let's bring in UBS Director of Floor Operations, Art Cash. And Art, hope you don't mind the late request to talk on the phone, but we are curious to know what you think is going on here. If this is just some swirl within a range, or if we really are resetting some longer-term economic expectations.
Well, a couple of things, Carl, and you know, because you get to see my daily pre-market comments every day. I've been writing for about a week that there's a cycle in here that indicated we might see an interim low between December 13th and December 21st, and this may be that test going on. The key here is the 3,900 level. We've been testing that all morning. If it holds, we'll be in good shape. If it breaks, we can have a problem. Now, we got a little help, or the Bears got a little help this morning from Christine Lagarde when she announced that the ECB had raised rates. She said something like, the market is clearly underestimating how high we're going to have to raise rates to cut inflation. That scared the heck out of everybody in Europe, and the yields on European bonds began to spike. Now, we already had weak economic data here. We were softer. That led to these lows. That spike in European rates led to these lows. Now, I don't mean to hog up the whole thing, but let me get this out because today is very important. Number one, you got to try and hold the 3,900 level. If you break 3,900, be careful as to how the rest of the day goes. If it develops into washout selling, that raises the possibility that you could get an extension to get new selling on not Friday, but on Monday and Tuesday. So if you've been doing this 60 some odd years as I have, you get to see these patterns develop. Now, there's nothing certain about that. That's probably at best a 10% risk, but watch how they close today. Did they hold 3,900? Did they get a late day bounce back? If they in fact break and get heavy selling and you get a washout day, you have to be a little bit careful as to see whether it extends into Monday and Tuesday. But right now, it's all about the market taking its own pulse, taking its own temperature. It's almost all internal.
Do you think the possibility that we do bounce on Europe's close today is important?
I think it will be. Perversely, what you could get if Lagarde scares the Europeans enough, you could get an accidental flight to safety. In other words, the people in Europe say, holy smoke, we're in bigger trouble. We've got a lot more to go than America. Well, let's go in. And they would then start buying U.S. currency and start buying U.S. bonds. That would bring yields down and probably put a bit under stock. So it's all interconnected here. It looks to be one heck of an interesting day. So we're going to keep watching the internals. They break 3,900, particularly if they break 3,900 and it brings in some cascade selling. This could be a very tough day. So keep your seatbelt fastened out there and hang on.
It's interesting. Just a couple days ago, Art, we were looking at that 4,100 level. People were saying, well, maybe not as important as you can get to maybe 4,220. That would justify the argument that maybe the October low was an important one. That seems to be far in the rearview mirror this morning.
Well, it is. And that's why, as I said, Carl, you have to look at all of these cycles, okay? Some of us don't have a computer. We're still using a slide rule. And that told us to be careful of a possible interim low between the 13th and the 21st. This could be it. If so, get ready for the Santa Claus rally. So we're going to make a low here in one of these next several days. Maybe this is the one. And then the end of year seasonality should kick in.
We'll end it on that hopeful note, Art, and I imagine we'll be talking in a few days at the very least. Thanks so much for coming to the phone.
My pleasure.
Art Casher.
Okay.
When we return, Ares Management's David Kaplan will join us, talking, of course, the Fed, recession fears, private credit markets, and a whole lot of other topics. Walking the street, right back.
As Kramer Guide.
Well, stocks, as you see, continuing their slide this morning. Of course, growing recession fears as the Fed continues to raise rates. We're now at the highest level we've seen in 15 years. Our next guest helps lead Ares Management. It's an alternative asset manager. It operates in the credit, private equity, real estate markets. And joining us now is a co-founder of Ares, David Kaplan. David, it's good to have you, particularly on a morning like this. Let me just start off with sort of the underwriting process from your perspective in terms of the decisions you guys are making every day. How has it changed, if at all, given the uncertainty you're seeing out there right now in corporate America?
Well, thanks for having me. I really appreciate being here. It is definitely an interesting day, an interesting morning. From an underwriting standpoint, our job actually is a little difficult today in terms of probability weighting outcomes. Obviously, the Fed is very committed to raising rates and squashing inflation. We're definitely seeing inside the boardroom of many of the companies that we sit in the boards or touch, difficulty in projecting what their budget's going to be for next year. So there is a high degree of uncertainty. And as a result, we are raising our, standards, if you will, around rates of return for a quantum of risk in the underwriting process today.
You are, yeah. Are you pulling back at all, just to a certain extent, or you're still committed to these markets, but as you say, only willing to do so at perhaps a higher rate of return?
I wouldn't say we're pulling back at all. We actually have $88 billion of dry powder. These are markets, frankly, and if you go back to 2008, 2009, even 2010, we grew through that market environment. And actually, these are markets and the volatility that we see in the markets that really fit our type of capital, which is extremely flexible in terms of what we do.
Do you see a default cycle coming? I'm just sort of curious, particularly given your long history and with so many of these predictions of recession. Or are we off in terms of, expecting sort of something that would be similar to what we've seen in the past?
Well, obviously, defaults right now are very muted. We don't see a wave of defaults coming in terms of a tidal wave. But certainly, when you look at 24 and 25 maturities, and definitely we're hearing in the market, owners of businesses with credit and borrowings that have 24, 25 maturities are starting to think about solutions today and certainly early in 2023 to deal with those. And whether the market contraction or market conditions lead to significant defaults, TBD. My crystal ball is as good as anybody's.
But I do wonder if you think that has something to do with the price action today, meaning if the conversation continues to pivot to how long the Fed, say, holds at a certain level, then maybe it's not so much about maturities in 23, but you do start to think about what comes up in 24 and 25.
What we've seen, Carl, in terms of, the companies that we touch, generally speaking, we're a little bit more senior in the capital structure. We're investing in and lending to more upper middle market companies that are a little bit more resilient. So that is, from a credit perspective and our positioning, we feel pretty good about that. But I don't really see a wave of defaults in the traditional sense. I do think you're going to see alternative credit and alternative capital being raised in 23 in anticipation of debt pay downs as well as maturities. So I don't really see the inability to pass along and protect margins yet.
Your CEO, Eric Getty, has talked about a golden age of private credit, not necessarily saying we're in it, but sort of intimating we are. Do you agree with that, David? And, give us a sense as to where things stand right now when it comes to private credit in particular, which, of course, we've seen enormous growth in over the last few years.
Yeah, look, I think yes, I agree with that. I would certainly say that we're in this capital rotation that has been taking place for quite a period of time of capital exiting and if you will, the more depository regulated bodies of capital into the hands of more institutional capital. We do not see that abating. And if you think about today, where the base rate is for our credit has moved 400 basis points in the last year. And so we're actually seeing on the private credit side, double-digit return opportunities today. And so folks that are allocating institutional pools of capital see that as well. And so we actually feel pretty good about where we sit in terms of private credit today and the opportunity set that sits before us.
Yeah. On the other side of that, private equity, which obviously perhaps can't generate quite the same return given higher rates of interest. What are your expectations in that part of the business right now?
2022, obviously some muted volumes. I would certainly say a bit of a bid-ask spread in terms of what sellers of businesses are looking for and what buyers of businesses are looking to pay. I actually think that balances out a little bit here coming into 2023. We're actually seeing the early signs of what might be an increased level of realizations, because there just needs to be realizations. When you think about it, many GPs, many private equity firms are built upon the fact that they have to return capital to their investors. And so we actually think there's going to be a little bit more deal volume, assuming there's no exogenous factor that comes into play, but a little bit more deal volume in 23 than 22.
I want to ask about a specific situation, just because it's one that's come up here a number of times. Carvana. You're apparently part of a sort of a group of creditors that have kind of banded together to make sure if in fact there was a bankruptcy, you're in a good position. Is that the case? And do you have any expectations that Carvana, where you have provided credit, is in deep trouble?
I really don't want to comment on a specific credit. Carvana is, we think, a viable business, one in which we feel very good about our position in the credit.
Yeah, and finally, just to come back sort of where we started, on the Fed, on the outlook, how would you characterize your own view at this point, given obviously the portfolio companies you deal with as we head into 23?
Look, I think there are a lot of Fed watchers that are prognosticating what's going to happen and parsing all of their words very, very carefully. From my perspective, what we're seeing real time is the Fed is getting the job done. And we're seeing certain items, whether it's consumer-facing businesses or business-to-business services companies, where there's actually, a decrease in pricing happening in terms of cost of goods, whether it's transportation, a container cost, from Asia to the U.S. is certainly getting close to where it was pre-pandemic. So I think as that data comes out, the Fed is going to have to factor that in a more robust way. And we'll see what, 23 unfolds in terms of where they take rates ultimately and how long they hold them there.
Yeah, the key questions, of course, that we entertain every day. David, appreciate you taking the time. Thank you.
Good to see you. Thanks.
Coming up this morning on Tech Check, the OPI analyst who named Tesla as a top pick for next year, as that name is really one of the few index components in the green this morning besides Verizon. We're back in a minute. Worst day in about a month for the major averages, all of them down 2% plus. For a moment there at the lows of the session, it was the worst day for NASDAQ since November 2. We'll monitor all of this and watch for Europe's close not too long from now. Stay with us.
Rated PG.
Welcome back to Squawk on the Street. Home flipping is still a big business, but it is coming off of its record run. Diana Olick joins us now. She has more on that story. Diana.
Well, David, it's not surprising given that home prices are weakening so quickly. So the record run has had flippers making big money. It now appears to be fading and flippers are moving on. Just 7.5% of all home sales in the third quarter of this year were flips. That's down from 8.2% in Q2, according to Adam. A flip is defined as a home bought and sold in the same 12-month period. Flips are still higher, though, than they were a year ago when the share was just under 6%. But here's why flippers are bowing out. Gross profits and profit margins declined significantly, reflecting the overall pricing weakness in today's housing market. In fact, gross flipping profits dropped at the fastest quarterly pace since 2009 to just $62,000. That's down 18.4% from Q2 and down 11.4% year over year. And that's the smallest profit since the end of 2019, of course, pre-pandemic. With that drop in gross profits, the return on investment fell as well to 25% from 30% in the previous quarter. Still not terrible, but just not as good. Adam notes it's not the size of the profits, but really how quickly they're falling that's so dramatic. Markets that did still show the highest flip rates were Phoenix, Spartanburg, South Carolina, Atlanta and Gainesville, Georgia, and Winston-Salem, North Carolina. The market's still giving the best returns: Buffalo, Pittsburgh, Scranton, Pennsylvania, and Salisbury, Maryland. While mortgage rates did drop over the last 2 months slightly, that won't matter much to flippers, as about 64% use all cash, and that is unchanged from previous quarters. Going forward, profits are likely to fall further as home prices continue to weaken. Back to you guys.
Very interesting that I didn't realize, they use a lot of cash. Diana, while we got you in 30 seconds, Lennar shares really not doing too much in response to those earnings. What is your take?
Well, it's not surprising given the weakness in the housing market, and we'll start the conference call with them in just about a minute. But what's surprising to me is they did not mention in their release at all the recent drop we've seen in mortgage rates, if that had any kind of effect, any perhaps green shoots to their business. So we'll be watching for that on the call. All right.
Diana Olick, thank you. And of course, speaking of watching, we're keeping a close eye on markets in which we have the S&P down to 39.05, some 2.25%. The NASDAQ, as is often the case, down almost 2.7%. That's going to do it for us right here on Squawk on the Street. Time to hand it over to Tech Check.
Good Thursday morning. Welcome to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Fort. Today, stocks under major pressure, as you can see, following that 50 basis point rate hike by the Fed. NDX losing more than $5.5 trillion in market value this year. More than 95% is in the red today. Elon Musk sells another big chunk of Tesla, but one firm says now is the time to buy. We'll talk to Oppenheimer's analyst who names it a top pick. And then the Street thinks chips can once again be key growth drivers in this market. AMD, NVIDIA, Marvell, and others as top picks, although definitely feeling some pain today. We're going to begin the morning, though, with markets moving lower. Our next guest sees a recession on the horizon, doesn't think the economy can keep up as rates approach 2007 levels, with U.S. GDP having doubled. Joining us this morning, Northman Trader founder, lead market strategist, Sven Henrik is with us once again. Sven, great to have you.
Hi, Carl, great to be with you.
So I know for a moment there was a period where you were beginning to think about how to get more constructive. Is that gone for now?
Yeah, we were constructive there definitely mid-October. I mean, the technicals told us a big rally was coming and into possibly the weekly 50 MA on the S&P, and we got that actually this week. I'm still kind of constructive because we're entering a really positive seasonality period here into year end and beginning of the year. But obviously the reaction we just saw in the last couple of days is both technical, but also exacerbated by the Fed's hawkish stance, at least on paper so far.
What do you think breaks? Is it going to be credit? I mean, is this going to be a wave of defaults? Is it more about earnings disappointing, valuations not being able to keep up with earnings, or a combination of all those things?
It's a combination of all of these things in context of a historic script. Look, the Fed funds rate basically yesterday pointing to 5.1%, which brings it awfully close to the 2007 level highs. Keep it simple. In 2007, debt to GDP was 60%. Now it's 120%. And what we're seeing now in terms of the lag effects of the Fed rate hikes, we're seeing it in the data already. I mean, industrial production today, retail sales, you name it, it's all starting to slow down dramatically. So in that sense, the rate hikes have the effect. The problem is the Fed has not accounted for the lag effects yet, and they're coming in hard. There is no way the economy can sustain an extended period of higher rates at 2007 levels with the debt construct we have right now. Government interest payments are going through the roof, $734 billion already in Q3. This is only going to get higher and more stringent next year. So my premise on all this is that following the historic script, basically we're going to actually see rate cuts next year, even though the Fed is currently in denial mode. Why? Because CPI is actually going to come down hard. The Fed funds rate at 5.1% will meet a 2 to 3% CPI rate sometime next summer based on the year-over-year rollover math. And then the Fed will actually look to have really aggressively tightened. And historically, even Volcker back in the 1980s, once the economy enters into a recession, the rate cuts are coming and they come rather aggressively.
Right. I mean, and then in a sense, if we are in a significant recession, what the Fed does perhaps starts to matter a little bit less than what the economy is actually doing. So I wonder, based on what we saw from November retail sales, and given what you're saying about the Fed being behind the curve, what do you expect the reaction to be to the market reaction to December retail sales? A lot of people hoping that Black Friday cyber week surge that we saw is going to hold up over the next 10 days or so to Christmas, but I think there are questions about that.
Yeah, look, I mean, we can still see a splurge into year end. I mean, don't forget, Americans' motivation to spend is always strong. But what we've seen this year, obviously, in the data, is an incredible push into credit card debt. You know, this despite claims that there's all these excess savings, the spending patterns in terms of credit cards vis-a-vis anything else indicates that a lot of Americans are in distress. And let's not forget, companies are preparing for layoffs. We're already starting to see that process. Buybacks are coming out. So this economy is going to face a lot more tightening next year in terms of a real sense. Keep in mind, this year, the Fed had originally forecasted for this year 4% GDP growth with a less than 1% Fed funds rate. Now, what the median Fed funds rate for this year ended up being 2%. We ended up the year now at 4.25%. And that means next year, we're going to be at a Fed funds rate on the median basis, 4 to 5%. Yet the Fed keeps insisting on 0.5% positive GDP growth. Makes no sense whatsoever as we're doubling this. So I'm sorry, you know, every Fed economic forecast should come with a disclaimer, you know, believe it at your own risk.
But Sven, just to push back on that, the Fed is looking at wage growth in the labor market. You and others, I know, say that CPI is going to, as you just said, come down hard next year. You're looking at things like commodities and used car inflation, but those make up a much smaller proportion than wage growth. So, you know, what makes you so confident that we're going to see that come down and that the Fed actually has room here to reverse course?
I don't think they have room to reverse course. They will ultimately have to reverse course. Look, even in the Fed's own forecast now, their unemployment forecast for next year is crept up a little bit to 4.6%. Newsflash, show me one time in history where the Fed has even got remotely close to predicting the labor market weakness into a slowdown. And the answer is absolutely zero. They're off by a mile every single time. So I would be cautionary here when I hear Paul say that, yes, companies don't want to lay off and probably try to avoid doing that. But that's just not what's going to happen. Corporate profits were at a record high this year on the heels of obviously the stimulus the year before, but also being able to pass through inflation-related price hikes. That's all going to come back to an end next year. And these margins are going to come down and companies will do what they will have to do, which is cost cutting. And that means jobs. And that's what we're already seeing in the tech sector. And we're starting to see it with some banks as well. This is a process.
Right.
Sven, yeah, I understand what you're saying in terms of the tech sector. We are seeing those layoffs. Those could increase next year. But even if it does, that's a very small part of the job market, right? We need to see layoffs at the services level, don't we? And what needs to happen for us to see that proportion of the economy see layoffs?
It's a process and it's coming. I have little doubt about that. You know, at the end of the day, all these companies are facing the same issue, which is cost of carry and margin compression. So yeah, earnings estimates are still too high. Could I be wrong on all this and we have a miracle, shallow landing with no real recession? Yeah, I suppose it's possible. But you're going to have to disbelieve yield curve inversions and everything else at this point into the highest debt construct from a rate hike perspective. So I think this is a pretty obvious case in terms of history. And we're going to find that maybe the dot plot by the Fed that does not presume any rate cuts until 2024 is going to be, again, to be seen as much too optimistic on their part.
Hey, last thing, Sven. You have looked at NDX, the long-term trend, which you point out has been defended successfully a couple of times. Can that happen again, given the fact that many believe there's plenty of operating leverage within tech to keep earnings strong if they do reduce headcount?
Yeah, despite what I just all outlined, I'm still kind of structurally positive here from a technical perspective, at least for a little bit, and to year end, maybe into the early part of 2023, because the technicals have been so clean this year, the long-term trend has held. And at the same time, we're forming bullish structures still on S&P and NDX on the weeklies, despite the weakness that we're seeing now. In fact, this week on both NDX and S&P, we got to the downtrend line, rejected again. And the more often, from a technical perspective, the more often you tag a trend line, the weaker it tends to get. So If bulls can hold kind of basically, let's say, the 50-day moving average here on the S&P into next week, I suppose we can still have another crack at this here towards year end at the beginning of the year. But then I suspect any larger rallies into early next year will probably present a selling opportunity for an ultimate low around 32, 31 on the S&P once the recession hits.
Interesting. Not too far off from what some of the major desks are arguing about Q1. That's for sure. Sven, look forward to tossing it around in the next couple of weeks with you. Thanks so much, Sven Henrik.
Thanks, Carl. Thanks, guys.
Meanwhile, we got a downgrade of Snap this morning. Also in the ad landscape, Netflix lower following reports that they're letting some advertisers take their money back after missing viewership targets. Julia Borston's here with us on that. Julia, what's going on?
Well, John, let's get a gut check on Snap first. Those shares are down about 9% on a downgrade to Snap to hold with a $10 price target. The firm saying, this is Jefferies saying, quote, we believe that Snap will continue to face several headwinds, including that Apple iOS 14.5 privacy changes, a worsening macro picture, and intense competition. Noting that while many of these factors are well understood, revenue estimates still appear too optimistic. Now, it is worth noting that those Snap shares are down over 80% year to date. Now, turning to Netflix, Digiday reporting that the streamer is letting advertisers take their money back after falling short of their ad-supported viewership guarantees that they made to advertisers. Now, the publication reports that shortfall amounts vary by advertiser, but in some cases, Netflix has delivered only roughly 80% of the expected audience. So that is according to an unnamed executive, and CNBC has not yet verified these reports and has reached out to Netflix for comment. We haven't heard back from Netflix yet. But I just want to note, as someone who's covered the TV industry for a long time, that it is not uncommon for broadcasters to deliver what they call make goods to advertisers when viewership falls short, saying you didn't get the viewership you wanted, we'll make up for it somewhere else. So it is unclear how dramatic these shortfalls are. But regardless of all that, Netflix shares are down nearly 8%. John?
But Julia, given that this is the start for their ad tier and they were so confident out of the gate about how well it would perform and how popular their content is and how well they would be able to target, it seems like maybe they would have underpromised. So is this reflective of an overall possible digital consumption or consumer slowdown? What would you say is the broader lesson here, if indeed Netflix is underperforming?
Look, this is certainly not a good headline just about 6 weeks after your launch of an ad-supported service. Obviously, you want to be really strong out of the gate. But one thing I'll say is that Netflix warned many times that they're going to start slow, they're going to iterate, that this is not going to be a static ad product, that they're going to continue to learn and make it better. So I think there was some warning about this from the start, but many people in the ad industry said that Netflix was very bullish on their own capabilities to target and reach all these viewers. But a lot of it can come down to these weird, quirks of viewership trends. If there's a show that they expected to be a big hit that's less popular than expected, or there's a shift over to Disney Plus because of some new content over there, maybe they lose some kids' viewership. So there's so many factors that could be at play here. I will be very curious to see what data Netflix itself reveals about its ad targeting, but not exactly the greatest headline when you're trying to launch a new ad-supported product, both for advertisers and also for consumers, raises some questions there. Yeah, not the greatest headlines. I think that's right. Netflix down 8% almost. Julia, thanks for laying that out for us. We're going to stick with the ad market and Snap and bring in Jefferies analyst Brent Thill. He is the one who downgraded the stock to hold this morning. Julia laid out the case. Brent, maybe talk about what she was just laying out in terms of Netflix and some of its advertising challenges. Could that be a good indicator for Snap and other social media companies? There were worries that Netflix and Disney's ad tier models would maybe take dollars away from them.
Our house view at Jefferies is that we're going into a hard landing versus soft landing. The first thing you do in a hard landing as a corporation is you cut your ad spend. It's the first thing that goes because you can dial it up and down like a stereo knob on your car or at home. And right now the knob is turning down. And as we go into Q1, I think the environment's going to get worse. The consumer's softening, weak retail sales obviously suggest that retailers will probably spend less as we go into Q1. So we think we've got an air pocket and there's no visibility with no visibility, you sit on the sidelines until the fog bank clears before you can take off again. And unfortunately, we just don't see that happening until sometime into the first half of next year, with line of sight in the back half of next year. Now, the question is, if the recession starts in Q3, like Jefferies economists are predicting, next year is going to be a tough year for the whole year, with line of sight then going to 24 numbers. So right now, I think, again, we're in a holding pattern. And until we get better visibility, I think the whole ad industry is somewhat in a tailspin. Obviously, Amazon, Google, some of the other proven names, you'll see wallets go from experimental to proven, and they'll incrementally probably take some market share in the short term. And obviously, Netflix is early in their transformation here. So I think we're pretty bullish about what they can do over time. But, short term, it's they're trying to get that off the ground.
Yeah, we have seen some notes this morning that mention the ad space. Brent, one argues that ad market's been deteriorating for most of the year, but actually has added to that deterioration, accelerated to that deterioration, really in the past month. Does that fit your checks?
It does, because I think what's happening is you're seeing broader corporate America lose some energy and steam, across many subsectors. And again, it's just the first thing that can get cut. It's not a requirement. It's a nice to have. And yes, everything's going to continue to go digital. Yes, we're bullish about the long-term trend. The short term, you don't have any visibility. I mean, if you go back and look at Snap's numbers in the last 3-4 months, when they talk about the variability that they saw in their core business, and then you've seen weakness in Salesforce.com in their marketing and commerce cloud. You've seen weakness in Adobe's marketing cloud. You see it everywhere. You see it in software. You see it in digital advertising. Again, I think it just matches what we've historically seen when we follow markets going into a recession. Again, we believe we're in for a hard landing. It's the first thing that goes. So it'll come back, and it will be one of the first areas that comes back when the world recovers. But I think right now that recovery is uncertain. It doesn't happen in early 24. Does it happen in late 23? That's right. The unknown for right now.
Speaking of Adobe, we do expect to get some more insight from their report this evening. It's kind of one of those off-cycle, late-cycle reports. Interesting to hear what they have to say about Marketing Cloud, and I'll speak to Shantanu Narayan, the CEO, tomorrow exclusively on that. But what's happening? Are you watching digital consumption? Roblox this morning is down 16.5% on missing the bookings number, just as we're getting this report about Netflix as well. And then there's questions about Snap and the overall digital ad market. I mean, is there something here? Is there a thread, a line to be drawn through the weaker November retail sales, digital consumption slowing down, and then digital advertising also slowing down, perhaps because of an overall economic slowdown, and then also perhaps because there's just less activity out there for advertisers to take advantage of?
Yeah, I mean, I think we're in a broad slowdown. And again, we're going into a harder landing. So think about it right now. If we're in a period where this is where advertisers want to spend because they want to capture us into the critical holiday period, and they're pulling back the throttle, what are they going to do in Q1? I mean, it's going from, 8 on the throttle down to 2. And so I think Q1 is going to be a very dark period for advertising in the short term. And then the question is, how long will that last? And I think we've seen this, again, to your comment, John, on Adobe. I mean, they lowered numbers last quarter. Everyone knew they had to lower. They brought the number lower. The question is, when there's one rat in the kitchen, is there another rat? Meaning, do they have to cut again? And certainly we've heard they're in a great fundamental position. But again, no one is immune to what's happening. Google, Adobe, Salesforce, all these companies are seeing the same thing. It's not like we're picking up one data point and saying, yeah, that's a one-off and someone's taking massive share. That is not happening. Everyone is getting hit. So in the short term, again, it's the best advice just to sit out the storm and to wait for it to clear before you get back in.
Brent Thill, thank you. We are seeing more selling pressure. The NASDAQ now down 3%, and the S&P 500, John, losing that 3,900 level.
Yeah, and still to come this hour, Tesla named a top pick, plus the highlights from CNBC's conversation with the CEO of crypto exchange Binance. Tech Chat. Just getting started.
TV.
As Sam Bankman-Fried faces charges in the U.S., other FTX executives could fall. Former FTX Digital Markets co-CEO Ryan Salame told the Securities Commission, on November 9th that at least 2 other executives were responsible for using customer funds to cover losses at Alameda Research, according to U.S. court filings. The FTX drama continues to ripple across the industry. Net withdrawals at the world's largest global exchange, that's Binance, have topped $3.6 billion over the past week, according to blockchain research group Nansen. Bankman-Fried and FTX had paid Binance between $2 and $3 billion to buy out their stake in the firm, but in part with FTT, that token, which is, of course, now defunct when CZ was pushed on Binance's liquidity. Here's what he had to say.
We're financially okay.
Including you have $2.1 billion to give away. If somebody came to claw that back, you'd still be fine?
We'll let the lawyers handle it. We are financially strong.
Guys, one of the most interesting things, there was a lot in that conversation that I thought he said was, we don't rely on trust, we verify. But then he went on to say that nothing is verified. We do not have a complete picture of proof of reserves. We do not have an actual audit. And when pressed on whether he even has $2 billion in the bank, he said, we are financially stable. Are we just supposed to trust that? I mean, at least with Coinbase, we know they have $5 billion in the bank, John. We know none of that. Maybe that's the only thing we do know, that we don't know anything.
He's in a tricky position, right? Because, yeah, there are a lot of auditors who don't want to touch this with a 10-foot pole, Carl. I mean, what's the upside to pitting your reputation to signing off on crypto firm stability now, right? Why not wait until halfway through 2023 and see how this shakes out? Do you really need that contract right now? But at the same time, that sends a message to everybody in crypto who's invested. Hey, got to be careful on the regulatory side. You got to be careful on the balance sheet side and the the faith in the crypto market side for those exchanges that do need people to believe and perhaps don't have those reserves as much as we would hope.
Mm-hmm.
Yep. I would love to see what some of the audit firms think about the fact that the argument that they are unable to evaluate some of these companies. One thing we know for sure is that Kathy Woods Ark did buy more coin last night, almost 300,000 shares, Dee.
I mean, auditing should be straightforward. They need to see what they have in the bank and do it just like they are able to in terms of Coinbase. And also, guys, we've been hearing from major players in the cryptocurrency industry that audits are possible, like Tether over a year and a half ago now told me that they were months away from an audit, and that has never materialized. So, a lot of questions still remain. It's not surprising, perhaps, though, that auditors don't want to touch it, but you got to ask why.
Yeah. Coming up after the break this morning, Elon Musk selling another huge chunk of Tesla. Despite that, Oppenheimer does name Tesla a top pick, saying the stock can get back to $400 a share. We're going to check in with that analyst when we're back in 2 minutes.
On Peacock.
I'm Christina Partsinevelos, and here's your CNBC News update at this hour. A number of economic reports raising recession concerns and pressuring stocks this morning. We've got retail sales that reversed last month's rise and fell 0.6%. The drop in part due to lower car sales, lower auto production also drove a surprise drop in industrial production just last month. Two regional reports are also showing manufacturing activity is contracting. The Federal Reserve surveys from New York and Philadelphia posting weak numbers for both orders and shipments. And then the labor market is still showing signs of strength. Weekly jobless claims fell unexpectedly to 211,000, the lowest level in nearly 3 months. In Europe, central banks are following the Federal Reserve's lead and raising rates. The European Central Bank and the Bank of England both hiked interest rates by 0.5 percentage point. The ECB also said it expects to raise rates significantly higher because inflation remains far too high. John?
Christina, thank you. The largest tech companies continue to be in the thick of today's sell-off. Steve Kovac has a beat check on some of the morning's hardest hit names. Steve?
Yeah, John, shares of the 5 mega cap tech names falling with the rest of the market this morning, with losses increasing a bit later. Apple shares down about 3.5% this week. Bloomberg reported Apple is working to allow those third-party app stores on the iPhone in compliance with the new law in the EU that'll go into effect in 2024. If more countries impose similar regulations, Apple's lucrative app store business could be at risk. Over to Microsoft now, shares off 3%. Just last week, FTC sued Microsoft in an attempt to block its $69 billion acquisition of the video game publisher Activision. That deal could take longer to close than Microsoft's target of June of 23. Meanwhile, Amazon is down as well, off about 4%. But it's the two names relying on the digital ad market that are getting hit the worst so far today. Meta and Alphabet are both off more than 4%. Perhaps a sign investors are more worried about the ad-supported social media companies within this group. Deirdre, I'm going to send it back over to you.
Steve, thanks very much. We're going to stick with the sell-off, and joining us now on the phone, Satori Funds, Dan Niles. Dan, I know that you are up on the year. You've been calling a lot of this. Where do we stand right now with the NASDAQ down nearly 3%?
Yeah, unfortunately, I think with the, and we put out a tweet on this yesterday in front of the Fed, our feeling was get out of the way of that. And then when we saw the ECB this morning and their statements, and, we put out a tweet on that, but the thing that struck us was the sentence of, quote, we should expect to raise interest rates at a 50 basis point pace for a period of time. And then later on saying we have longer to go and we are in for a long game. And so I think, you combine that with some of the fundamental news we got this morning, and more importantly, how the stocks are reacting to it. So Netflix, and the story out that they're returning ad dollars to advertisers because they're just not getting the viewership that they expected, and obviously that stock is flipped.
Dan, I think we're having some audio issues, so we're going to get that sorted out and come back to you. We're going to go to a quick break right now, and up next, we've got exclusive results. We're going to stay here, actually, guys. Carl, as we noted, the S&P breaking that 3,900 level. I heard Art Cashin tell you earlier this morning that was a key one to watch. We could expect more heavier losses if we do break that.
Yep, definitely in line with what Dan was saying, and we'll work out the audio in a moment. But the commentary out of Europe and the ECB, the notion that the market is underestimating their resolve. At the time we talked to Art a few moments ago, guys, we were above 3,900. He did warn about breaking that level. Also, John, NDX below the 50-day for the first time since pretty much November 10th is getting some attention. Also, the idea, John, that there's few places to hide. We've talked about the ad market, financials getting hit on some of these credit card delinquencies, semis obviously challenged on some research, travel downgrades. There's a lot.
There's a lot. And there's a real economy underlying all of this, which I think is so important to remember. And sometimes we see that reflected not only in things like the retail sales report that we got today for November, but also in some of these earnings reports. And into it was really interesting to hear about Credit Karma being hit because some of the loan issuers out there, the credit card companies, are less willing to deal with that kind of subprime market. You line that up with the fact that consumer credit, people are feeling more stretched and their savings are getting extended. And then you look at what's happening in consumption. Roblox, again, down more than 15% this morning because the bookings aren't holding up, D. And so when you look through all of that, and we're in that stretch 10 days before Christmas where the consumer needs to show up, and there are all these signs of fatigue across physical and digital, you got to question what that means for positioning heading into 23. And again, we're going to get A little bit more data, I think, from Adobe out of earnings today. Big picture on ad spending, on the health of e-commerce, and perhaps whether that continued after that big launch week after Thanksgiving. But that, to me, underlying is what a lot of this is about.
Yeah, and Adobe is so important, as it has been all year, because it is a late reporter in the earnings season. Things moving so quickly this year. I think we've got Dan Niles back with us and hopefully fix the audio issues. Dan, John's been talking about sort of the consumer side of this picture, but I know looking into next year, you think that enterprise could be the next shoe to drop.
Yeah, absolutely. Because, you know, John's right. I mean, you got to go back 3 years, right? So COVID hits, everybody gets on the internet. They have to get their businesses on. So they buy a lot of enterprise software, hardware, services, everything they need. And you're sitting at home, you're buying all these consumer goods. And as John talked about now, you're seeing the give back from that, right? Consumer demand's falling off because what are people doing? Well, now they can go out. So they're going to restaurants, hotels, vacation, doing all of this stuff. And so their revenge spending on these experiences, they bought all the goods they needed. They bought the smartphones, the PCs, and the, you know, Peloton bikes, etc. And so what you're going to see going into 2023 is now, as all of these companies are setting their budgets for 2023, they're saying, well, we're going to have less employees. We need less software to support them, less hardware to support them, less cloud services because we don't have as many people using it. And when companies report the fourth quarter and guide for 2023, that's when things are going to start to get ugly, because the enterprise companies is where all the high multiples are. The high multiples aren't sitting in the PC vendors like HP or, you know, Dell. They're sitting with all the software vendors where people have somehow made this mistaken assumption that they're immune. And now they're getting a wake-up call that, you know what, growth at Salesforce slowed. You're going to see it across the board. Those guys are the bellwethers and the ones you need to pay attention to.
Hey, Dan, why do you think, I mean, we've been treated with analogs all year long, charts that look at S&P performance after CPI peaks, charts of S&P performance after the Fed pauses, two things which we think we're getting. And I wonder why you think the market doesn't feel like it's going to agree with a lot of those analogs.
Because people are looking at the wrong analogs. They're not looking at the analogs from the 1970s. That's what you need to look at, because the last 50 years looking at any of that data after 1980 is irrelevant. 1970s is when you had high inflation. And if you go back and you look at that, you needed rates coming down before the market bottomed in, I think, 1982. They were coming down for like a year. And the reason is you've got high inflation that you need to kill off. And the problem is that you've got 4 million more job openings at about 10.3 million against people unemployed at 6 million. And everybody's so busy focused on the layoffs at the wrong company. You take all of the publicly traded companies in the United States together, and they're less than 25% of all jobs in the United States. Those jobs are sitting at small and medium business. And the thing is, we're all going out and consuming all of that stuff. We're going to hotels and restaurants and pizzas and, you know, movies, etc. And it's going to take a much harder recession to kill off the jobs in the small and medium business sector. And that's what's driving inflation. So that's why all of those analogs that you have people coming on talking about just don't make any sense, because those were in periods of low to declining inflation. You're dealing with really high inflation, which you've got a decade's worth of data, but nobody wants to look at it because for obvious reasons, it's depressing, right? You've had PE multiples go from 20 times to 12 times on a trailing basis on the S&P. You had high inflation. You had Volcker, who didn't want to raise rates to where he did. People forget, he cut rates, and then he was forced to raise them again.
Yep.
And he didn't want to do that.
Think,
nobody wants to be the bad guy.
So do you think that, you know, Morgan Stanley, JP Morgan calls for S&P 3K to 3,300? Is that a legitimate reset? Or do you think that could it be more dramatic than that? Should it be more dramatic than that?
Well, you got to remember, Carl, we came into this year saying we thought the S&P would be down at least 20%. So we were pretty early on this when the market was hitting all-time record highs. And then in May, we said down 30 to 50% is what we revised it to in May. And down 50 is about 2,400 on the S&P. 2,400. Now, by the way, that's not that aggressive downside. And the reason I say that is if you say, well, during a normal recession, you have 20% reduction in EPS estimates. So EPS peaked for the S&P 500 at 250 in July, down to 235. I think it goes to 200. And then you say, well, if CPI is over 5%, the trailing PE multiple on the market over 70 years worth of data is at 12 times. So you do 12 times 200 in earnings, that gets you to 2,400, which is where we get the down 50% from its peak. So, that's why we, it could definitely undercut that, but 3,000 is sort of the estimate we've had since May.
So cash here then, I mean, I'll note we're down about 750 on the Dow right now. On the S&P, we are right about at that level that Art Cashin was talking about last hour to watch for the close, 3,900, maybe a little bit below that. The way things are moving, we are a little bit below that. Is it worth staying long here for some folks who, for that 10% upside, when you see potentially 20% or more downside from here? I know you've had you've done a long short thing throughout the year, biased toward short, but expecting post earnings October earnings pop, which we got. Is this enough?
Yeah, I mean, it's a complicated answer to your question, John, but here's the thing, and you touched on this earlier, right? Netflix, or I think you touched on Netflix, they had to return money because they weren't getting the viewership necessary. That's a fundamental data point, stocks down 7%. Roblox not hitting its numbers, for the bookings for the quarter, obviously stock's already gotten crushed. It's down 17% on top of the beating it's already taken. So the fundamentals are poor. They're going to get worse. I think you're going to see a wave of pre-announcements. Apple, I'm waiting for them at the end of the quarter or early next year. They've pretty much told you their numbers are too high. And that thing's sitting at a 23 PE and the S&P's at 18. So you combine earnings going down with multiples still really high, and you don't want to try to pick up pennies in front of a steamroller. And so that's what I would tell you going into the end of the quarter, because now you've got to fess up. You've got to actually report your numbers and tell people how you're doing, and the rubber hits the road. That's not, I think, going to go well. And looking at how stocks are reacting, it's not like Roblox is up today, right?
Yeah.
It's not like Netflix is up today. So that tells you there's still a lot more downside.
Yeah, Dan, I don't think you're alone in terms of thinking that earnings expectations are still too high. Dan Niles, always great to get your insights. Thank you. We'll talk to you soon. Coming up next, exclusive results from the CNBC Technology Executive Council survey. We are back in just 60 seconds.
As part of the CNBC Technology Executive Council survey, we asked executives, including CIOs and CTOs, about how they plan to make their companies stronger with mass layoffs on the horizon. Frank Holland has some of those results, joins us now. Frank?
I do, John. Layoffs in the broader economy on the minds of these tech leaders, as you mentioned, CTOs and CIOs, and more than a third say that right now, today, we're in a recession. We're going to show you the numbers in just a second. Another third believe we could just be days away forecasting a recession in the first half of 2023. And then we see 13% right over here, optimistic. They're saying there is no sign of a recession on the horizon. Our survey of CIOs and CTOs, it began on November 18th. We were in the middle of a wave of layoffs in major tech companies, an estimated 50,000 in November alone, with some signs that more layoffs could be on the horizon. So it was in that environment that 57% of tech leaders in our survey believe that the layoffs, they're actually an opportunity for their company to bring in top-level talent, while 35% said they expected to face issues keeping their top-level talent due to those same layoffs and job cuts. Only 9% believe their company would not be impacted at all. Another snapshot of the job market, 43% said finding qualified talent was just about as difficult, just about as easy as it was in the same time period in 2021. 35% saying it was actually more difficult. Only 12% said it was actually easier. These tech leaders still seeing a tight market for labor. And while companies are searching for talent, they're also looking to spend more on new technology. Over the next 12 months, nearly 3/4 say they're going to spend more on new tech. That's new hardware and software, with just under 1/4 saying they're going to spend just the same. So the spending continues. In this survey, it actually raises some questions about the IT spending slowdown we're hearing so many companies talking about, John.
Yeah. Then again, last month feels like a year ago. Greg Holland, thank you.
Thank you, John.
Tesla, meanwhile, is one of the few stocks in the green in the NASDAQ 100 today, now about flat. That's after news last night that Elon Musk sold another 22 million shares worth north of $3 billion. That stock having a rough run now, down 55% this year and 30% since Musk's Twitter deal closed. Of course, investors concerned with Twitter's impact on Tesla shares, alongside other challenges, including macro headwinds. Joining us now, Full Cycle founder and managing partner Ibrahim Al-Husseini, who was an early Tesla investor, and Oppenheimer analyst Colin Rush, who just named Tesla a top pick for 2023. Welcome to both of you. Ibrahim, start with you. How much of a concern is this Tesla selling, you think, especially that it's paired up against Twitter, which is in such a different industry and in such need of capital?
Hi, John. Good to be back. Good to see you. So Tesla's a brand, right? And that brand is being tarnished on the daily because of Musk's behavior publicly on Twitter. You buy cars, I buy cars. We know that a car is a cornerstone of a consumer's identity, at least for a large subset of consumers. Traditionally, Tesla has said, I am a, technology forward, environmentally conscious global citizen. And that is no longer the case. Now it is a confused brand where it is, that brand is associated with a founder that attacks Fauci. He, promotes characters that are anti-Semitic, and it really has turned off a lot of the buyers. I mean, right now, I remember when we used to talk about how proud we were of owning a Tesla, and now if you look at social media, the biggest thing you see are people taking screenshots of them canceling their order. So the brand is tarnished.
So, Colin, some of the bulls like to say that the fundamentals haven't actually changed all that much given his distraction with Twitter. But what Brahim just laid out there, the brand, that feels pretty fundamental.
I agree with it. It's a real concern, and it's happening in real time right now. What we've been looking at is on the technology side, where Tesla continues to strut out in front of competitors, and I think is being underappreciated for the innovation that they've done within the EV space and the material space. But the brand issue and the long-term impact of that is a legitimate concern. And beyond that, the debt load that you guys were talking about earlier from Twitter impacting, Tesla shares because of the selling is a concern, right? And as we start to get a little bit more clarity on that, we think there's some support for Tesla. But from a fundamental perspective on the technology side, we feel very good about this. But the premium that Tesla's gotten in the market from a pricing perspective is potentially at risk. And so one thing we haven't seen the company do is spend aggressively on marketing. And at the point that we start to see that, that could be a real signal for the challenges on the sell-through for the vehicles.
Brahim, I wonder if you think that perhaps people are reading too much into what's happening at Twitter. I mean, when you look at Tesla, yes, it has fallen significantly over the last few months, but really it's come in line with the rest of FANG and big tech losses over the last year and a half.
Yes, except that its PE ratio is trading even after a 58% drop in the price of the stock. It's still trading at a 50 times multiple on its PE, while Alphabet is in the mid-20s, GM is in, I think, something like in the single digits. So I think the days of Elon Musk performing for his vast retail stockholder base is behind us, because that's what he's been doing for a long time. Because Tesla uniquely has something like a 42, I wrote that, like 42% of their stock is held by retail investors. And while Alphabet right here is that, retail investors are at 18%. So he can get away with things, at least he used to be able to get away with things based on who is holding the Tesla stock. But I think those days are over, because he, as a market mover, has lost a lot of credibility. And remember, a lot of those retail investors only entered the investment space in the last 14 years, where all we've ever seen is just growth, growth, growth. This is the first time they've ever been confronted with a recession. We've lived through many of these, and this is when you actually know yourself as an investor or not. It's through these hard times, not when the market goes up for 14 years straight.
So, Colin, is Tesla a best idea, a good idea with an asterisk, then, just sort of as long as Elon Musk stops doing some of the brand damaging things that he was doing and starts focusing on the fundamentals, kind of like Zuckerberg with Meta? As long as he stops spending so much on the metaverse, the core business is actually doing pretty well.
So I'm going to disagree with some of the fundamental, multiple commentary here. Tesla's earnings power is actually fairly impressive when you look at the potential growth for this company. As you look at the company executing against a 50% growth metric, getting an enormous amount of operating leverage off the platform, we see the company earning $18 to $20 as they reach 5 million vehicles a year. Now, with a growth metric that they've talked about as their target, that's 2026. And so from a multiple perspective, we're not concerned so much around at these levels, especially that the multiple is too high. What we're worried about is that there's larger backlash around Musk and his behavior. And so, yeah, I think there's a point around Musk doing damage to the Tesla brand. But from an earnings power perspective, we think there's actually a lot of upside here from the current estimates out on the street.
Yeah, and how much does all of that, though, affect those growth projections for 26, given we're going to have some kind of a landing, hard or soft, we'll see. Anyway, Ibrahim, Colin, thank you.
Thanks, John. Good to see you.
Tesla definitely one of the rare bright spots today, because look at the tape. NASDAQ down almost, better than 3%. And you can see we have definitely lost 3,900 S&P. We'll be right back.
CFO.
Let's get a check on the markets. The major averages deep in the red right now. We got the Dow down more than 800 points, which translates into nearly 2.5%. The S&P down below a key 3,900 level, also down more than 2.5%. And the NASDAQ faring worse of all, down more than 3%. And with that, let's get to chips. We got a pair of analysts out with their top ideas in semiconductors for 2023. Cowen picking NVIDIA. Morgan Stanley bullish on AMD. Let's bring in Cowen's Matt Ramsey and Morgan Stanley's Joseph Moore. Welcome to both of you. Matt, start with NVIDIA. So your price target on this 220 would have it up 30% from here. Does that factor in a recession of some sort, or do you think NVIDIA is immune?
Hey, John, thanks for having me on. Joe, good to see you. We definitely named NVIDIA as our top pick. I know Joe's going to talk a bit about AMD as well, which is kind of second in our pecking order of stock picks for 2023. And we factored in a lot of things in our analysis, John. The fact that the market in Russia is now a zero for a lot of these companies, some turbulence in China, the fact that crypto is sort of permanently gone from the revenue streams, some inventory corrections in gaming. And they've felt a lot of the pain in NVIDIA already, and what's around the corner are product cycles in their biggest businesses. NVIDIA is the AI computing company across all vertical industries and in the cloud. A brand new Hopper product cycle with significantly higher prices, a new gaming product called Ada Lovelace, which is our new gaming GPU. As the channel clears through their January quarter, I think we're going to see a pretty big rebound in their gaming business, and a huge investment for the company in autonomous driving chips and simulation in the data center that's just now starting to come into revenue. So we factored a lot of those things in, but it's a good year coming ahead.
So then, Joseph, when it comes to AMD, is your argument that their either PC exposure is not so extreme that the consumer slowdown is going to significantly hit them, or do you think the holiday season is going well enough that there won't be a significant inventory overhang that's going to haunt them into the new year?
Yeah, look, I think there's some near-term risk for AMD and for most of these stocks in semiconductors. You know, this is in the context of a relatively cautious industry preview. But I would say that the two stocks we're talking about here are two stocks where I feel best about achieving consensus numbers next year. The PC market is meaningfully de-risked. Their business, AMD's business, is down close to 60% in client. I think that's enough to burn off inventory and get a recovery next year, even though the full year number is down. And then data center is weak in the near term as well. So I think there's some risk around that in the short term. But I feel good about next year's targets. You're looking at very strong share gains. You're looking at a cloud market that, while there are cuts, AMD taking a higher percentage of that. And I think with enduring strength in those markets. And this is the worst performing large cap semiconductor stock in 2022. So I think they've executed very well. Their competitor has stumbled on the server side. So I would say, you need to be using this period of weakness to build positions, especially relative to this group.
Matt, I wonder, a lot of the negative commentary that we get about the space overall is that the weakness in, say, phones is not going to be offset by any acceleration or channel clearing in gaming or certainly in autos. I wonder if you think that's fair.
I mean, the group overall, one thing that I've noticed over the last year or so as we've gone through some of this pain for the whole semiconductor sector is there's not just one semiconductor cycle. The cycle in PCs and gaming is very different than the cycle in memory, is very different than the cycle in automotive. And they move at different paces. I think what the two stocks that we're talking about here are ones that went into some of this pain earlier. NVIDIA with the collapse of crypto computing and some things that happened of exclusion from being able to sell their AI products into China. AMD of what happened in the PC market maybe a bit earlier. And as we've talked here, there are catalysts for both companies in terms of average selling prices, in terms of margins, in terms of share gains that are coming into next year. But there's some pretty market-specific things for both NVIDIA and AMD that we're fired up about. Very, very different than what's going on in the smartphone market.
Joseph, we're almost out of time, but just briefly, let me ask you, what kind of recession does your model factor in, and did that change this week with Powell's presser?
Yeah, we're certainly looking for weaker markets next year, right? I have AMD's PC business, for example, down close to 15% for the full year. what's interesting is that implies a significant sequential recovery from the levels of Q4. So, it's not, they're not immune by any means. It's not the trajectory we had a few weeks ago. But I think that, I continue to be optimistic that consensus estimates are achievable, even in a tough economic environment.
Guys, appreciate it very much. Obviously, it is, I would argue, John, definitely one of the hardest spaces to read right now, given the fact that there are so many cycles within a cycle.
Yeah, you got that enterprise consumer split, and you've got what's happening in data center versus what's happening on the client side, and all of it affected by the macro.
Meanwhile, guys, pronounced weakness. And don't forget, tomorrow, $4 trillion in options expiration. Goldman today saying that's going to be the biggest OPEX in 2 years. So you think today's interesting. We'll see what the morning brings. For now, Dow down 800. The judge in the House once again. Let's get to the half.
Carl, thank you very much. And welcome, everybody, to the Halftime Report. I'm Scott Wapner from Post 9 here at the New York Stock Exchange. Front and center this hour, sinking stocks, a more hawkish Fed, escalating recession fears, what all of that means to your money in the months ahead. We discuss and debate that with the investment committee. Joining me for the hour today, Josh Brown, Jason Snipe, and here at Post 9, Jenny Harrington, Bill Baruch along with us today. Let's check the markets. We're just about at the lows of the session. The Dow's giving back 800 points right now, 2 1/3%. S&P's down by 100. That's 2.5%. And boy, look at the NASDAQ down more than 3%. That's a loss of near 340. 345 is the yield on the 10-year note. Jenny, Powell, he was hawkish. The outlook was hawkish. If you're surprised by anything that you heard yesterday or by how the market is reacting now, you haven't been paying attention.
I agree.
Right?
I agree. No, it's totally, completely unsurprising. And this goes to something you asked me last week. Last week you said, do you have conviction between now and year end? I said, no, but I have hope. Right? But there's no conviction. And so.
Well, is hope lost now?
No, because I think we're kind of in the same camp. And this is uninspiring and it's unexciting. But I've said for a while, I think we're going to ultimately reflect back on this and see a long period between June and I don't know now, 6 months from now, 3 months from now, where consolidation has been happening. And so when we say like, oh, is this because of the Fed? Maybe. Maybe it's because we're trading at a 17.5 times multiple on earnings that everyone knows is going to come down. Maybe it's because the consumer's weakening, and I don't think the consumer's super weak, but they're weakening. They're not strengthening. There's a lot that's out there, and we just are in a process of digesting. In fact, Bill and I were talking about this earlier. We're still digesting the fact that the market was up 16.5% on an annualized basis for a decade. That's a lot of excess, and you know what? We're not having helicopter dumps of money anymore. Money is coming out. Interest rates are going up. There's a lot of weight on this market. So am I terribly bearish? No. Am I bullish? Not at all. Do I think you can make money in this environment? Yes. But it's uninspiring
Boy, it's
at
going to be much
best.
more difficult. I'll tell you that.
For
If you
sure.
keep Bill having days like this, does this sort of kiss the year-end rally goodbye?
I don't think it puts goodbye, but here's the glass half full look at yesterday too, is I think Powell deliberately didn't try to be as Jackson Hole Powell. He didn't try to really kind of slam the market down. So I think that was a positive. And the odds of rate hikes moving forward are only looking at 25 basis points in February and another 25 basis points in March. So that's the glass half full.
Well, that's what the market, that's the market view, right? We do have the market and the Fed at odds, and you have the disconnect, which you suggest. The question is, who's going to be right? Yeah. Some say the market is going to be right, that the Fed is going to have to come back and meet the market because it's not going to be able to do all that it says because the economy, as we learned yet again today, is weakening, perhaps more than people thought that it would, at a pace faster than they thought it might.
Well, let's talk about the elephant in the room that no one's really saying is the China data last night was absolutely awful. Everybody expected bad China data last night because they were locked down for all of November. On the plus side, though, you look at that being the catalyst here today and sort of who wants to step in and be a buyer to catch a falling knife in the day. So maybe we kind of move past today, Christmas rally, good finish to the year, still potentially there. And you know what? The People's Bank of China meets next week. So there's some development geopolitically there.
I just wonder, Josh, if Powell and company, they took the eggnog that we were thinking about drinking between now and the end of the year and they dumped it on our heads. That, the rhetoric, as I said, was hawkish. The outlook was much more hawkish than some had looked for. The terminal rate to 5.1, obviously, 17 of 19 see it over 5%. He's been hawkish. He's been consistent. He's told you what's coming, and then you do have those, whether it's, Tom Lee or our own Jim Lebenthal, who perhaps refuse to believe what lies ahead. What do you say to that?
The Fed is getting its way all over the place. If you were to substitute more recent shelter data, specifically rents, for the extraordinarily lagged data that is going into the Fed's calculations, they are very much going to continue to get their way in January, February, and March. We're looking at the next CPI report, most likely with a 6 handle, and that is most likely going to continue to fall from there. The question is, how fast will it continue to fall? And I know that sounds crazy. We've been like, oh, it's so stubbornly high, forget about it. You just got U.S. retail sales in November down 0.6. That was supposed to be down 0.1. The consumer has gotten the message. They have stopped spending in a lot of categories on a dime. The housing market is frozen. There is nothing going on there. Don't tell me that the Fed isn't making progress on inflation. After talking to mortgage people, realtors, forget it. It's over. And housing has a huge multiplier effect. It could be as high as 18% of the economy. What we saw in the inflation data Tuesday, CPI, medical costs are falling, airline ticket prices are falling, gasoline is down month after month after month, or even electricity costs have fallen. So the Fed is getting their way, but they have to keep talking this way, regardless of what the 10-year is doing, which is laughing in their faces. They have to keep talking this way, because the worst risk is that we take a pause, and then because people let down their guard, financial conditions start to ease a little bit, and then all of a sudden they have to come back with another 50, another 75.
Right?
You don't want that.
They already have.
You don't want
Since
that.
the last hike, the financial conditions have been easing, right? And that's been one of the issues. Everything that you said, Josh, of course, is correct in terms of the direction of inflation, yet they're not satisfied. Why? Because they're willing, it sounds like, and it certainly seems like, they're willing to have a recession. They essentially want to put the economy in a chokehold and hope that it taps out without being carried out on a stretcher. That's what Powell's hope is. Why? Because he needs the economy to tap out.
He could say whatever he wants. He could say whatever he wants. He cannot continue to raise with the 2-year, 5-year, and 10-year falling at the pace they are. The dollar has peaked. Rates have peaked. The Fed can say whatever they want, and they should continue to deliver this message. But the concern in the market, and rightfully so, is now shifting toward recession and away from inflation. And everybody knows it. And all of the data is screaming that message. And I'm going to tell you, a lot of the economy already is in recession, in addition to what I just talked about with housing. And I think the rolling recession call, which I think is Citigroup, is going to be the right one, because we're already living through it. It's not a prediction. It's actually happening. A rolling recession is interesting. It's not as coordinated as you would like it to be, like in COVID, where we actually could pinpoint the start of the recession to a specific day in March. This is trickier, but a rolling recession is what is currently occurring. It's undeniable in certain sectors, and if it hasn't gotten to your sector, give it a beat. And in that environment, I have to believe that the Fed is going to look around and say, okay, our job's not done, higher for longer, et cetera, et cetera. But it's going to be more bark than bite from this point forward.
I mean, that's not necessarily, Jason, what Wall Street sees. Goldman sees 3 more hikes coming, 3 additional 25 basis point rate hikes, February, March, and May. Deutsche Bank, 17 hawks, 2 turtle doves, and a 5.1 terminal rate is the headline for them. They've got a forecast of 5.1.
That was
cute. By May. So they see many more hikes as well. Right. I mean, the Fed chair, Jason, keeps telling you what's coming. Some don't believe it, but he's living up to the hype thus far.
There's no doubt about it, Scott. And obviously, the Fed has already moved 425 basis points this year, right? The terminal rate, to your point, is above 5% now. What I heard from the commentary in the presser the other day is he's obviously focused on labor. The labor participation rate has not moved at all. There is a structural issue with labor on the supply side, and that will continue to press and move wage inflation, right, which could be a precursor to more inflation. So clearly they're still focused on raising and hiking into the new year, but they've done a lot already. And to Josh's point, you see it, it's working. With the retail numbers we saw this morning, manufacturing negative, Philly Fed was a miss. So the work they're doing is missing, and there's a lag effect in labor. So let's see what happens going into next year. But to Josh's point as well, I think they have to continue to bark and talk the way that they're talking, but they might shift gears, going into Q2 and to Q3 of next year.
Yeah, well, that's a long way away. And there are those who suggest that recession now is all but inevitable, including Jeffrey Gundlach, who I spoke with yesterday, obviously got his first reaction to what happened. He says there's a 75% chance of a recession. Listen.
Yields are down very substantially. I'm surprised people don't really talk about this. I mean, the long bond yield is down something like 90 basis points. The 10-year treasury yield is down 75 basis points. And even the 2-year treasury yield is down 50 basis points. And we're at these levels that suggest that recession is coming.
I mean, it's not just those levels, perhaps. Josh referenced the retail sales report. Philly Fed, worse. Empire State, negative. Industrial production declines. Business inventories miss. The data is deteriorating and confirming what the Gundlach perspective sees.
I think that's right. I think one thing that Josh kind of misframed, though, is the increased focus on recession. We've been talking about this for the entire year. 9 months ago, my mom, who I'm sure she's watching, so sorry, Mom, I didn't know she knew what the word recession meant. 9 months ago, my mom asked me what to do with her portfolio if we have a recession. As Ed Yardeni says, and Ed's the one who I think initially coined the rolling recessions, as Ed Yardeni said, if and when we have a recession, it'll be the most highly anticipated recession we've ever had. So we need to hear what Gundlach says, and who knows if it's 75% odds or 60% odds. Every strategist has a different odds on it. We need to hear that, but we also need to acknowledge the fact that some enormous amount of this information is anticipated.
I know, but
and
there are
is
some who
priced
still make
in.
the case, Jenny, on this very desk who don't think we're going to have a recession. If Jim Lebenthal were sitting to your left instead of Bill Baruch, he would be making the case that we're not going to have a recession,
And
that
you
the
know
Fed's
what?
going to stop, they're going to pause, and that's going to be bullish. Well, Powell gave you the perspective yesterday that pausing alone's not bullish. Why? Because they're going to keep rates higher for longer.
But here's the thing. One thing, I was listening to a really interesting Goldman Sachs commodity call yesterday. Goldman was saying, whoever the strategist on that was saying.
It was Jeffrey Curry.
Oh, exactly. And he was saying, hey, we may not have a recession. They were even in there may not be a recession, or it may be small and mild. And then we need to take all that, Scott, and say, what's it going to look like? How long is it going to be? How severe is it going to be? Is the work of these rolling recessions, is that super functional? And will it then moderate the broad-based GDP recession if and when it happens? But here's the thing. It doesn't really matter if Jim's right or Gundlach is right.
Well, it matters. Yes, it does. To people who are taking their advice, it matters a lot. It matters a lot.
But you can still make money.
Matters a lot.
And I'll throw Jim
You
a
can lose
bone.
a lot of money if you get it wrong. If
I'll throw
listen
Jim
to
a
the
bone here.
person who is not paying perhaps as close attention to what's actually happening, you can get hurt.
But that's when you really need to consider the time frame. And if you're Jim or if you're me and you manage money for people and your time frame is 3 or 5 years, that's where I get into it doesn't really matter who's right, because if the portfolio is constructed properly and it's constructed with the right asset allocation and the right strategy, then you don't need to worry about getting in and out at the right
No, but
time.
the problem, Bill, with that is that, we collectively as investors have lived on the idea of the 60-40 portfolio. To Jenny's point, if your portfolio is, in her words, constructed correctly, well, that has meant for decades 60-40, and that has been called into question over the last 18 months as well. So what is the playbook then going forward if you think a recession is 75% likely like Gundlach does?
I'll say today what we're seeing with this market sell-off, rates are responding. Rates are actually coming down on this move. Treasuries are trading higher. I think that's a positive coming out of all this Fed speak, ECB, Bank of England, all of that today and all these rate hikes. If the rate market, if we were seeing rates higher, then I'd be concerned. But also I look back to last year and I thought the consumer, even though they sort of eroded through November and December, they came back strong in January and February. What's to say we won't see a stronger consumer in the first quarter of this year? And what we're seeing right now is a slowdown due to all the tightening that's happened. So just like the Fed has said, the cumulative tightening that has happened, they're going to have to wait and see, let it marinate.
Why would we see a stronger consumer in the first quarter of the year if we already know that the tremendous amount of stimulus and the savings is being spent, that credit usage is going up, that the consumer's not stupid either, okay? Give the consumer more credit in seeing the kind of data that we're talking about. Why did retail sales fall? What do they hear about? Manufacturing is getting weaker, production's getting
pulled
weaker.
forward demand.
All of the different economic metrics.
Judge,
Josh?
The Californians, who are hilarious, actually did a stimulus payment to offset the inflation. And I'll give you a second to finish laughing at that. In addition, Amazon Prime Day, what that did was it pulled forward retail sales into the calendar month of October. And actually, there was no revision to October in the retail sales data we got at 8:30 this morning. So that stayed at plus 1.3%. That's probably your last good month for consumers. And if they didn't come back out in November shopping, which we know they did not, and if you look at the categories, a lot of Christmas categories, like consumer electronics, were down pretty big. They ain't coming back in December or in January, especially year over year. You look at these holiday sales numbers versus 21, and you're going to know there's not going to be a resurgence for the consumer.
So, Bill, I look at what you're buying. I asked for, in essence, a recession playbook, if you believe that we're going to have one. And you're buying industrials, cyclicals. You bought Deere, right? Yep. You bought Oxy. Now, you're obviously highly levered to energy, so I get that. And that's a Buffett play, and people like it for that reason, among some others. But do you not think there's going to be a recession?
I think we're going to be a softer landing. I think that's what we're looking for. I'll address Deere. I mean, the relative strength we've seen Deere across any asset, across any sector, has been tremendous. It's really about to break out. We see a little pullback today from a technical basis, filling a little gap. But their niche, I think the company has performed extremely well in this year, despite the fall in agriculture prices in recent months. I think Deere is set to perform. Oxy, more of a trading vehicle for me. Rotated some cash out of Pioneer. Sorry, not Pioneer, but PSX, Phillips 66, as refinery margins have come in. Rotating that cash into Oxy is a bit of a trade as crude oil came into $70.
All right, let's bring in our halftime headliner now. Find out what Chris Heisey sees. He's the Chief Investment Officer at Merrill and Bank of America Private Bank. Chris, welcome back. It's good to have you on the halftime report.
Hey, thanks a lot, Scott.
I think what jumps out to me the most is the discrepancy between you and the chief market strategist of Bank of America, Savita Subramanian, who says her target for 2023 is 3,900 to 4,000 on the S&P. You're the Merrill and Bank of America Private Bank CIO. You're 4,300 to 4,400? Is that right? Why the discrepancy there?
Well, actually, the 4,300 to 4,400 is basically a blow off. It's well above the 3,900 note that we actually totally agree with Savita on in terms of what the markets are trying to get to. We're going to close the year somewhere around that, maybe a little higher than that. Well, actually, we think that 4,300 level is just upside to what the current view is overall in a more, what I say, a little bit more bullish scenario. So I wouldn't pay too much attention to levels. Rather, the theme for next year is the fact that the foundational element of what was just discussed a few minutes ago in terms of 60-40, a diversified portfolio, we're back to a foundational year. And we had a 100-year terrible year with stocks and bonds. So perhaps it's not a very bullish thing to say that 60-40 is resurrected, but that's our foundational year for next year.
So in terms of the discrepancy between where the market is and where Powell is suggesting they're taking the terminal rate, who do you believe? Who are you betting with?
Well, actually both. I mean, we have to take the Fed's word for what it is by saying this is where we want to get it to. They're trying to talk down inflation the best they can. They're very worried about wage growth, the stickiness of that. They're worried about the employment market not coming down to levels that would suggest inflation is going to ultimately peak. But all we have to do is take a look at some of the inflation gauges and the components thereof, and we can see that inflation is coming down sharply. Matter of fact, the biggest surprise, at least for us next year, is the fact that it will come down a lot quicker and sharper than any expect. And the second surprise, even if they take it to the terminal rate of, say, 5.25, which the economists at B of A Global Research believes as well, they're going to have to back that off pretty quickly. The market is expecting 100 basis point cuts in 24 and potentially 25. That could actually get pulled a lot farther forward, closer to mid, dare we say, the second half of 23, which ultimately becomes a tailwind for equities in our opinion.
So you are then decidedly in the camp that the Fed is more from here forward, all talk, little action.
Well, I think they're going to act. It's pretty clear that they want to take this to 5.25 into March end. Unfortunately, they have been saying, to your point, that they're going to stay on a pause for longer. The data will likely showcase to them that they can't. It's very difficult to create a so-called soft landing. Now, this time is slightly different. Consumers are a lot healthier going into this recession. Corporation average debt on their balance sheet is almost double what it typically is. So they've done the right thing in their capital structure. So could they smooth out this recession versus the pre-pandemic ones? Yes. But unfortunately, housing means a lot to this economy. Goods-based manufacturing means a lot to this economy, and so is the world. So the data is going to start to go against them a little quicker. And I think Jeffrey Gundlach said it correct yesterday, where yields have come down. They're telling us that this could actually be a little bit harder landing than what the market is telling.
But wait, I mean, you just said that, but you also said that you see the Fed going to 5 to 5.25. So you can't have it both ways.
Exactly. And I think that's why markets are so confusing right now. That's why data is completely mixed. And the further we get into late cycle, the Fed is following the path of the employment market right now. And they're trying to talk down inflation based upon employment because of where unemployment is. And the window is open for them to raise rates because we're still at so-called 7% inflation, if you will, looking backward. And then they're going to have to toggle pretty quickly, at least in our opinion. That's why when we suggest that bonds outperforming the first half and equities in the second half, very difficult to time that. So we want to be as diversified as we can. We want to be broadly neutral starting the year, so you're not moving in and out all over the place. And selection, Scott, you and this panel knows it better than anybody. Selection is going to matter a lot in 23, much more than what we've seen in recent years.
Chris, we'll leave it there. I appreciate it very much. That's Chris Heisey joining us today. Coming up, Disney's the worst stock in the Dow today. One member of the committee today is making a move on it as well. We reveal the trade, and we'll, of course, debate it. Dow is down by more than 800 points at the moment. S&P 500 down just about 2.5%. Halftime is back in 2 minutes. All right, welcome back to the halftime report. Disney is the worst performing stock in the Dow today, on pace for its worst year since 1974. However, Bill Baruch is a buyer. Okay, so you bought it 2 days ago,
Yes.
right?
Yep.
It's a new position for you.
It is.
It comes on the same day now, today, that JP Morgan says it's a top pick. However, Cowen, did you see that note today? I saw it. I'm going to quote from it for those who haven't. The Fox deal doubled Disney's invested capital and was a significant strategic error that cannot be undone. That's pretty scathing.
They went deeper. They got harsh on that. And you know what, though? It's Fox. Nobody likes the Fox deal.
It's also 4 years old.
Yes. Well, here's the thing. Disney is the ultimate storytelling brand, and Iger's return is just within that narrative. And we're already seeing that story being told with JP Morgan making its top pick in 2023. Now, this was also a rotation for me because I owned Netflix. I sold Netflix against gap resistance. Netflix is a more expensive company with a 34 forward PE. Disney cheaper at a 24 forward PE.
Well, we'll get to Netflix in a second too. But look at that.
It's down twice as much.
Let's stay on the Disney story.
Yeah. But their free cash flow is set to accelerate significantly in the coming years. So I like that. And then they also have the revenue growth. So I think it's a really good story here right now. Plus, I'm at heart a technical guy, and there's a beautiful technical pattern that's building out there too.
Okay. Josh, I'm curious, what do you see when you look at the technicals and you respect them, I know. What do you see when you take a look at Disney?
It's most likely going to have to challenge that 89, 90 level and will probably fail. But I mean, let me put it to you this way. If you're an investor, throw the technicals out, because what you're looking for, if you're a long-term investor, you believe that there'll be cash flow growth, there'll be earnings growth, there'll be dividends, buybacks, then you want the price lower. It's two entirely separate disciplines. If you're trading, I just don't see, it's like a falling knife strategy, I guess. I don't really know. I would wait for it to stabilize, and it just isn't. And there's nothing in here telling me that we've seen the successful retest that we would need to see at that level. By the way, that level is from early November. So we'll see what at 86.75 was your low on November 9th. It took a little while. The stock couldn't break above 100. That looks like the ceiling. So you're buying it here. I guess you're betting the 86.75 will hold, and you want to trade it for 8 or 9% back up to that old high before there's resistance. I suppose it can be done. I don't love the risk reward there.
Jenny, you own it too.
Here's the fundamental side, which is earnings growth is 17%, 29%, and 18% in the next 3 years. Comps are low, earnings have been beaten up. And so as we start to get past this unpopularity, this kind of hate fest that poor Disney's had hanging over it, those are going to be really compelling earnings growth numbers. And you know what? I read an interesting study recently that Ibsen did on popular and unpopular stocks and the popularity premium. This is a stock that this is a company that has the potential, that has the potential to get a popularity premium back. So, Josh, people are going to forget about this year. When they see 17%, 20+% earnings growth, they're going to forget about this, and they're going to start to love Disney again.
They're not going to see that.
We're going to be ahead of that.
They're not going to see that.
Okay.
They're not going to see that. They're not going to see it. Tell me a recession where Disney was a good buy going headlong into it. Name one.
Okay, but here's what I was saying before. A lot of this is already priced in, and that gets into the whole point you were making, Josh, about rolling recessions. Different industries, different stocks have
Travel is next year. The travel recession is next year. The year-over-year comps for Disney
No, Josh,
in the
the
parks
travel
business
recession was 2 years
are going
ago.
to be horrific. No.
Josh, the travel recession was 2 years ago. Look at what predictions are for JetBlue's earnings. I know we'll get to that later. But look at what their predictions are for
JetBlue
next
got
year.
downgraded today, by the way. We'll get to that later. But to Josh's point, is this really a stock on the top of your list if you think we're going to have a recession?
I think this is where the share price has already anticipated a recession, already anticipated a really weak consumer. If you read further into those notes,
51 times trailing.
Times trailing. Josh, they're going to get back in 2 or 3 years to 10 times earnings. If you look at 3 years, 4 years down the road, you've got a stock with $10 of earnings in it. That will put it at 9 times. Let's say it takes some time to get there, but you know better than any. Okay, But again, we have different time frames. I am so happy to sit back and be patient. I am so happy to say, I don't care if we have a recession next year because I think that this stock has already anticipated that. It's the same reason I bought some retail stocks. The share price anticipated terrible scenarios. Not everything moves at the same time. Not everything bottoms at the same time. And this is one that I think is already.
I smell another bet. I'll tell you what.
Okay, I was trying to go there. You make it, but listen, everyone gives me grief because I haven't given you your hamburger yet. That's on you, and you know it. So you make that bet, but you need to let one of us actually close it out.
First of all, it was a cheeseburger, and now it's going to be a double cheeseburger. Okay.
Bring it
and
on.
my favorite burger in New York is Bobby Van's, and it's not on the menu, but they make it for me. So they grind up all the porterhouse from the day before, and they make a great burger.
All right.
No. I will be a buyer of Disney. I will be a buyer of Disney when it breaks that 86.75 level. Okay. I think I'm going to have an opportunity at this thing, low 80s, high 70s. And if I get that opportunity, A, I'm going to pull the trigger. But B, we're going out.
Okay. And so we're going to mark it December 15th, 2023.
Our viewers marked it. We marked it. The chefs at Bobby Van's have marked it. If not, we'll make sure they marked it.
I only go to the Park Avenue location.
All right. Well, we may drag you down here. Wall Street is unveiling their top stock picks for next year. That's been going on now for a couple of weeks. We have more of them coming up next because there's ownership here on the show today. Plus, the investment committee is ready to grade your trade. And now maybe more important than ever, too. Just given how unsettled the market is, a lot of you have been buying some stocks, need some advice on what you've done. We'll answer your questions coming up. You can send an email to us, askhalftime@cnbc.com. You can tweet us. Halftime's back in just 2 minutes.
The Biden administration this week announcing a $3.7 billion investment to bolster the country's carbon dioxide removal industry. Through 4 initiatives, the investment will fund research, develop technologies to capture carbon from the Earth's atmosphere, and push to commercialize carbon management. It's all part of a goal to reach a net zero emissions economy by 2050. That's your ESG Fast Fact of the day.
Rated PG.
Welcome back to the Halftime Report. I'm Christina Parts-Nevelis, and here's your CNBC News update at this hour. The White House announcing plans today to push back against a possible winter wave of COVID infections. The Biden administration says it will offer more free at-home COVID tests and boost vaccination efforts as well. While public health officials don't expect a COVID surge as big as last winter's, cases and deaths have increased since Thanksgiving. As COVID remains a threat, a new report is looking back on information failures from the beginning of the pandemic. A just declassified report from the House Intel Committee says the United States should have spied on Chinese health officials to learn more about COVID and react more quickly. The report also says U.S. intelligence agencies have failed to fix shortcomings and aren't prepared for the next pandemic. And the Senate passed a bill late last night that will bar federal employees from using TikTok on government devices. This bill, which still needs a House vote, comes as states across the country are banning the Chinese-owned video app from state employee devices. Scott, back over to you.
All right, Christina, thank you. That's Christina Parts-Nevelis. Let's throw up shares of Netflix because we alluded to it in our prior conversation with Disney. It is a terrible day for those shares, down some 9%. Jason, you own it. Advertising concerns. It's Netflix today, and maybe some of Disney is wrapped up in that. Snap is down big. Just wanted to bring it up because you must be watching this with a little bit of concern, I'd imagine.
For sure, absolutely, Scott. So I mean, the Netflix story is really them having to return some capital for unforeseen reasons on just advertising. Numbers aren't looking the way they need to look. So they're returning capital, which is never a good thing to see. Now, as it relates to just the broader story, I think their focus on profitability continues to be a positive for them. There's some class flow generation again, and I think they're going to figure out this password sharing issue. So I continue to like the pure play in streaming, and that's why I continue to like Netflix here. But obviously the news this morning is concerning.
Yeah. Let's rip through some of these 2023 picks. They keep coming out, and we do have ownership here today. Northrop Grumman, 2023 pick. Morgan Stanley, Jenny. Price target goes to 626 from 585. It's yours, right?
Yes. So this is kind of my opposite stance from what I just explained on Disney. We've owned this for years. We initially bought it when it had an 11 times multiple. It's trading at 23 times now. Obviously, defense spending is going to grow and be resilient and increase, but this is now a little expensive for us. So we might trim it. We might sell it. We're not quite there yet because we think that there's a little bit of a ways to go. But this is where, I don't want to own it because it's already had its move. I don't want to own it as much. You want to own things before they're popular. This is popular. It doesn't get more popular than this.
Bill, you own it too.
We own it. We have good exposure in the defense space, along with Raytheon. If I were to cut one of them to reduce, it would be Northrop. But the relative strength that's in there right now is tremendous. I like how the stock and the company have traded, and the defense is only going to get more attention.
Why is Northrop the one you would choose if it was between Northrop and Raytheon?
I think with what Jenny had hit on, I think it's more in the front and center as people are buying it. For the story, for the narrative, and Raytheon less so. Raytheon we've owned for longer. We added Northrop earlier this year.
Okay. Bank of America, Wells Fargo, Mayo says it's a top pick. Target 52. Jason, you own BAC.
Yep. So on BAC, I mean, for me, obviously the last quarter, it was a net interest margin story. It's up 24%. I think banks are concerning on some level. I sold XLF last week. But if I look at banking fees as an example, it was down 46% in the quarter. That won't be the story forever, and if you look at also average loan growth continuing to grow at 12%, that might also help them going into next year. So let's play it out as one of the individual money centers that I could decide to keep.
Let's take Uber. Bank of America, Josh says it's a top pick. The price target goes to 43 for them. They urge you to buy it now. You own it.
Yeah, and I added to it recently. This is like the most frustrating stock for me because I can't understand why it's not treated better. I understand the whole narrative that people don't want money losing companies, et cetera, et cetera. They're cash flow positive. They'll be earnings positive. They got through an entire recession. There were questions about the delivery business. That became the engine that got them through COVID. Now they've switched gears. Everyone's back to experiences, being out and about. Even business travel is back, believe it or not, and Uber benefits there. So now they have everything happening in their favor at once. You've got the last vestiges of some of the labor issues getting wrapped up in the next year or so, probably. Politically, none of that stuff is getting anyone what they want. So probably not going to see much of a change in their business model there. And the stock just acts terribly. And I think that's a function of it just being classified amongst this crop of names that were no earnings names. And that's just not going to be the case going forward. There's even a divergence in Uber's results versus Lyft. Because again, they've got other businesses that have growth, like Drizzly, like Freight, International, things that Lyft just can't do. So I think at some point that's going to make a difference, and this stock is going to start getting treated better. I don't know when that's going to be. It's definitely not on a day like today. But I'm an investor here, not a trader.
Gotcha. Yeah, tough day. 4%. Tough day overall in the market, as you know. Up next, we are grading your trades, answering your questions about specific trades that you have made. You can send an email to us, askhalftime@cnbc.com. Tweet us. Halftime's back in just 2 minutes. All right, it's shaping up to be quite a nasty day in the market. You see the Dow's down 830, so we've given it back about 1,000 points or so since the Powell decision and the news conference as well. Many of you making trades, you need some advice, which is why it's time for Grade My Trade. All right, Jenny, you get the first one, okay? It's from John. It's on Devon Energy. Cost averaged up from 49 to 59. Wants to know if they should add more. You own it, so what do you think?
Well, I think as a trade, you've done really well. particularly you've got a positive return in a negative market. So good job there. If you want to turn your trade into an investment, keep holding this. One of the things Bill and I were talking about earlier is that most of the oil stocks are pricing in $50 oil. I think it's $60. Devon's pricing in about $60 oil. So if you believe that oil is going to stay higher, you have a lot of money still to make here. So I would hold on to it and I would increase it.
All right, Bill, you're up next. Brandon, all right, purchased shares of Amazon after the pullback on the last report. Average price of $95.94. What would you grade the trade, and what are your thoughts on Amazon going forward in the current rate environment? Why don't you take it?
I like the trade at 95. I mean, you've obviously bought it here this fourth quarter. It's a good, I think, value down there. But here's the thing. People are concerned about the retailer or the consumer, but that retail business has a network effect and allegiance for that Prime membership. I like that. We're underweight the stock relative to how it is in the S&P. But one big story is AWS, and the 30% of operating margins growth is something that I think is going to continue to be a big story here and continue to grow.
Okay. Jason Snipe, you get it. It's Jim from Wisconsin says, I bought Shopify, $23.94 a share. What do I do here? Do I let it ride? Do I take some gains? What do you think?
Yeah, so that's a great trade here. Obviously, Shopify now is around $32, $33. So for me, as you kind of look at the macro backdrop, look, they built a sustainable base through the pandemic. But, you know, as I alluded to, as you look at the macro backdrop going forward, I would look to cut some of it loose, you know, because I think there will be some deceleration as well, especially for small businesses. So I would take something off the table.
Just real quick, Bill Baruch, Shopify. Didn't you sell that recently?
Yes, we did. A lot of overhead.
I thought I remembered that. So you take the other side of this? What do you think? What would your grade be then if you sold out of it?
I like the entry in it. I think the upside is very limited, obviously, with the interest rates right here. If we see rates rise, but again, I think we're going to see a better consumer in the first quarter of next year. So I think there's headwinds from a price standpoint, from a rate standpoint, but I think there's definitely some upside. But if we can get through 40, 50 bucks.
All right, let's jump ahead to the Kinder Morgan one, guys. It's the last one. Lonnie Starkman, okay? Jenny, for you. Lonnie bought it at $18.16, right? So the stock's down just marginally since then. You own it. What do you do?
I think you hold this. But just to be really clear, of all the stocks that really aren't trades, that are really just long-term, and the whole point of owning them is to scrape the income, that's Kinder. It doesn't matter if oil or gas prices are up or down. They're pumping the commodities through their pipelines. They're collecting the cash from it, and they're paying it out to the shareholders. So just hang on to this and collect that cash, which is so wonderful to have in this kind of environment.
All right, we've called it a stock picker's market, and that's in fact what all y'all are doing. So keep your trades coming in, please. Send an email to askhalftime@cnbc.com. The investment committee is going to grade them. You can tweet us too at Halftime Report. Up next, we'll hit some of the biggest analyst calls on the street today. A number of them are in the travel and leisure space. Is getting hit very hard today. We're back right after this.
at Invesco.com.
Let's do some of our calls of the day. We alluded to it a little bit earlier when Jenny had mentioned JetBlue. I said it was downgraded. That comes from Cowen today to market perform. Jenny from Outperform. Target to $9.
Yeah.
$7, less than $7 stock now.
Man, that's a pretty nice upside, isn't it? $7 to $9.
If you think it's going there.
I think it is.
Why?
I think what the streets, what a lot of people are missing is how much jet fuel price. Okay, first of all, getting back to Josh's, a recession's coming. I don't think it is on airline travel. I think there's tremendous pent up demand. I know I'm traveling professionally as much as I am personally, so I don't think that really slows. So I think earnings hold up on that. But jet fuel's down like 21% in the last month, and I think that that's not accounted for, and I think that that really could push and promote margins as people pay more attention to it. Also, it's just stupid cheap.
Well, maybe it's cheap for a reason.
Well, 6 times? What are you going to do, go bankrupt from there?
I'm not suggesting that. But I mean, if travel's been so great, if all the seats are full, and if fuel prices are down like they are, why is it down 50% year to date?
Well, I think there was a lot of overhang over the Spirit merger, and people really hated that. I think there's a lack of belief that the earnings are really coming back. I think that they need to actually start to deliver, and I think they're delivering 60 cents in 23, $1.72 is what's expected in 24. And so we've kind of been beaten up as a society, and I think we need to see the numbers actually delivered before we're willing to step up and buy things.
You just maybe, the travel and leisure.
The stock is is at a 20-year low. I'm sorry. This stock came public this stock came public in 2002, April of 02 at like $13 a share. It's half the price of its IPO after 2 decades. This will never be a good business.
But Josh, there's no significance in that. Like, you always need to take your starting point as today. So who cares that it was $13 once upon a time? Just like I don't care that Peloton was $178 once upon a time.
You're such a good investor.
What I care about now,
You're such a good investor. I can't believe you would even have this like on your radar.
Josh, but
No,
that's
seriously.
the thing. Like, it's not okay. And historically, we haven't bought airlines, but sometimes the math is just there, right? And the math is just here.
Is this for the appetizer? I mean, what do you start with if you're having a burger?
I don't
like
know.
the side salad? What do you do?
You know what I think?
Shrimp cocktail?
I think Josh
Shrimp
is trying
cocktail.
to get me to treat him to a trip to Disney World.
Shrimp cocktail. They do have a good shrimp cocktail there. Shrimp cocktail, then the cheeseburger. That's on the table. I just
What's
added
your
that. I'm the
target?
judge. I can do
What's
that.
your
That's
price
my
target
ruling.
on JetBlue?
Real quick, and I got to
where do
take
you think it's going?
15, 16. I think it could easily be 15, 16 in a couple years. And when it moves, and we all know this, when these move, they move so fast that you've missed the boat if you're not early.
I don't want to wait that long for this lunch. I'm coming. All right, final trades are next. Oh, we got a big overtime. 4 o'clock Eastern time today. Ed Yardeni on what now for this nasty market. Cantor's Eric Johnston, same topic. Eric Jackson on why he's been buying more Tesla, which has gotten absolutely ripped. Adobe earnings too. So we got a lot to get through. We're going to focus some on tech too, which is getting crushed today. Let's do final trades. Josh, what do you got first?
ITA, we were talking about individual defense stocks. This is the whole index, and I think this trade continues to work into next year.
Okay. Jason Snipe.
CMS Energy Corp beat and raised in last quarter, closer to 3% yield, above peer EPS growth. I like it here.
Yeah, I mean, I mentioned tech. I'm looking at NVIDIA hammered, Google hammered, AMAT hammered, NVIDIA, Lam Research. It goes on and on and on. Meta. We'll try and get to some of that later today, too. What's your final trade, Bill Baruch?
Westinghouse Air Brake, WAB Tech, symbol WAB. They sell technology-based equipment in the freight. Highest level, it's trading up 2018 highs right now, so it's moving quick.
What do you got, Jim?
Massive 8% yield, huge in economic recession proof.
I'll see y'all in OT. The exchange is now.
Thank you, Scott. Hi, everybody. I'm Kelly Evans, and here's what's ahead. An ugly market, super ugly today, as the hawkish Fed is followed by bad data on retail sales and manufacturing and even more. The disconnect between the Fed and the markets is growing. So who's got it right and how do you position? We'll tackle it all. Plus, we've had a ton of great news on the airline front lately. So why aren't investors buying it? We'll debate whether the market is too bearish and get some top picks for 2023. And Don Peebles called the carnage in office real estate, but he called it a big opportunity, too. He joins us with an update as REITs remain a pressure point in the markets. And speaking of the markets, let's get a check on things as we stand at 1 p.m. Eastern time. The Dow is pretty much at fresh session lows right now, down 886 points. That's a 2.6% drop. The S&P down similarly to 3887, and the NASDAQ down more than 3%. It's below 11,000. Now, yields are falling sharply as well. Take a look here at the 10-year yield, 3.43%. So we're down almost 20 basis points since the Fed and since the CPI. The 30-year, 346, and the 2-year still way high here. You can see in terms of this inversion, 424, and that hawkishness is the issue here for markets. It's after pretty much every other piece of data other than jobless claims this morning came in worse than expected. And even the better jobless claims data is a quandary because the strong labor market is probably the main thing keeping the Fed in hawkish mindset right now. Let's get to more of it. Our big theme of the day here, the markets versus the Fed. Who's got it right? Bob Bassani is at the New York Stock Exchange with a look at what's going on with stocks. And Steve Leisman's got a roundup of that data and central bank action. Bob, let's start with you.
Well, what's happening today is the soft landing crowd is having a horrible day because the economic data is awful. So remember, the soft landing crowd's thesis is we're not going to have a hard landing. Earnings will be flat to maybe slightly up in 2023. We'll avoid this earnings apocalypse and things will be okay. The problem is the data isn't really going in their way, and now they have a valuation problem for the stock market. So look here, we have the Fed still higher for longer. That's an issue. But now we have the soft landing case is a lot harder to make because the economy looks like it's starting to weaken. So earnings right now, the important thing is how much do they need to drop? They're declining, but they need to drop more if the economy is really slowing down dramatically. The valuations, though, are still high. Believe it or not, the prices are still high right now. So this is what I call the valuation problem. So we see here the average 2023 earnings estimate for a strategist down 6%. That's a mild earnings recession. But the forward multiple is 19. Boy, that's expensive. Very rarely, Kelly, do you get over 18. It's only happened in the dot-com bust, and we saw it in 2017 and 2020. But most of the time, it's below 18. You've got to make an argument right now with these valuations that the economy is going to be a lot stronger in 2023. And you see the data today. That argument is just a lot harder to make. We've got a valuation problem right now.
So, Bob, just to be clear, even with the market's big drop this year, it's still more highly valued than normal?
Yes. The strategists themselves are dropping the earnings estimates for 2023, down 6%. If you apply the numbers that they have for 2023, down 6%, The multiple on the S&P is about 19. That is way above historic average right now. Now, though analysts are a little more optimistic, that's a different group of people. They still have multiples, earnings estimates a little higher. But most people are following the big Wall Street strategists these days. They tend to pivot a lot more quickly and tend to be a little more accurate.
That's crazy that we're still up at 19 times by that basis. Bob, stay right there as we turn to Steve Leisman, where we've had data, central bank action. Steve, tell us what's happening with the Dow now down more than 900 points.
Well, it's this gap between the Fed and the market boils down to a sharp difference over what recent data say about the current state of the economy, Kelly, and especially inflation and where it's going. Here's a little bit of my take on what the market's saying versus what the Fed is saying. The market says recent inflation data show it's falling. The Fed says 2 months is not enough. Core inflation is still 6% year over year. I need substantially more evidence, Powell said. Markets saying the economy is weakening, recession is likely, at least according to our Fed survey. Fed says, yeah, but the labor market's still hot. Wages are going to drive inflation. Morgan Stanley writing, the Fed chair sees the recent round of weak CPI prints differently than the market. Both October and November CPI prints were downside surprises to market expectations, but not so much for the Fed. You can see this disagreement between the market and the Fed in the 2023 outlook. Median forecast of Fed officials for the funds rate next year rising to 5.15%. It had been 4.6% in the September outlook. But Fed futures prices trading at 4.4% for year end. That is cuts after a few more hikes. So the market sees the Fed en route to making another policy error by tightening too much and not taking account of low inflation and a weakening economy and maybe those earnings coming down that Pisani was talking about. The Fed is fairly hell-bent, I'd say at this point, on not making the last error by tightening too little and letting inflation continue to rip. Kelly?
All right, Steve, stick around as well. Where do we go from here and how should investors position? Let's bring in two more voices. Peter Bookvar is Bleakley Financial Group CIO, and Andres Garcia Amaya is Zoe Financial's CEO. And it's really good to have you guys both here. Peter, just jump off of what Steve was just talking about and what Bob mentioned as well. You know, the Dow's down more than 900 points right now. What's it going to take to quell the selling pressure?
Hi, Kelly. I think today is a realization that while the Fed is almost done raising interest rates, whether they raise 50 or 75 is sort of irrelevant at this point. It's the point of keeping them elevated for a longer period of time. That is what is going to continue to slow growth. So even if they stopped raising rates yesterday, and that was the last hike, by maintaining this level, every month that goes by, there's someone that's having to refinance their debt at a much higher level than what is maturing. And that is why I see more of a grinded out economy, a death by 1,000 cuts economy, because rates are going to stay high for longer. And we should get off of how many more rate hikes are left and focus on, again, higher for longer.
Do I bail out of the stock market then, Andres? Go to the other side of the ledger and pick up, 4% on a CD for 1 year and see where we are in 12 months' time?
One thing's for sure clear, which is the 60-40 didn't work this year. And I don't see the dynamics drastically changing next year, except maybe that bonds look more appealing than they did this year. So yeah, the 60-40 doesn't work. You need some commodities exposure. You might even need some cash exposure, right? Last time I checked, I saw a 3% savings rate. That's unheard of for the last 15 years, that type of hikes leading to higher savings rates. So yeah, the world has changed. Doesn't mean sell stocks. It just means, you know what? Maybe we won't see all-time highs anytime soon.
Peter, why did the mood get so much worse after the ECB's press conference this morning?
Well, we saw a pretty sharp rise in European interest rates. Christine Lagarde said that they're going to be raising rates more than what the market anticipated. They laid out a plan for QT, which will start in the second quarter. While it's going to start very slowly at only 15 billion euros a month, it's likely going to pick up thereafter in Q3, Q4. So you saw 30 basis point increases in some European bonds, and that's rather sharp. So I think it just reaffirms this global monetary tightening still has a ways to play out.
Bob, what are you hearing from traders? Do they want the Fed to stop hiking here? Do they want them to start cutting? What do you hear?
Sure. Look, 2022, the story was about inflation and figuring that out. 2023, everybody's obsessed with the recession. And what side of the recession debate are you on? So the soft landing crowd has had a lot of currency in the last few months. And that's why the stock market has lifted. To the extent that today is about the soft landing crowd basically losing a lot of talking points, that's a good reason why the market's down, in addition to what Peter was talking about on the ECB. So again, you go back to this valuation question here. They wanted to stop because they're very concerned. The hard landing crowd is screaming really loudly, and they're going to have more influence as the more they see the economic data weaken.
But you know what's peculiar, Stephen? It's like the best and the worst news right now, jobless claims, right? Here's the one data point that would tell us if the economy was worsening quickly right now, and it keeps holding up. And the longer it holds up, the more that means we're going to have wage pressures or decent jobs reports that are likely to keep the Fed from cutting substantially right now. As Michael Darda has said, that's probably going to be the main reason why they make a bigger policy mistake. No one's cheering for a worsening labor market, but it's a fascinating dichotomy, and that data point is probably the most important one of all.
You know what?
And
Something
I think
that's interesting that
where
I don't.
the Fed and the markets most
Steve, go ahead, and
disagree-
then Andres, I'll come to you. Go ahead, Steve.
Okay, I'm having trouble right now keeping the old Pete Seeger Union song, "Which Side Are You On?" out of my head right now. But that said, that's really the key right there, Kelly. That it's the difference between the labor market, between the Fed and the market, over the outlook for the labor market. Powell has said repeatedly that he believes wages is going to drive that really important non-housing core services section of the CPI. And the idea being services are all about wages. That's what the cost structure is. And if labor markets remain tight, you're going to keep driving up wages. That's going to keep driving prices for something like 55% of the core. The market just disagrees with that and thinks that the labor market's going to, if the labor market is going to be right, it's going to be right that the labor market's going to come off that. And that's where the disagreement is.
All right. And what were you going to say, Andres?
Yeah, what I was saying is it's interesting that it's not part of the conversation, a scenario where we get a recession and by the end of next year, core CPI is at 4.5. Right? What happens then? Right? Isn't the goal to get it to 2 to 3? So we're kind of assuming all of a sudden that it's either recession or soft landing, but inflation hasn't gone to 3, right? Like core CPI is still at 6%. So I don't think the conversation around inflation is going away anytime soon.
Well, speaking of which, let's show what Bill Ackman was tweeting about in the case of where inflation really could be heading. Can we even get to 2%? Peter, is 3% more likely? Here's what Bill Ackman said. He said, I don't think we can get 2% inflation without a deep job-destroying recession, and it won't be stable there. He said accepting 3% plus or minus inflation is a better strategy for a strong economy and job growth over the long term. What do you say, Peter?
Well, I agree that it's going to be tough to get it down to 2 structurally. I think 3 to 4 is where the inflation is going to be eventually settling out. I disagree with him, though, that somehow 3% is a good thing. Inflation is a tax, and a 3% tax is worse than a 2% tax. So I only see trouble ahead if we settle in on a higher inflation rate, because interest rates are going to stay higher for longer. And I think the consumer still drives this economy, and a higher cost of living is not going to be good for them.
Right. But Peter, and I hate to even go here, but we're going to go here over the next year or so, I imagine. Which would you rather have, a 3% tax with no job or a 2% tax with one?
Well, that's going to be this fine line that we're going to have to dance around. I think Bill's point was that somehow 3% was a good thing. And while I agree that it's going to be tough to get to 2, 3% is what we might have to settle for, but that doesn't mean it's a good thing.
Andres, let's kind of boil this down then to what tactically you would do here as the Fed faces this question about pivoting, or if so, how hard and how and when. What do you say? What's your advice?
Look, if you're in the camp that we're not totally out of the water and that inflation is going to take a little bit longer to get there, I think the value stock versus growth stock still works. I think having diversification around commodities still works, and having some cash, because I do think that we'll have good opportunities, right? We're not going to go straight to all-time highs in this type of environment.
All right, Bob, what are you watching on the charts here as the sell-off is rapidly approaching 1,000 points?
3,900 to 4,100. We have been in this range for the last month. We've had some strong inflation reports like the PPI that came in, and we held at 3,900. We are essentially there right now. We're 15 points below that. So we break below that. That's a bit of a warning sign technically. And also, we have not been able to get over 4,100. That's the point at which you break the downtrend we've been in all year. We've been in a trend of lower lows and lower highs all year. If we get over 4,100, you break the downtrend. People will say, aha, you see the soft landing crowd will say Wall Street is signaling that we may get a soft or mild recession. And that argument is harder to make when you drift lower and you get the kind of crummy economic data we got today.
Sure. 3884 is the S&P level right now. Steve, a final word to you. What would change Chair Powell's mind and you think and have him going, you know what, maybe it's time to take a bigger pause here?
I think if you had weak job growth, weak wage growth, that would be a big step in the right direction. Another couple good inflation reports. I think the Fed might be able to settle down in this 4.5 to 4.75 range. I'll tell you what, one thing that a trader I talked to was really bothered by yesterday was the unanimity of the FOMC in terms of the 17 of the 19 that see the funds rate going above 5%. A guy said to me, look, isn't there anybody on the FOMC who's looking at the bond market and has some sympathy with that attitude? It's not like the idea of the market is a crazy idea that maybe the Fed, maybe we're going to have a sharp recession. Why isn't anybody on the FOMC sympathetic with that outlook? It'd be one thing if they were sort of a majority in favor, but this was 17 of 19 saying we got to go up above 5% next year.
Andres, it looks like you agree with that.
Yeah, I mean, look, the Fed does not care what the bond market is signaling right now. Their biggest concern is inflation. And I think that there's some miscommunication here. It's almost like, I don't know if you've seen the movie, He's Not That Into You from the early 2000s. I feel like the market's GG right now, right? Just misreading whatever the Fed's saying. The Fed's saying, look, guys, I don't actually care if the stock goes up or down. We need to crush inflation. And the market's like, ooh, maybe soft landing, right? That's a good thing. So there's a miscommunication going on, and we'll see who wins out of this one. I think the Fed, unfortunately, is going to win out of this one.
All right, we will leave it there. Guys, thank you all. Andres Garcia, Amaya, Peter Bookvar, Bob Bassani, and our Steve Fleisman. Still ahead, it's been a rough week for airline stocks despite bullish outlooks from a number of executives. We'll debate whether to own these stocks into 2023. Plus, will the Fed worsen the cracks emerging in commercial real estate? We'll ask real estate mogul Don Peebles coming up. And as we head to break, here's a look at the markets. Dow's down 921 points. S&P's down 112 to 3883. NASDAQ's the worst performer, down 3.4%. And the 10-year back to 343. The exchange is back after this.
This is The Exchange on CNBC.
Welcome back to the exchange. The airline index is down 3% this week. I mean, a lot of things are down this week, but they have had bullish outlooks from Delta and United. Delta raised its guidance. United, that massive order for at least 100 Boeing Dreamliners. In fact, United CEO Scott Kirby addressed the disconnect between stock performance and expectations with our Phil LeBeau earlier this week. Listen.
Investors have a hard time with two things. One, recession has to be bad for airlines. They just don't realize we're coming from such a depressed level.
Interest rates increasing has slowed the economy down significantly, and the concern is whether they go too far. What was encouraging yesterday was a 50 basis point increase as opposed to a 75 basis point increase. So I think we're slowing down, and I think the market will ultimately adjust.
When you say adjust, how much more losses could we be facing in some of these commercial real estate sectors?
Well, I think that the commercial office space marketplace has been hit by a double whammy. High rates and a recessionary environment, but also a change in the way people work. Americans are working differently. Remote work is here to stay. Hybrid work is here to stay. And so there's a far less demand for office space. And that's putting a lot of pressure on REITs, for example, that have a large inventory of office space in markets like New York City and an older inventory, because these markets are not created equally.
Yeah.
New office buildings are performing much better than in older existing office buildings.
Let's say I'm in one of these funds, maybe it's even gated now. Can they take my money and convert it into residential properties like we've seen in Lower Manhattan, for instance? This was already happening over the past 10 years. Empty office space was becoming fancy new apartment space. And is that going to just happen across the country? And could that bail out investors here?
Well, I think it can help in New York, but I think that what's happens is a value hit from a commercial office building that was performing properly prior to the pandemic. The valuations now are down 30, 40% and will go down further. And the exit is a conversion to office space for many of these buildings. And I think New York City and Washington, D.C. to a lesser degree will be helped by that. Those are the two hardest hit markets in the country, is New York City and Washington, D.C.
What's going to happen if some of these funds do end up having to sell assets at, distressed or even fire sale prices? It feels like that could still be another shoe to drop here.
Yes, it is. And I think that there'll be losses. I mean, any fund or any REIT that's heavily concentrated in commercial office space in the major U.S. markets, excluding, say, Texas and Florida, I think are in for a very rude awakening. So there are going to be significant losses. The cost to convert these buildings to apartment use, which will produce ultimately less income than those office buildings produced pre-pandemic. So I think you're going to see a lot of losses there.
Wow. So what's your advice to investors? Where's the opportunity? What should people do right now? Or is it all predicated on the Fed eventually pausing its rate hikes?
Well, I think pausing the rate hikes would be helpful, but it won't bail out commercial office space. I think you've got to look at the more entrepreneurial funds that are able to pivot. So you have larger funds that, the Blackstone funds, the BlackRock funds, some of the Goldman funds. Those funds tend to be much more entrepreneurial and nimble, and they have other places to go. So they have other strategies. And I think that, taking these commercial office buildings and converting them, especially those who are now buying. So anyone buying commercial office buildings can make the conversion now. Those are going to perform well. And so there's some new funds that have come out that are opportunistic. There's some new ones that have come out to raise money to buy and convert commercial office space in New York City and Washington, D.C. and San Francisco, elsewhere. I think those will perform well.
Yeah, it makes a big difference when you're starting with a much lower purchase price. Final question. I'm a little surprised that a company like WeWork wouldn't see better fortunes right now, because the traditional work environment has broken down, but people do still have this desire, this need to kind of have a place to do their business. Do you think that model will emerge better from this over time, or is it simply just challenged because there's just fewer people in that pool than there might have been a couple of years ago?
Well, I mean, WeWork is not a new innovation anyway. I mean, we just had been doing this for quite a while, many decades. And so what's happened is WeWork was focused more on the startup and the entrepreneurs. And that's not where the opportunity is in flex commercial office space. It's for the small, mid-sized, and larger companies that want to remain flexible now. And I think also what's going to happen is commercial landlords are going to have to change about how they lease their office space. It'll be more short-term. You'll see more commercial office building owners actually get into the same kind of business that WeWork is in with flex space. And so that's going to put a lot of pressure on WeWork's ability to produce better earnings.
Yeah, and if you want exposure to, kind of that third place where people might show up and just casually work, you just buy shares of Starbucks and you don't need to worry about the fundamentals in real estate at all. Don, thanks very much. It's good to see you today. We'll check back in soon.
Thank you, Kelly.
Don Peebles with the People's Corp. Coming up, the NASDAQ is the underperformer today as investors digest the Fed decision. Netflix, DocuSign, and Marvell are all having the biggest negative point impact on the NASDAQ 100 today. We're going to get a closer look on the mega caps next. Speaking of the semis, the SMH is on pace for its worst day in a month, down about 3%. The semiconductors often a good leading indicator. Today, it's going straight down. We're back in a moment.
Tech.com.
Welcome back, everybody. Tech a clear laggard today after the Fed's half-point rate hike and sustained hawkish stance. We see major pressure across stocks. Steve Kovac is here with a check on how the mega cap names are faring. Are they defensive, Steve, or are they still behaving like their old selves?
Yeah, it's bad and getting worse throughout the day. So shares of the mega cap tech names falling with the rest of the market, Kelly, with those losses extending into this afternoon. Let's go to Apple shares first, down more than 4% this week. Remember, Bloomberg reported Apple is working to allow those third-party app stores on the iPhone in compliance with a new law in the EU that'll go into effect in 2024. Now, if more countries impose similar regulations, Apple's lucrative App Store business could be at risk. Now over to Microsoft, shares off 3.5%. The FTC sued Microsoft a week ago today in an attempt to block its $69 billion acquisition of the video game publisher Activision. That deal could take longer to close than Microsoft's initial target of June of next year. Then there's Amazon. It's down as well, off nearly 4%, but it's the two names that rely on the digital ad market, Kelly, that are getting hit the worst so far today. Meta and Alphabet are down around 5%, perhaps a sign investors are more worried about those ad-supported social media companies.
Obviously, Netflix down sharply on some concerns about what might be going on with advertisers there as well. Talk a little bit about those advertising trends. I mean, obviously, so they're super sensitive to a recession, but you'd still think those companies would benefit if marketers have to pull back. Are they really going to pull back at Meta and Google first? It seems unlikely.
Yeah, and it's also traditional media companies. We're seeing layoffs across traditional media companies. Washington Post yesterday, for example. So, yeah, those get hit first. But, I mean, Facebook, Meta rather, just went through those huge layoffs as well. So they're all cutting costs. Our Jen Elias was reporting a little bit earlier this month about, layoffs are still on the table at Alphabet too. They haven't had them yet, but that could be a cost-cutting measure too if the ad market turns.
And, I understand we still lump these all together, and in many ways, like today, they still trade the same. Yeah. But a name like Amazon, where the stock has really been under pressure the past couple of months, it faces very different issues than some of the others. And, I'm just surprised there isn't more differentiation at this point, this mature in the cycle with some of these big tech names between their fortunes. It just seems to be almost telling you, what, they only perform well in a high liquidity, low rate environment. And this is not that.
Maybe, but I was looking, at Amazon's performance last week, and it was the laggard of the group. Yeah, they all grew last year, all these shares, but Amazon was still the laggard last year of that whole group. They didn't grow as much. And now it's really Meta taking on the chin in this group this year. But still, yeah, Amazon for some reasons it just doesn't have the shine that it used to. Perhaps that's because Jeff Bezos is no longer running the company. But yeah, they're hurting and they're going through all these inventory problems, a lighter consumer in the holiday season, and all of those issues. Yeah, and advertising too.
Right, and it was a pandemic darling, and I was pointing this out earlier. But if you look at a sort of staid company like Generac, right?
Right. I saw you tweet that today.
Generators,
yeah.
right? Exactly.
Right.
This is a company that's profitable. It's been around forever. But when you have your shares run up the way that it did, and you could lump Amazon into this category, anything that was part of the stay-at-home trade the last couple of years is seeing this massive cliff post-pandemic, and the market just seems to be in a punishing mood.
And that's tech in general, though. Tech was just overall tech was the benefit of the stay-at-home. We use those tools to work from home, to be locked down. So yes, of course, when things turn the other way, tech takes it on the chin. Yes.
All right, Steve, thank you.
Absolutely. Thanks, Kel.
Still ahead, while the mega cap tech names are taking a hit, Tesla has somehow managed to reverse course today. It's now one of two positive stocks on the NASDAQ 100. There it is, up 0.2%. And Jeff Kilburg says now could be the time to buy. He'll rejoin me with what's got him feeling bullish next on The Exchange. Welcome back to The Exchange. What do bonds, China, and Tesla all have in common? Investors ran away from them this year. But CNBC contributor Jeff Kilburg, should we say you're running towards them, Jeff? You're tiptoeing. You're
I'm listening.
You're fast walking.
Yes. Yeah. I don't know if I can sprint anymore in this old body, but yes.
Why do all three of these sort of perk your interest a little bit?
Well, the old bond trader in me, Kelly, has to really take interest in the fact that for the first time, we really have to listen to the bond market. Everyone is so predicated, all their investment theses for 2023 is based upon what the Fed is. Historically, I don't know what the technical term is, but the Fed has been horrible. on forecasting. So we're giving them a lot of credit. I take a lot of credence in the fact that the 2-year note is at 4.23%. We saw that max yield coincide with the max low in the S&P 500. So if we look at the S&P 500, Kelly, I think the bond market, you have to believe in the bond market. And that's the thesis, which is actually taking me overseas, because I do see this lag, this disconnect. What did we see earlier in the year? We saw the bond yields go from 1.5% in the 10-year up to 4.25%.
Crazy.
There was a huge disconnect and a lag in equities selling off. Now all of a sudden we're seeing some calmness come back into the market. So
you can say that on a day when the Dow's down 916.
Well, it doesn't feel good, but if you look at the S&P 500, pull up a chart the last 3 months, we haven't moved. The exact tick. It's 3,882 on the S&P 500 exactly 3 months ago. So there's been a ton of noise, a lot to digest. But I think on days like this, you have to remain calm. I'm looking overseas at PGJ.
Golden Dragon.
The
China
Golden Dragon.
Index.
It's the NASDAQ Golden Dragon Index. Invesco's ETF gives you liquidity, gives you exposure to Alibaba, JD.com. NEO just got upgraded today. I was a little early buying this about 3-4 months ago, but I think this is a theme in 2023 as we see China reemerge. It's been very hard to measure China.
Sure, and Marco Papich told us the same thing last week. He's very bullish on China's prospects for next year. But let me go back to what you said about bonds. So basically, you said that stocks are tracking the 2-year yield right now. If you think that the 2-year yield's not going any higher, then you think it's safe to buy.
In a lag effect. Exactly right, Kelly. What I am seeing, and we talked about this before on CNBC, when we saw that 2-year note go above 4.5%, we saw a lot of institutions buying that yield, embracing that yield, I should say. It went up to 4.88, and now it's come back and simmered down. I think there is an opportunity for equities to really get over the opinion. And I know Bob Pisani was talking about earlier, that technical move above 4,100. That is when all of a sudden people say, aha, maybe the bond market was right.
Sure. If we get to that point, as we're still sitting where we are, let's talk about a little about one of the more controversial ones here that you're looking at, and it is Tesla.
It is Tesla.
Now, the stock, if you want to argue that the stock is underperforming the fundamentals because of Elon Musk, I can absolutely understand the case for buying it. That said, does it require some kind of management change to perform better? Does it face another year of tough liquidity, you know, with what the Fed's doing here in the market?
So one thing I don't do is get political, right? But I look at sentiment. I think sentiment is really important to talk about investor sentiment. This is a beat up stock. We just saw Elon sell more shares, another big block just yesterday. So I think when you look at this, go back to November of 2020. That's when the stock kind of took a breath at 136, and there's been a parabolic move ever since then. So I think it's fascinating in this opportunity to buy here. If you want to use options and really qualify and quantify what your risk is. But I think owning this here, we're going to get a lot of this political component, this undercurrent in the rearview mirror.
Why? Why is it going to go in the rearview mirror?
Because it's just maximized. It seems like in June, we had maximum conversations about inflation. Back in October, you know, the world is imploding. It was maximum equity scared. And you saw the pessimism come out. Right now, it seems like max Elon.
Yeah.
I don't know if that's a word, but it's max Elon. So I think there's an opportunity in Tesla. I think the technology will be refocused in 2023, but it's very hard to see it right now.
Okay, quick final word. You're also picking around a little bit in energy. Tell me where.
We are. You know, I run a sector rotation model, and that model all year has been trying to find themes that make sense, and more importantly, stay away from sectors that are really revealing weakness. But
which I would have thought energy qualified as.
Energy up 55%. If you look at XLE year to date, but I think you got to be a little more selective. So you look at a name like Valero. We own Exxon, but also look at Chevron. These are names that I think the theme that we saw in 2022, where the dollar is going, I think that puts more wind in the sails. And that same theme in 2022 of owning the sector of energy persists in 2023.
So there are some big calls out there today that saying actually you should buy the dollar, go long it, it's going to have another big year. If that's the case, does that hurt your energy trade?
It does, but that's the consensus view. The consensus view is the Fed is right. My view from Chicago and sometimes Nashville is the fact that the Fed has never been right, going back decades and decades. So I'm going to bet on the old bond trader in me, Kelly, and bet on the fact that the Treasury market, specifically the 2-year and 10-year, is forecasting that we are going to get through this storm.
All right. We will leave it on that hopeful note because we need it today. Jeff, thank you again. Really appreciate it.
Great seeing you,
Jeff
Kelly.
Kilberg. All right. Dow's down 931. Crypto is getting crushed today, and the Fed fallout is hitting all swaths of the fintech space. We've got the big movers and whether there's more pain ahead next on The Exchange.
CNBC.
Welcome back. Want to get to one more thing before we go, and those are the big moves in crypto and fintech stocks. Both are taking hits. No surprise in a market like this. Kate Rooney is here with what's behind it. Kate?
Hey, Kelly. Yeah, these are some of the most rate-sensitive, high-growth names in tech, very much under pressure today. Investors are worried about weaker consumer spending with that retail sales number and higher rates affecting lending, as well as a trading slowdown hitting some of these stocks. Affirm and Upstart, those are some of the worst performers within this sector today. And when borrowing costs and delinquencies go up, their margins tend to get squeezed. Dan Dolev of Mizuho is among those questioning whether some lower income Americans will be able to repay loans. SoFi, meanwhile, holding up a little bit better. And unlike most fintechs, it's a regulated bank, so it gets to borrow from the discount window. It's seen a rise in interest income thanks to higher rates. CEO Anthony Noto also bought about $5 million in that stock yesterday. That helped SoFi. And we also got Block, highly indexed to the U.S. consumer and spending there. Also some lending and trading. It is one of the worst performers within the group today. PayPal is also down. It has been an outperformer lately. It is one of the highest rated fintechs. The average analyst rating overweight with a price target that's about 30% higher than where it's trading today. But there are some jitters that it may be losing market share to Apple Pay. Robinhood also getting hit by a trading slowdown overall this year. Kathy Wood's ARK FinTech ETF down as well. And then the broader contagion fears we've talked about on FTX, that's been weighing on Coinbase. Bitcoin is also down today. It's been pretty range bound so far, and a lot less volatility in that space and less trading activity tends to drag on revenue at Coinbase. Finally, you've got the card companies. Those are underperforming rather, the S&P around fears of a weaker economy and consumer spending as well. Kelly.
Yeah, we saw some higher charge-off rates in November, that kind of thing. Kate, I'm a little surprised Bitcoin's holding up as well as it is, frankly, with everything that's happened. We're still around 17K. You could easily see, rationale for it being below 10. What are people saying about that?
It does seem to be really rate sensitive, Kelly. It's interesting. Some of the crypto specific news isn't hitting Bitcoin as hard as it may have a couple of years ago. At this point, it seems more sensitive to things like the US dollar strength and interest rates. So that really was the big mover. Other than that, within all of this FTX drama and what's gone on with specific crypto companies, it actually has really not performed too badly in the context of what it probably would have done a few years ago. It's become more of a mainstream investment in your average portfolio, and it's very much traded like a risk asset. It's also outperforming some of the other smaller cryptocurrencies. If you look at some of the smaller tokens that tend to be a little riskier, it sounds crazy to say, oh, Bitcoin's actually a safe haven within this asset class, but it's holding up better than the rest.
Yeah, it's not FTT.
Yeah,
Kate, thank you very much. We appreciate it for now. Our Kate Rooney reporting. And that does it for the exchange, everybody. Stay tuned with the Dow down now just under 900 points. Power Lunch begins right now.
As you mentioned, Kelly, the Dow down 900 points. The sell-off on Wall Street just intensifying. This is Power Lunch. I'm Frank Holland in for Tyler Matheson. The Dow down, as we mentioned, the NASDAQ and the S&P down as well as investors grow concerned. The Fed's relentless rate hiking campaign is tipping our economy into recession. This hour, I'll look at the health of the consumer, recession protection plays, and what a slowdown means for tech, oil, and the travel trade. But first to Kelly and a check on this sell-off. Kelly?
Frank, thank you. Welcome. And hi, everybody. Tech is getting hit the hardest on those recession fears. We have the S&P down about 2.7% today, but 3.4 nearly for that NASDAQ. And the selling picked up steam after a bad retail sales report this morning, showing the worst drop in 11 months. We had some other poor data as well, some tightening out of the European Central Bank. Added up, here's your landscape right now. Apple's one of the worst performing Dow stocks, matter of fact. Netflix down big on some advertising concerns, down almost 9% today. We'll have more on that later. Alphabet and Microsoft, look at Google shares down 5%. Now, over in the bond market, yields are also falling on those concerns over growth. The 10-year back below 3.5%. Remember, 361 or so were the highs we saw after that CPI report, but it's been a big about face. In fact, let's get more with Bob Pisani at the New York Stock Exchange. Bob?
Well, the problem today, Kelly, is that the soft landing crowd is having a very tough time. So remember the narrative here. The stock market's lifted off of its October low under the belief that while we may see an economic recession or slowdown next year, it's going to be a mild one. The Fed will raise rates. They'll finish in early 2023. And then maybe they'll start considering lower rates in 2023, the end or early 2024, and the market and the economy will hold up. Earnings will not have a precipitous decline. That question mark now exists, or there's a big question now, because the earnings situation may be a little bit more precarious than people think. We're still going to have rates higher for longer. We know that. But the soft landing case is much harder to make. We had some lousy economic data today on retail sales, industrial production numbers. And so now the soft landing crowd is a bit on the defensive. Maybe we'll have a harder landing. If we get a harder landing in the economy, earnings have been coming down modestly, but not much. And it's certainly not accounting for any kind of hard landing. Maybe 4 or 5% decline in earnings. That's not a big number here. So we have what we call a valuation problem right now, guys. And the important thing now is, what side of this recession debate are you on? If you're on the harder landing side, and today, because of the economic news, that's got a little more currency, then the numbers have got to come down. The market's got to come down. The valuations are too high, and earnings estimates have got to come down even more. Guys?
You know, Bob, you said the word currency. I want to ask you about the weaker dollar. The dollar's definitely been, it's slowed down. It's tremendous hike over the year, only up 9% for the year, but actually down about 6.5% for Q4. How does that shape what we're looking at for the rest of this year and into Q1?
Well, you saw what happened today. The dollar dropped because the ECB had some comments out raising their inflation forecast. So generally, that's good news. Dollar down and rates down, particularly on the Treasury rates moving to the downside. The problem is very, very simple right now. The stock market is pricing in somewhat of a very, very mild slowdown in the economy. And the evidence is starting to mount that may not be correct. So again, you just keep bouncing back and forth between what side of the equation you are. Tell me where you believe the economy is going to be a year from now, and I can give you a pretty good idea where earnings are going to be. Right now, most of Wall Street has earnings down, flat to down about 5%. That's a very modest earnings recession. But in a notable recession, earnings can drop 20% very easily. The market is not anywhere near anticipating that. And the kind of economic news we got today indicates maybe we're on the harder than the softer side.
Yeah, certainly something to watch, Bob. Right now, we're looking at the 10-year rates at 3.44. Bob Pisani at the New York Stock Exchange. Thank you. All right, turning our attention to retail. The S&P Retail ETF down more than 3% on today's disappointing retail sales report. It is off 31% so far this year. The declines in the report were really broad across most categories, including furniture, autos, and electronics, suggesting that inflation is taking a toll on the U.S. consumer. Here to discuss what this says about the consumer and the health of the retail industry is Jerry Storch, CEO of Storch Advisors and former Toys R Us U.S. chairman and CEO. Jerry, always great to see you.
My pleasure.
So I know you're really about, apparel and toys and merchandise and stores, but I really want to touch on one thing. We've been talking about the health of the U.S. consumer, but when we look at the auto report, down more than 2%, isn't that the one area that we supposedly had a lot of pent-up demand? What does it mean that we see auto sales decline by 2%?
Look, cars are expensive and they're often financed, so it requires, interest rates have a huge impact on big ticket items. So absolutely no doubt that it's hitting the consumer across the board. And when I look at this report, there are just two numbers you really need to know. One is grocery is up 8.6% on a year-to-year basis. And the second is department store is down 3%. So the need to eat versus look good spread is over 11 to 12% difference in consumer trends. That's just massive, where consumers are being forced to spend their money on necessities and don't have much left over.
Yeah, you mentioned the increased price of food that we saw in the CPI report. Also, shelter costs went up 7% according to that CPI report. So what's going on? I remember back on Black Friday, I was out in the field. It looked like sales were going to be strong, right? It looked like it was going to be a really strong holiday season. What's changed since then? Has the consumer lost spending power or just confidence in their ability to spend right now with an uncertain 2023 ahead?
Hey, I hate to tell you this, Frank. I was on your show on Cyber Monday, the Monday after Black Friday. I told you then that was just a load of hooey, a hype. Black Friday was not good. It wasn't good at all. And so Adobe put out this report that said it's record sales on Black Friday, meaning online sales showed a 2% increase year over year, which is tragically bad. 2% increase in online sales. That's horribly off trend. And so, as I said a couple of weeks ago, it wasn't a good Black Friday. It wasn't a good Black Friday online. It wasn't a good Black Friday in the store. And it's certainly not a good Black Friday or a good holiday season for anyone who sells goods that are not necessities.
Jerry, we also saw November charge-off data showing a little bit of an uptick in delinquencies last month across some of the major card companies. So it's obvious there was a break in the trend, if you want to call it that. What's peculiar to me is we've all of a sudden had several months now where real wage gains have been above inflation. So I don't know if that's going to bail us out here with a little bit of a lag, or not. I mean, what's your make of that?
Well, I think the consumer is getting more and more leverage, so they can't keep spending at the rate they were spending at before. I mean, we can look backwards and we can see that we've lost a lot of some of the government stimulus that was helping the consumer along. We know that credit card spending is starting to increase again. Consumer leverage is starting to grow. So there's absolutely no doubt that we're seeing signs of a stretched consumer. I love the American consumer. She will spend until she runs out of money. And what we're seeing here are so many signs that she's starting to run out of money. I mean, basically, she's spending money on food. Gas was the other big number in this. Still up big year over year. The amount of money people are having to spend on gas. And then people are doing one thing. They're going out to eat. So you see nice increases in restaurant sales, which is that whole reopening phenomenon. People are also spending on services that's not in these reports. So these reports have no information about airlines or hotels or other travel or services. But keep in mind, a lot of that is price inflation for the same airline flight.
Real quick, Jerry, is it possible that this was just pulled into October? It's an Amazon effect?
There's no doubt some of it was pulled in October. I think the retailers were racing to be the first one out under the theory that they didn't have to be faster than each other, just faster than the bear, just faster than the slowest retailer. So they pulled a lot of sales in October, but it doesn't mean that it's coming back. In other words, they spent some in October, November is down. I don't hear from anybody out there that sales are like great guns right now. It's only 10 days left to Christmas. There's almost not enough time to make it up. And the retailers are promoting wildly. I mean, there's incredible promotion out there, which means what we aren't even talking about now is what impact will this have on on retailer margins. So sales might not just be soft, but their margin rates may get hit. Plus, we could have another, I hate to say this, but inventory hangover as we get to next spring.
Wow.
Oh, Jerry Storch, we got to leave it there. You're not your usual sunny self this time around. A lot of doom and gloom about the retail picture, but Jerry Storch, we always appreciate the insight. Thanks for being here.
Thank you.
And if he's right, let's look at some ways to protect your portfolio as recession risks grow. Mike Bailey is here. He's Director of Research with FBB Capital Partners. First of all, Mike, do you share some of this pessimism about the consumer?
A little bit. I think the key issue is it depends. So, the last guest was talking about a lot of pressure in the retail space, maybe pull forward to October. November wasn't looking that good. I really think it depends what kind of retail sector you're looking at. So we generally prefer scale. We like barriers to entry. We like companies that are gaining share. You can find that out there in the market. Companies like Lowe's, for example. You're making a housing bet with something like that, but there really is a lot of scale. They've just come out. They've given guidance for next year to big analyst meetings. They're really baking in a lot of some potential pressure next year.
Yeah.
So I think there are ways to play retail without kind of getting burned among some of the smaller caps.
And we should be clear, and Jerry himself was very clear to say, look, I'm talking about kind of stuff you buy, maybe at a mall, but we're not talking about services. Are people simply going back to spending as we've seen on those Taylor Swift concerts, maybe even some airfare, some vacations again? Is this just a mix shift?
We're seeing a little bit of that. Just it's been sort of this big cycle between the stay-at-home period during COVID, buying stuff. Now people are doing revenge travel, et cetera. So there's a little bit of a shift there, but I really think it depends. What angle are you looking at? So some people would say, well, I want services. I want to have a good experience. For example, I want to have a home situation. So I'm going to go get a home improvement. Others might say, well, I'm going to go and have some discretionary retail, et cetera. The other angle might be, despite some of that shift towards services, we are probably headed into a recession. And so generally people like to buy in bulk, scale up, et cetera. There are ways to own that theme as well. Even if goods in general are under pressure, something like a Costco, that may benefit as people look to buy bulk, even as that kind of mix from goods to services starts to shift.
Hey, Mike, guys, it's Frank Collin here. I want to switch away from retail just for a second. I want to get to one of the other picks. Ticker MMC, Marsh & McLennan. This is a conglomerate with insurance, investment business, $80 billion market cap, not a stock we talk about very often. Probably best known to our audience as the parent company of Mercer, an asset manager with about $350 billion in assets under management. In this current environment, what makes a company like this so attractive to you?
So really, this is a bit of a macro call. And I think as you're heading into possibly a recession, you do want to have a pretty solid company in your corner. So Marsh Mac, really the big brokers, even Aon, they're in pretty good shape. A lot of times when there's fear in the market, that's generally helpful for insurance demand. People are really concerned. They want to stock up on insurance. A good way to own that theme is through the brokers. So Marsh Mac and even Aon have done pretty well. Looking into next year, if there is some type of slowdown, you are likely to see that again. Typically, these companies do pretty well through a recession. There is a little bit of a bottoms-up theme with reinsurance, so Marsh Mac is likely to have a big benefit there. And then among the brokers, Marsh Mac tends to service more of the mega cap type of companies. So if there's any pressure among small companies out there, I think Marsh Mac is better positioned. So good company, a pretty good part of the cycle, and I think something you want to own, at least for the defensive part of the portfolio.
Mike, before you go, do you want to just comment on where earnings are headed? Because like Bob Bassani said last hour, the market still looks overvalued if it's 19 times where kind of the top-down strategists are seeing things. Where do you see them, and what does that mean for stock prices right now?
Absolutely. So I would see some additional pressure on earnings. I mean, we can kind of start at a high level. We've got, Jay Powell really squeezing the economy. I think investors today are worried. They're seeing basically the ghost of Christmas future. Today retail sales are under pressure. What does that mean for the next 6 to 9 months? So as that filters down into earnings, we do see a bit more pressure. So typically in a recession, you're going to see profits come down 10, 15, maybe 20%. We're still in the early innings of that. So I think that's going to add to some investor volatility. As we get into the spring, I do think earnings are going to trickle down. You may get a tipping point where earnings are down, let's say 10%. Investors say, okay, we're going to look over the hill. Earnings may go down a little bit more, but we're likely to start buying. So that could be a bit more of a tactical buying opportunity looking into the spring.
All right, Mike, thanks for joining us today. Tough market. Mike Bailey with FBB.
Yeah, we're not getting a lot of optimism today. A lot of people kind of telling us it's going to be rough sledding ahead.
Don't expect it, yeah, with Dow down 903.
All right, coming up here on Power Lunch, more on this market sell-off, including a trade down on travel, why a leading analyst says white-collar job uncertainty could impact Marriott's bottom line in the new year. Plus, tech taking yet another beating. Will stocks like Netflix down 52% this year and Uber down 37% see the biggest bounces in 2023? Power Lunch, right back.
TV.
Now, travel and leisure stocks are getting hit on recession concerns today, so it's not just about the retail sales report. We've got Marriott, Norwegian Cruise, and MGM, relatively minor drops, but still 2 to 3%. It's the shifting labor market that just led our next guest to downgrade shares of Marriott to equal weight. What is it? white-collar job uncertainty. Barclays analyst Brad Montour joins us now. It's great to see you, and you actually pick up on quite a dispersion between white-collar and blue-collar fortunes right now. Is that right?
Hey, Kelly, how are you? Thanks for having me. Yeah, look, I'm not a macroeconomist, but this is something we've been seeing anecdotally for a little bit now, right? Our own companies who hire workers in hotels or dealers at casinos, they're still not fully restaffed from the pandemic, right? And so, the idea that they would go and cut people just to try and hire them back 6 to 12 months later, for us doesn't feel like it's how this macro will play out in 23. We see the tech layoffs accelerating. We see white collar or blue collar job postings gaining share from white collar job postings. We see blue collar wage growth outpacing white collar wage growth. So yeah, we kind of see that there being a little bit of shift under the surface there.
It certainly points to a profit squeeze because it basically implies that your earnings are going down because what you're paying out for your labor force is going up, but at the same time your end demand is kind of falling off a bit. Who else other than Marriott do you think is going to be feeling the squeeze here?
Yeah, so for our call today, we do focus on Marriott, but I think it's going to be across the board for high-end leisure travel, right? I think that it isn't going to fall off a cliff, right? Travel and leisure is going to be a bright spot in 23 relative to other consumer discretionary segments. But I think that price sensitivity is going to start to form at the high end because, look, the world is different than it was 12 months ago. There's less pent-up demand for travel specifically. There's less confidence in the economy overall. And so we just think that there's going to be a little bit of trade down.
So, Brand, hey, Frank Holland here. I know it's a pretty bearish call on Marriott and generally the travel sector. I want to ask you, does that factor in a reopening China? We're seeing signs that China could reopen. And while we're saying that the pent-up demand is kind of ebbed here in the United States and maybe in Europe, there's certainly going to be a lot there. People who have been stuck in their house, and generally those Chinese travelers are high-end consumers.
Yeah, thanks, Frank. So, look, China, we think that we are bullish on China's reopening in 23. That is a tailwind for all of our companies that have exposure to China. The exposure for China for Marriott, let's say, is less than 10% of rooms. That's pretty stable across most of the companies we cover. It varies, but net fees to these companies are even below that number because they make a little bit less royalty fee in China than they do in the U.S. So it's a tailwind, but I think the U.S. is still the core business and the profit driver, and so that's sort of front and center.
So, Brant, let's get a little bit more granular about the Marriott call. What do you see happening to the stock next year?
Yeah, so look, we moved to the sidelines on Marriott with an equal weight rating, right? And so it was at our price target. It trades at a pretty full valuation, a valuation that's well above historical multiples. It outperformed its lower end peers this year by 20 points. And that was because, and we had a buy rating. That was because the tailwinds into this year were a big, a broad recovery of group travel, a broad recovery of high-end business travel, and the high-end leisure consumer holding up. That was the thesis. It played out. Going into next year, there's less group recovery tailwind, right? Group will be okay, but there's less tailwind. And then business travel at the high end is actually more sensitive to macro than the low end of business travel. And so that's where Marriott is positioned. Sure. And so we just see less tailwinds and a slowing of growth as a sort of a base case with the full valuation.
No, it's a fascinating call. And for what it's worth, if people are looking for more of a pick out there, Wyndham is your overweight, moves to overweight as you look into next year. Brad, thanks for joining us today. We appreciate it.
All right. Netflix has been one of the hottest stocks. Oh, sorry about that, Brad. Back to this. Netflix has been one of the hottest stocks in the market, up 60% over the past 6 months. But today, the stock falling 9% on concerns its new ad-supported tier that just launched hasn't gotten off to a great start. Mark Mahaney named Netflix as one of his top picks for 2023. He will make his case coming up. And as we head to break, I look at some of the other names in addition to Netflix, which are dragging on the communication sectors today. Meta, Alphabet, and Disney among the big names getting hit pretty hard. Power Lunch, back after the break.
the app.
All right, welcome back to Power Lunch. Netflix shares falling by 9%, tracking for its worst day since September on reports of a sluggish start for its ad-supported model. The stock's been all over the place this year. It's about 77% off of its lows and about 22% higher quarter to date, but still down about 50% since the start of the year. Hope you can follow that. Our next guest says he expects the rebound to continue into next year. Here to talk about Netflix and some of his other top picks in 2023 is Mark Mahaney with Evercore ISI. Mark, great to see you.
Hey, Frank.
So we're just talking about it right here. Netflix up more than 20% in Q4. A lot of excitement about its ad-supported tier at first, but it seems to be getting off to a slow start. What's setting it up for a strong start in 2023?
Well, we did turn tactically constructive on the internet sector for 23 because we think multiples have been de-risked, estimates have been de-risked, and we've seen enough cost actions, kind of an unprecedented level of RIFs, reduction in force, RIFs being taken across the space. I think that creates this EPS slingshot opportunity. But all that said, macro trends are deteriorating. You heard that, or decelerating. You saw that in the Department of Commerce data. We've seen that in other checks. So you want to be tactical about it. You want to find companies that have already taken out costs, that have got a new revenue stream, or got somewhat recession resilient revenue streams, and you want companies that have got a new product cycle. That's Netflix. So it's our top pick for the year. They've taken out costs earlier in the year. I think $9.99 or $6.99 now for Netflix's library. That's about as cheap as you can get for entertainment if we go through a recession. And then I think this advertising business is the real deal. It's off to a sluggish start, but Frank, have you seen any ads promoting this? I haven't, and I haven't seen them in the U.S., Germany, or the U.K., the three largest markets. I think they're doing it in some other markets, and I think we're going to start seeing more of it as they roll out their password sharing plans next year. So I still think it's a major catalyst. It addresses rising price sensitivity at the company, and they can do it in a way that's really positive for unit economics. So I'm sticking with Netflix. Today's move doesn't faze me.
I want to start with Netflix just for a minute. How crucial is content to this ad-supported tier? Obviously, they have big hit shows like Stranger Things, Bridgerton. How important is it for those shows to come back and keep people not only watching, but also watching the ads?
It's extremely important, Frank. The two most important reasons why people have been churning off of Netflix in the past, it used to actually be content. And then price actually became the bigger driver. That's why I thought this ad-supported initiative could be so useful in terms of helping grow subs. But content is still king here with all of the streaming companies. Netflix's advantage is now we've gone through a period of accelerating competition in streaming over the last 3 years. That all changed. I'm going to overstate it, but that all changed when Disney fired its CEO because he was generating excessive losses in their Disney Plus streaming business. We're now entering a period of streaming industry rationalization. I think that helps the incumbent, the leading incumbent. That's Netflix. They spend $17 billion a year on content hits, and you need 220 million paying subscribers to support a spend like that. Well, Netflix has that, and I think their subscriber base will continue to grow. So content is king, but I think Netflix has the P&L and the subscriber base to afford paying whatever king-like levels of content spend.
Mark, it's Kelly. Your two other top picks also jumped out at me. One of them is Uber, which has had a tough year. And the other one is Wix, which we don't talk a lot about, but it actually is also down about 50%. So Uber and Wix, if people are looking across this market today and wondering, if there's a couple of cheap stocks to pick up, why are they your top picks?
So I'll stick with those, Kelly, those three screens I use. You want to find names that have got some recession resilience. I don't cover a defensive sector. Tech is discretion. It's much more of a discretionary sector, especially on the consumer side, but even on the enterprise side, we're seeing a slowdown in cloud spend. So you want to find something that's somewhat recession resilient. I think mobility is that. I mean, you still need to commute. You'll still want the social rides to and from restaurants or homes or movies, whatever it is on the weekends. You still have your airport trips. I just don't think mobility, I think it's more of a utility than a consumer discretion item. And then Uber's also taken out costs. All of the travel and the mobility names, they had to take those 20 to 30%. It was that bad. RIFs way back in 2020, but because of COVID, that means going into next year, I think their cost bases are already matching what could be a softness in revenue. And then there's a couple of interesting product initiatives that I really have liked out of Uber, including what's called upfront pricing, which has been, I think, a huge boost for their drivers. And there's a counter-cyclical edge, to Uber. You're getting more drivers coming onto the network because they need that side hustle. And Uber is a great way for you to make an extra quick 35, 40 bucks an hour. So I like Uber. I think it's reasonably defensive. You just turned a corner on free cash flow. And if you're going to continue to generate positive free cash flow at Uber, more value investors will come in.
So, Mark, I want to push back on you a little bit. I actually had a question about Wix and Uber as being your plays, because I feel like the economic slowdown, possible recession is a double-edged sword. You mentioned for Uber, more people need a side hustle. And for Wix, maybe more people start up a website or something else because they're not feeling as satisfied in their job or perhaps lose their job. But at the same time, doesn't that reduce demand because less people are going to fly and less people are going to do things on the websites that Wix already has as customers?
Yeah, I mean, Frank, this is a cyclical sector. So I'm really trying to find who's less cyclical, who's got a business that's got, reasonably sticky demand, and demand will soften in a severe recession. It'll soften for all of these businesses, including search, including cloud computing, no question about it. But people will need a web presence during a recession, and you may even get a greater startup community with all the dislocations we're seeing in tech jobs. So I think the demand may actually hold up reasonably well versus something that's purely discretionary, like apparel, fashion apparel. Right. And then again, with mobility, the question is, will we still commute? To airports, will there still be some travel? Will there still be those social outings? And then what's the alternative? You're going to pay for an expensive taxi in New York. Prices have gone up there 25%. There's still the safety concerns you have with other modes of transportation. So I think the demand for mobility, at least for Uber, is going to be sticky, at least through a recession, more so than other areas.
All right, Evercore's Mark Mahaney. We appreciate the insight. Thanks for being here.
Thank you, Frank.
All right, let's get over to Steve Kovac now, making his debut on the CNBC News Update set. What's up, Steve?
Hey there, Frank. Yeah, here's what's happening at this hour. Georgia has become the latest state to ban the use of TikTok on government phones and computers. Governor Brian Kemp calls TikTok a national security threat, which could share user information with the Chinese government. More than a dozen states have recently announced similar bans. And chemical and pharma giant Bayer has agreed to pay nearly $700 million to end a PCB pollution lawsuit in Oregon. The case was originally brought against Monsanto, which Bayer now owns. The payment is the largest environment damage recovery in Oregon history. And tennis star Boris Becker has been released from jail in England. He served 8 months of a 2.5-year sentence. Becker was convicted of hiding millions of dollars in assets after declaring bankruptcy. The 6-time Grand Slam champion has already returned to Germany. Frank, back to you.
I'll take it, Steve. Thank you very much. Our Steve Kovac. Coming up on Power Lunch, we're digging into all angles of this market sell-off. Stocks are down big. Bond yields are also trending lower. It's a sea of red today, including in oil. Right now, it's around $75 a barrel. Up next, we'll talk to the man who may have made the call of the year, predicting in February when prices were soaring that oil was on its way all the way back down into the 60s. What is he saying about crude now? You'll want to stay tuned on Power Lunch right after this. Welcome back, everybody. It's been pretty relentless all day today. We have 90 minutes to go. Dow's still down 841 points, but let's get caught up across the markets with bonds and commodities as well, including looking back at perhaps what was the greatest call of 2022. Before all of that, though, let's start with stocks. Down 950 was the lows today. We've backed off of that a little bit by about 100 points. The S&P is still down 105, though, to 3889. And the NASDAQ, the worst performer, down 3.3%. E-commerce names getting hit particularly hard today. We talked about it a little bit earlier, but Wayfair, Overstock, Etsy, Shopify. Wayfair is down 10%. FinTech getting knocked around as well. PayPal, Toast, Affirm, Visa, MasterCard. Not a lot of places to hide here with the firm down 7%. Verizon is the only Dow component higher on an upgrade over at Morgan Stanley to overweight. They call it an attractive value, and it's up 1% today. Let's get to the bond market now, where yields are falling, but again, it's not doing a lot to help the stock market. Turns out a lot of recession fears everywhere. Rick Santelli.
Hi, Kelly. Hey, if yields weren't down, maybe the stock market would be down an extra 1 or 2%. We don't know the counterfactual. What we do know is that post-Fed, 2-year and 3-year note yields are higher. 5s and 7s are virtually unchanged. And 10s, 20s, and 30s, their yields are lower. I don't know that Jay Powell would have suspected that type of arrangement. Look at a week to date of 2-year note yields. You can see that, yes, they're higher on the session barely, but they're lower on the week. If you look at a week to date of 10-year yields, consider this. If they trade below 3.41% and they're close, that'll be a new low for the week, and actually it'd be a 3-month low yield close should they do that. And if you look at bond yields, a completely different picture. Here's a week to date of bonds. Up, up, up and away. They closed a whisker under 210 at a 1-month high yield, which means if you look at the relationship between the two, it's gotten closer together. As a matter of fact, there's only 136 basis points that separate our yields in 10s from yields in bonds, which means it's the closest together they've been in 26 months. And if you look at Fed fund futures, everybody's going to say, hey, they are lower on the session. And look at the June. June is the fulcrum today, and they're right. Lower means more Fed, but they're still higher on the week, which means that the pushback in treasuries by investors trading them is still probably bugging this Federal Reserve. Kelly, back to you.
I'm sure it is, Rick. Thank you very much, Rick Santelli. Oil closing for the day, dropping about 1% and now barely higher for the year on those global downturn fears. Let's get more on what was one of the biggest market surprises this year, in fact, as WTI crude is around $76 a barrel today. Yes, earlier there, back in February, before that big price spike, most in the market believed that the price of oil was headed relentlessly higher, perhaps to over $100, even to $150 a barrel. Not to the downside, which is exactly what we've seen play out. But this is not a surprise to at least one analyst. Here's what Citi's Ed Morse had to say when I asked him in early February why he thought prices would end the year lower. Listen. We've heard 120, 150. We've heard a lot. My next guest has the opposite view. He sees prices falling amid a coming oil surplus. With us is Citi's global head of commodities research, Ed Morse. Ed, how low could prices go?
It's always hard to either say what the bottom is, what the top is, but we're figuring about a mid $60 price range for Brent, low $60 price range for WTI by the end of the year, just based on the numbers that we look at. And yes, there are wild cards in them that could change that one way or another, but mostly probably to the downside.
Well, let's call him mostly probably right. Ed Morse joins us now. He's Citi's global head of commodities research. Ed, it's good to have you. It looks like a lot of the reasons you cited, excess inventories, that's the dynamic taking place in the market today. So what happened?
What happened was we had a price spike that was really a result of the initial reaction to Russia's invasion of Ukraine and Europe and others deciding to get off of Russian crude in a scramble to find alternatives. So there was a bidding up of Brent and other related crudes. And yeah, the market was tighter at that time than it's turned out to be. We're now in a very different situation. We were not expecting last March that the world was going to be facing a recession. So when we look at 2023 versus now, we're looking at demand growth that's going to be really on the very low side. We're looking at demand much lower than most other people. We're thinking demand is going to be about a growth of 1.3 million barrels a day, 1% basically. We're looking at China right now, which could have growth, but it's Demand at this moment is about 1 million barrels a day lower than a year ago. Europe is entering recession. Demand is lower than a year ago and with nowhere up to go. And the U.S. is seeing no year-on-year growth in demand whatsoever, with the recession lying ahead. So we have three big economies that are not seeing significantly robust growth, with the only hope for it being in China of the big three, as it may or may not come out of this slowdown.
So, Ed, would it be fair to say you're even more bearish now?
We are bearish, but there's a new factor in the market, and that's the U.S. acting as a floor price agent. We've heard that the White House is very public about saying there's a price at which we're going to start buying SPR oil. That price seems to be WTI hitting at $70 a barrel. You've got to take it as a message to believe, particularly as China also starts buying when the price is low. And we know that OPEC plus countries want to keep a floor under prices. So we have a lot of dynamics in the market now for buying excess crude, moving it back to the strategic stocks, which were released in abundance this past year in order to bring the price down. And it succeeded in doing that.
Hey, Ed, Frank Holland here. You just mentioned China a second ago. So when you made this call, it's hard to believe that you knew that the zero COVID policy in China would extend this long. I don't think anybody knew that. Are you also factoring in the fact that, again, I asked an earlier guest, that China is going to reopen? We're already seeing the signs. We're seeing a number of reports. And that Chinese people will not only get out their house, they're going to travel around their country and to other countries as well.
Absolutely. And in our low case for oil demand growth, half of that comes from China, believe it or not. It's a complicated story in China. The big growth of new oil demand is going to be clearly on the aviation side. We're seeing international flights already starting to grow at an incredibly rapid rate. But there's another hidden thing that we don't much think about, and that is what China did last year. In last September, when they started having blackouts, they stopped exporting petroleum product. They started slamming that down. They were exporting last summer, a year ago, in summer 21, around 1,200,000 barrels a day of petroleum product. They stopped doing that altogether last September, and now they're opening up again. So yes, we expect Chinese demand to actually grow, but we expect Chinese exports to grow as well. And we think they'll be back up to that 1.2 million a day level by the time we hit Q1.
So final question, Ed, for investors looking into 2023 and wondering if energy stocks are the place to be, would you caution them away from that? Or do you think that they can still perform well in the price environment that you anticipate?
Yeah, I'm sorry to disappoint you, but by regulation, I'm not allowed to talk about equities. We think that oil prices will be volatile and they'll be moving to the downside. We may have a strong Q1 because it's wintertime, but other than that, and the Russian issues that are uncertain, we think there's going to be inventory buildup again through the year. And the only thing that's going to stop the slide into the 60s is U.S. purchasing of SPR oil, along with healthy Chinese and Indian purchasing because the price is low.
Fascinating. I'm sure investors know what to do with that information, if you're right, once again. Ed, thanks so much for your time today. It's good to have you.
All right, coming up next here on Power Lunch, we're digging into the tech sell-off. The NASDAQ down more than 3%. Chip stocks getting hit even harder. We're going to have the details next on Power Lunch.
NYSE.
All right, welcome back to Power Lunch. Tech is leading the way lower today. Let's bring in Christina Partsenevelis with more on what's dragging tech lower. Christina?
Well, we have a number of economic reports that are out today, and that's raising recession concerns and pressuring stocks, especially those sensitive to further Fed rate hikes like technology. The NASDAQ is almost below the 50-day moving average, which is a key technical threshold. The NASDAQ 100 has already lost over $5.5 trillion just this year alone in market value. And today it continues to fall well over 30% down. 3% today, 30% year to date. Big cap tech having the biggest point impact with names like Apple, Microsoft, Amazon, and Nvidia, all over 3% lower today. There's only one NAS 100 name in the green, and that would be Align Technologies. It's up over 3% today. There's one report that I saw that Align is popping on positive comments regarding its Chinese business, so things may be doing well over there. And since we got those weaker than expected November retail sales, e-commerce names are getting hit pretty hard. Look at Wayfair, down almost 10% lower. You've got Overstock over 7% lower, Etsy over 3% lower. And then you've got chip names that are considered highly cyclical, and equipment names specifically like KLA, ASML, down over 4%. Not only because of demand weakness, but there's uncertainty about relations with China and what that means for exposure going forward. And a lot of investors have been concerned about this as of late.
And you're right, because normally we have the cyclical or we have just some more particular political issue. Now we have both. What is the latest on the China front here?
So it's a Cold War, a chip war, whatever you want to call it. You have the fact that the United States imposed these curb restrictions in early October. Now they've added 30 names to the entity list, which means that companies will have to get more licenses in order to do business with certain Chinese tech firms, specifically related to more advanced technology, so that China won't advance any of their artificial intelligence, their military applications. China retaliated by filing a complaint with the WTO, but honestly, that doesn't really do much. And then the second thing they did is, this is just Reuters reporting it, $143 billion in incentives for the Chinese semiconductor space that could be implemented in Q1 of next year, which would possibly change things. It would help China maybe come forward in the mature node section, which is not blocked right now. And then if that's the case, if they keep developing that, they could lower prices and then hurt competition here in the United States. So there's all these factors to consider.
Absolutely. And it comes at maybe the worst possible time for investors who are already nervous about it. Christina, thanks. Christina Partsenevelis. Big drop in retail sales triggering recession fears and leading to today's big sell-off on Wall Street. Up next, we're looking for opportunity and which stocks can you be best positioned for a recession? Maybe we'll get our traders' take on these names as we head to break. Take a look at some of the consumer names selling off on those macro fears. Etsy, eBay, Target, even Chipotle off 3.5% today. Stay with us.
little as 3 weeks.
All right, welcome back to Power Lunch. For the market selling off, we're focusing our three-stock lunch on recession-resistant names, according to Wall Street analysts. Bank of America calling Meta Platforms a best-positioned large-cap name if a recession happens. Wolf Research initiating Warby Parker at Outperform, saying the optical retail market is recession-proof. And Cowen naming Delta a top pick for 2023, saying that the airline should return to profitability even in an economic downturn. Here to trade them is Courtney Garcia, Senior Wealth Advisor at Payne Capital Management and a CNBC contributor. Courtney, great to have you here. Let's start off with Meta.
Thanks for having me. Yeah, Meta, I would not agree that this is a recession-proof stock. I mean, ultimately, about 98% of its revenue is generated from advertising revenue, and that's one of the first things to go if a recession does in fact happen. That being said, though, as a longer-term investor, what I do like about Meta is it's finally got to a reasonable valuation. It now trades at less than 16-time earnings after about a 65% drop this year. So I'd actually have this as a hold. I do think it has some near-term issues when it comes to advertising spending, but long-term, I do think this holds a place in your portfolio.
Yeah, we don't want to dwell on this too long. We got to keep it moving, but also a lot of small business exposure. Do you think that's one of the first areas we're going to see that ad spending slow down?
Very possibly. Yeah, and I do think that's the question is a recession going to happen? But if you are of the mindset that we're going to see that, yes, that's absolutely going to be one of the issues.
All right.
And if you think recession's going to happen, there's some who say Warby Parker is going to be recession-proof. You buy it?
Yeah, this one I actually have a hard time with. I have Warby Parker as a sell here. A couple of reasons, but we are in this higher interest rate environment, and this is where profitability is going to become really important, as well as valuation. Unfortunately, Warby Parker is unprofitable currently, and they're actually just slowing growth. They were trading about 30 times year-over-year revenue at their IPO. At their recent quarter reporting, they were only about 8% year over year. So they have slowing growth. They're unprofitable. I do think they also could be at risk of people trading down. I mean, trading down from a Warby Parker to a LensCraft. Actually, Delta, I have a buy. I'm very optimistic on Delta. Airlines in general, I don't think that the demand pull forward that you've had from COVID is ending anytime soon, especially with business and international travel, of which Delta has a lot of revenue sources there. I do think one of the big things that has been a drag on their earnings is the fact that fuel prices have been so high, which is really out of their control. But A, we're starting to see that come down, and B, they are over the next several years going to be upgrading their fleets to more fuel efficient aircrafts, which is only going to benefit them. So I do think that longer term, this still has a lot of trajectory to go, and it trades very cheaply at less than 8 times forward earnings.
Yeah, almost 7, which is astonishing. Courtney, you think it's okay to be invested in the market in this environment?
Absolutely. I am a long-term investor, and we definitely want to stay invested here, but I do think you want to be strategic about where you're invested. Some of your longer duration assets I do think are going to continue to be at risk here. So make sure that you're well diversified. Make sure that you are only adding those things that are likely going to continue to do well in a recession or in a higher interest rate environment.
All right. Courtney Garcia, thanks for your time today. We appreciate it.
Thanks for.
Up next, a bright spot in one of the most hard-hit sectors of the year. What is it? Can you guess? More Power Lunch right after this.
Paramount Plus.
Welcome back. Okay, there are some bright spots in the market despite this heavy sell-off today. Look, a lot of them are actually in real estate, one of the hardest hit sectors of the year. Lennar's up 3% today, same with D.R. Horton and Toll. Let's get out to Diana Olick with more. Diana?
Well, Kelly, you can thank fast falling mortgage rates for all of this. The builders are reacting to the deep dive in the yield on the 10-year Treasury, which mortgage rates loosely follow. Freddie Mac also released its weekly report showing a small drop in rates last week, but rates have since dropped even more. Take a look at Mortgage News Daily, which posted a 14 basis point drop just this morning to 6.13% on the 30-year fixed. Remember, the rate last peaked October 20th at 7.37%. So that's a pretty big move in a short period of time. Check out, of course, the home building ETF ITB. The builders were down in the pre-market due to Lennar's earnings release late yesterday. It showed a wider than expected drop in guidance on new orders, and it missed on earnings. But in the conference call late this morning, Executive Chairman Stuart Miller harped on the lack of supply in the market and said the shortfall leaves the industry in what we believe will be a short duration correction. He also said that Lennar is not fire selling its homes, despite reports that it was selling some backlog to investors. Kelly?
Yeah. And so what do we make, Diana, of this? Do we call it a counter trend move? Do we call it a green shoot for housing? The stocks have kind of been leading the market.
Yeah, I'd go with either one of those. And we heard the CEO of Toll Brothers just last week calling it a potential green shoot when he didn't want to say that it was a market turn the way he had said in August when mortgage rates first went down and then shot back up again. But he said he did expect that there were some green shoots there. But of course, remember, we're in December, which is traditionally just the worst time for home sales. Nobody buys or sells a home for Christmas. So we'll probably have to wait and see what happens in January. But this trajectory is clearly going lower. And if it stays lower or moves even below 6%, that could be really strong for housing as long as we continue to see prices weaken the way they have been for the last couple of months.
Yeah, bizarre to think, hey, if mortgage rates go below 6%, wow, would have seemed crazy a couple of years ago. Diana, thank you very much, Diana Olick. Frank, thank you as well.
Always great to be here with you, Kelly.
I hope the market can turn around a little bit. Thanks for watching Power Lunch, everybody.
Closing bell starts right now.
Fed hangover and downbeat data sending the market tumbling today, though we are off the worst levels of the day. The Dow is down almost 1,000 points at the lows. You can see we're down about 745 right now. This is the make or break hour for your money. Welcome, everyone, to Closing Bell. I'm Sarah Eisen. Take a look at where we stand overall in the market. Mention the Dow. There's only one Dow stock higher today, which just shows you the breadth of the selling. Verizon is the outlier. Everybody else is down. Goldman Sachs, United Healthcare, Microsoft taking the most off the Dow. S&P 500 down 2.3%. Every sector lower right now. Hardest hit in the pockets of technology. Communication services at the bottom of the pack. Names like Netflix selling off more than 8%. Technology, materials, industrials all at the bottom of the list. There's the sector heat map for you. And it just shows you the scale of the pain today. A big unwind that we are seeing with some of those tech groups down more than 3%. That's why the NASDAQ is in the eye of the storm. It's down about 3%. It's not too far off of session lows. Big declines for names like Apple, Microsoft, Amazon, Google, NVIDIA, Meta, Netflix, all taking the index lower. Tesla is actually an exception. It's higher today, but keep in mind, it's been lower over the last few weeks. We're going to be all over the sell-off for you this hour with some great guests to help you make sense of what is happening, including Cowen CEO Jeff Solomon with his thoughts on the Fed decision and the market impact. Plus, the one and only Jim Cramer will join us with his take on the sell-off and the big takeaways from his monthly investor club meeting. We'll begin, though, with the market and the economy. A slew of global central banks joining the Fed in raising interest rates today. We got the European Central Bank and the Bank of England. We also got new data showing retail sales in the U.S. coming in well below estimates. Our Steve Leisman has the latest for us. And Steve, it really does feel like for the markets right now, central banks are front and center. And the message was higher for longer.
Yeah, and nowhere to turn, Sarah, as well. Several major central banks, as you said, joining the 50 club today, hiking rates by 50 basis points following the Fed's move on Wednesday. As investors endure global rate hikes in a global battle against inflation, and there's nowhere to hide. European Central Bank, Bank of England, Swiss National Bank, all hiked by 50 basis points today. Norwegian's up by a quarter. And most importantly, ECB President Christine Lagarde signaling more aggressive rate hikes ahead than the market had expected. It's a toxic mixture for markets where rates are rising and the economy looks to be weakening. The data came in tough today. Retail sales down 0.6 compared to an estimate of down 0.3. Could have been some seasonal in that. It was a strong October as well. Philly Fed worse than expected. Empire State way worse than expected. But there it is again. Jobless claims stronger than expected. 211 versus 232,000 on the estimate. Jobless claims data remains a key point for the Fed. It's looking for more slack in the jobs market. Jobs market keeps showing strength while the market focuses on the retail and the manufacturing data, both of which are weak. The disagreement between the market and the Fed, it shows up in that 2023 outlook for the funds rate. Median Fed forecast rising to 5.15 from 4.6 in the September outlook. But Fed futures prices year end at 441, 440. That is cuts after a few more hikes. So the market, Sarah, sees the Fed en route to making another policy error by tightening too much.
I didn't think Powell was as hawkish as he could have been yesterday. Am I wrong? He was way more hawkish at Jackson Hole when he talked about pain. He was way more hawkish last time they raised interest rates, where he really seemed to make the point that financial conditions weren't tight enough and that they had a lot more work to do. I mean, he was kind of hawkish, but not down 1,000 points hawkish, was he?
I don't know how to put that into context like that. I think it's a good point, Sarah, that he was not dramatically more hawkish than he was previously. First of all, I want to make a couple points. I think what markets were listening for was some sense from Powell that he got a little more comfort with inflation given the last two reports. You read like Morgan Stanley today, Ellen Zentner says he did not pick up on those two inflation reports or change their forecast the way the market did when they saw those two better inflation reports. The other thing I think that really was hawkish for the markets was not just the new level of the funds rate projected for 2023, it was the unanimity. 17 of 19 Fed officials above 5%, 7 of them above 540. So they look at that and they say, you know what? Is anybody listening to us out here? At least we have a point of view in the market that is not going to go that high. And they didn't also see any comrades in arms out there.
I agree. But also I would think, Steve, it's also maybe surprising that they raised inflation forecasts, both for core and inflation rates for the year. So did the ECB. They don't see the inflation rate coming to target, I think, till 2025. And that seems like it's going to be a big question. How low can we get next year on inflation?
You're absolutely right. And I think the other thing about this is I'm not sure the market takes into account the situation that both Lagarde and Powell are in, which is you are a central bank president with inflation running, core inflation at 6%. You cannot sound dovish in any way, shape, or form. You have to hold the line and be, as hawkish as is reasonable in those circumstances because you are triple your target rate. You got down to 3, 4, 5. Then we could talk, but not at 6.
Right. I don't know. I think the market expected him to be hawkish, and I think he was kind of, but it wasn't extreme. Anyway, Steve, thank you very much. Appreciate it. For more on the market and the economy, let's bring in Bespoke's Paul Hickey and Neil Dutta from Macro Research, Renaissance Macro. Neil, I really wanted to talk to you today because you've been a bull on the economy, and I'm wondering if anything's changed lately as the data has come in weak.
Well, has the data come in weak? I mean, if you look at the Atlanta Fed, which sort of puts all of this together, Q4 GDP tracking, Sarah, is close to 3%. And that's important because the consensus, if you look at blue chip, is at 0.5%. So there's significant upside risk to the consensus. And oh, by the way, I think the consensus is offsides on GDP growth and the Fed, frankly, as well. In the first half of next year, because the consensus is looking for basically no growth. And, look at what's happened. You mentioned, I think it was mentioned about home builders earlier in the program.
Yeah, they're up today.
Yeah, well, I mean, some recession. I mean, with home builders working. So if interest rates.
Well, they've been beaten down pretty hard.
Well, up is up, Sarah. Up is up. You want to make a bet on whether residential investment is going to be as weak in the first half of next year as it is right now? I can pretty much assure you that it won't be. And at the same time, remember all that fiscal squeeze that people were talking about for this year? Well, what happened with that? What we know now is that the personal income numbers are coming in stronger than expected because folks have been underestimating the mana that was going to be dumped down from the state governments onto taxpayers. And that's juicing personal income at a time when gasoline prices are now at year-to-date lows. So the risks to the economy are when the Fed is hiking aggressively and energy prices are very high. That's not what's going on right now. Gas prices are falling and the Fed is signaling that it's going to step back. So that's where I am at. I think the Fed
It's definitely
consensus,
pretty bullish.
well, I don't know that it's bullish. I mean, I think it's bullish for the economy in the short run. Wait, it's out of consensus. I mean, okay, I'm out of consensus. That's not happened before. But look, what I would say is that it's good for the economy, but it also means that the fixed income market is mispriced. If real economic growth is picking up, it reinforces the Fed's higher for longer approach, and it'll prompt people, I think, to push out their recession expectations, thereby making cuts in the back half of next year less likely.
Paul, do you agree with Neil? Or is he crazy?
Well, no, I certainly don't think it's crazy. But, I think, when you look at what the market is saying here, Neil was talking about interest rates. Maybe the bond market's mispriced here. But the Fed, the unanimity that Steve was talking about with, Fed funds rate next year, they're intentionally inverting the yield curve. Now, the Fed itself has, talked about the importance of the yield curve in forecasting a recession. And when you have the Fed funds rate 100 basis points above the 10-year yield, going back to 1994, when the Fed has, telegraphed its rate decisions, when it's been this inverted, you've seen a recession imminent all three times. So I think in that respect, the market is saying to the Fed, hey, we're looking at different things here. And I think in that respect, you get this little bit of a shock here in the markets. It's one day. It's certainly a very big decline. But I think overall, taking a step back from a bigger picture, there's some things to like about the market here. First of all, what drove the market lower for the first half of this year was the fact that, as Neil mentioned, energy prices were higher. They've come in. The dollar was strong. That's come in. Rates are starting to come in as well. So those factors are less of a headwind now for the market. And when you look at internal measures of the market at the most recent low in October, they were much better than they were at the prior lows. And even right now, the market's behavior around this trend line that we've all been, watching so intently, it's been a disappointment as we haven't been able to get above that trend line. But the behavior of the market this time around has been a lot different. Whereas we pulled back immediately and sharply both of those prior periods. For the last 2 weeks, we've been hanging around these levels just below that level. And as technicians will tell you, the more often you test resistance or support, the weaker it gets. So in that respect, I think you can take some solace. Lastly, seasonality. December is a back-end look historically. The lows of the month are typically in the middle of the month, right around December 15th, going back to the early 80s. And so in that respect, the second half of the month is back-end loaded, and that sets us up for a potential surprise to the upside.
Well, today is the 15th.
Yes.
Also, to your point on technicals,
I'm very observant.
Well, since you mentioned it, since you're able to pinpoint it to that day, I thought it would be helpful for people. Since you mentioned technicals, just wanted to add some color. I talked to a big head of equity trading desk at a big hedge fund today, and he was saying that there's a technical level that a lot of folks were watching that was breached today, 39, 33 approximate on the S&P 500, that a lot of these CTA strategies, I don't know if you follow these, it's a trigger. And it makes them sell, and it picks up momentum on the downside, and people who follow these CTH strategies sell. So perhaps that led to such a big decline earlier today. Just one explanation. But bottom line, Neil, if the worry is no longer inflation and it starts to be growth for next year and earnings, you're pushing back on that idea because why? Because we're seeing a lot of rate hikes and a big adjustment. And it's happening globally. So what is the bottom line for investors?
Well, the bottom line is it's the surprise factor of the recession, right? I mean, one of the ways you get a recession is through an element of surprise. Companies think things will be okay, and then something bad happens, and that prompts them to adjust their CapEx plans, their hiring plans, their inventory levels, and so on and so forth. And that sort of creates that downward spiral of the recession. But what if we've been talking about this for 6 or 7 months and companies have already been doing that? Now what? And now household demand holds up a little bit better and companies are offsides on growth. that could well precipitate a period of catch up where companies have to
But
catch
their
up to the
financing costs are going up. That's going to impact earnings no matter what.
Well, a lot of them have also termed out. But at the end of the day, remember, if you get the call on the consumer right, everything else about the U.S. economy will fall into place. And right there, between still large pile of excess savings, lower gasoline prices, and steady labor markets, that's enough to maintain a reasonable pace for household demand. And look, I mean, I bet you every mortgage broker's on the horn with their with people that got stopped out at 7% interest rates, and they're calling them up and telling them to get back in. And so you'd expect to see housing demand pick up, which I think is part of what the builders are reflecting. So between these two things, I think there's, look, the consensus is for no growth in the first half of this year. So I think the risk.
But it's also still for a soft landing. It's not for a hard landing. So a lot of people think that the earnings expectations and growth numbers are too rosy.
Of a no landing. The odds are going up, Sarah, of a no landing right now. That's the risk.
So you're more bullish than soft landing. Final word, very quickly, Paul Hickey. It sounds like you share at least the optimism on the market.
Yeah, so I mean, the market's giving a better message, but the counter to Neil's point is that we've had such an aggressive policy tightening in the last few months here, and it takes time for that, even as the chairman admitted yesterday, it takes time for that to take effect. And 50 basis points seems like a step down and seems light compared to what the last 4 hikes were, but historically, even that was a large move. So we've seen an enormous amount of tightening come into the system in the last 6 months. And we're still going to feel that going forward in the next few months here.
By the way, I just also want to mention what's happening with bonds today. Very strong bonds right now. The 10-year yield, 3.42. The 2-year yield, 4.25. So we're seeing those yields come down as stocks sell off. The dollar is also strong today following that ECB and Bank of England meeting in particular. The pound is weak. The dollar's up 0.75%. Neil and Paul, we'll leave it there. It's a great discussion. Thank you both for joining me. Let's get a quick check overall on where we stand in the stock market. Again, low of the day was near down 1,000 on the Dow. We're down about 755 right now. It's a broad sell-off. Everything is getting dragged in. On the S&P, every sector is down. Communication services and technology, those groups particularly hard hit. They're down more than 3.5%. Names like Netflix selling off hard now, down 9%. We'll talk about that a little bit later, some bearishness around the Netflix ad-supported model, but also just a lot of these growth stocks are getting hit. Meta is down 5.5%. Technology, the chips getting slammed right now. Materials and industrials and financials. What's holding up best? Energy and real estate, but they're both down almost a full percent. Joining us now exclusively is Cowen CEO Jeff Solomon. Great to have you.
Good to be back.
Especially on a day like today. What would you tell folks?
Yeah, so everybody take a deep breath. Remain calm. The truth is...
Why?
Well, markets have days like this. I mean, it's, the market is reacting to the specifics of, what they heard from the Fed chair yesterday. I'm not surprised.
What did we hear from the Fed chair yesterday that made the markets
He's
upset?
just going to continue to do whatever he can to tamp down inflation. He's been incredibly...
Didn't we know he was doing that anyway?
Yeah, he's been incredibly forward on this. Like, it's straightforward on this. Very transparent.
But is he wrong? Should he be more worried about the economy? Is the market telling you that they're going to make a mistake?
So he's actually pointed to some very specific things in the 70s where the Fed sort of took its foot off the gas in terms of tamping down inflation, and it got worse down the road. So he's following the playbook. The Volcker playbook is to get out in front of it, make sure it goes away. He always has the ability to come back and cut rates later on if there's a problem with the economy. And so in times like this, I think you need to invest in places where you have a high degree of certainty of outcome, regardless of the volatility in markets. We just put out our 2023 themes. There's a couple of really great themes in there that for the longer term investor should absolutely hold, regardless of how long it takes the Fed to tamp down inflation.
All right, so let's talk about some of them.
Yeah. So
here's a list. Focus on fundamentals, consumer and corporates.
Yeah.
What are the fundamentals showing?
So I think the consumer continues to be resilient, but I think they're going to be selective. And one of the things that
retail sales were a bummer today.
Yeah. So it's not one size fits all. Just to be really clear, to use a retail term. So I think you have to look at the different buying patterns of consumers. So I was at a conference yesterday. You and I were both there, and we heard a
The
few
Yale
things.
CEO
Right, one of them is
Right.
You can't get a room in Mykonos for till 2026. You can't get airline tickets because how do you square that with the fact that the consumer may be saving in other areas or choosing lower cost items in certain areas? There are new buying patterns emerging post-COVID. This is something that I've been saying over and over again. The old data sets, the things that people would look at to see where the consumer is going to be and how they're going to behave, out the window. 2019 and previous doesn't matter. What happened during COVID doesn't matter. New patterns, new data sets are being formed on new consumer behaviors. Some of the things we saw during COVID will be stickier. Some of them will emerge as new trends. And as that happens, you'll get to see this dispersion around people's expectations until we actually have a higher degree of certainty. So I think you can be sure of a few things. One, deglobalization, absolutely happening. The decoupling of China and America, or the Chinese influence, the American influence, 100%.
What do you do about that? What's the investment?
So one of them is that there's definitely going to be capital spend on re-engineering supply chains and reshoring. We've been talking about this for years. No question, we're going to be building more chip capability, more fundamental commodity capability here in the United States, more ports in the United States.
But nobody wants to touch the chips if we're going into recession.
Yeah. Again, we might be going to a recession. It'll be short.
You're thinking longer.
Yeah, I mean, we have to spend so much money to replicate what we get from Taiwan, because the likelihood of Taiwan being an independent country in a decade is just, it's not high. Like there are certain things that are almost destined to happen. Listen, I hope it does. I hope that's not the case, but you can't be prepared. You can't expect that to be the case, especially with chips. So we will spend a lot of money in this country building chip infrastructure. We had a whole legislation around that. So I think those are the kinds of things that we're looking at. I think energy. So basically, when you look at what Moscow did, it threw everybody into a tizzy. But we had 8 months to prepare for how to get increased natural gas and oil supplies into Ukraine and into Eastern Europe, right? And so that has actually been happening. It's been great that we, as a country, the United States is a net energy exporter. We're doing things to stand in the face of the supply problems they might be having in Europe. That's great. No one earlier.
So you would tell investors to buy these energy companies even now after the tremendous rally they've had this year as a long-term.
Yeah, because we're going to need all kinds of energy sources. So historically, it's been like, okay, carbon-based energy versus new energy. That was an investment paradigm. Now it's just all energy. So I think you'll continue to see pushes towards alternative energy, pushes towards solar, pushes towards any kind of energy that allows for people to have energy independence, countries to have energy independence. So I think those are the kinds of things that even on a day like today, you can make that investment and have it work out over the long term, even on days like today.
I'm going to ask you about crypto.
Yes.
Because you took Cowen into crypto.
Yeah.
And a first for custody, right? Yep. How's that working out?
It's this tiny business for us, right? We were trading spot crypto. So just to be really clear, Cowen is not at all in any way, shape, or form entangled in the FTX mess. I think those of us on the inside, certainly those of us that are catering to institutional investors, recognize that companies like FTX are a problem. Like, you can't have a company that does execution and brokerage and custody all in one because there are too many conflicts.
But it also makes you wonder if crypto investing overall is a problem.
Well, I think it won't be back to what it once was until there's better regulation. And I can't give you a window into when that's going to happen or how long that will take, but there has to be more regulation. Eventually, this ends up in a highly regulated fashion, which is what we've been saying.
What is the level of institutional interest right now?
Well, it continues. They're continuing to look at ways to play in this space, but it'll take them longer to do that as things settle out. Let's not minimize the FTX changed, I think, people's perception and change. Institutions will be a little bit more reluctant and maybe reticent, but the ones that actually have the ability to see where this is going long term will continue to play.
Final question, because of your view into capital markets. I mean, you're big in IPOs. There have been no IPOs. Yeah. How does it look for next year? IPOs, M&A, the whole pipeline.
So I think for IPOs and financings, little window, anytime you see the VIX kind of get into the low 20s or high teens, there's a bunch of companies that need to be financed. And certainly we see it in life sciences and healthcare, tools and diagnostics, capital intensive businesses. And these companies will not miss the opportunity to catch those windows. And there will be windows. There just was one, and we're still in one, technically, even with today's activity, where there's been a lot of issuance over the last, 30, 35 days.
And we saw a few big mergers this week too.
And so,
that was this week?
Yeah.
Monday.
Yeah. So when you look at like Horizon Pharma, for example, listen, those things that need to be done strategically will still get done strategically. And what we're seeing in middle market M&A, which is really where we spend most of our time, still a lot of stuff to get done there. I think buyers and sellers are still trying to figure out where things are going to shake out. But we're going to learn a lot more here as we head into the beginning of 23. And once that happens, people need to get things done, and they will. They will. It won't be like it was in 20 and 21, but none of us thought it was going to be.
It'll
like
happen,
that.
just at lower prices.
Yeah, things are going to continue to happen. I really do. There's a lot of good fundamental reasons why there should be some consolidation in industries. I think certainly when you have difficulty in the capital markets, sellers companies that might otherwise finance themselves to continue their growth will look to be sellers. So there is that tension between should I go the M&A route or the capital raising route. Many of our clients look at dual paths. If the financing markets are not open, they're going to sell. So I think that's a
buyer.
Yeah, there is always a buyer. The question is really about price. And private equity still has gobs of dough to spend. And they're doing the smart thing here by waiting to see where things shake out. But they have a lot of money to spend. And that is a 3 to 5 year run that, still even in this environment.
It's really good to get color from you, especially on a day like today. Jeff Solomon, thank you so much.
All right, good to see you.
CEO of Cowen, good to see you too. So not all bad news on Wall Street today. We mentioned the home builders. They are actually rallying despite Lennar's weaker than expected earnings and a warning that new orders will slow and all this talk about higher rates for longer. Diana Olick joins us. What is driving this builder rally, Diana?
Well, Sarah, this one's easy. Mortgage rates. The average rate on the 30-year fix dropped 14 basis points this morning to 6.13%, according to Mortgage News Daily. Remember, the rate last peaked on October 20th at 7.37%. So it's down pretty sharply in a relatively short period of time. So no surprise, the home building ETF ITB is in the green. The builders were down in the pre-market due to Lennar's earnings release late yesterday. It did show a wider than expected drop in guidance on new orders. But in the conference call late this morning, Executive Chairman Stuart Miller harped on the lack of supply in the market and said the shortfall leaves the industry in what we believe will be a short duration correction. He also said that Lennar is not fire selling its homes, despite reports that it was selling some backlog to investors. Sarah.
Diana Olick. Diana, thank you very much. 4.3% in such a down market, higher for Lennar. Let's check out the Dow heat map because it just shows you the scope of this sell-off today. Boy, is it broad. Every Dow stock is lower right now, except for one. That's Verizon, the only outperformer. If you look at what is dragging the most on the Dow, United Healthcare, Goldman Sachs, Microsoft, the usual suspects here, IBM at the bottom of the list right now. We're off the lows of the day, but we're still looking at a decline of about 740 points. S&P down almost 2.5%. Mad Money's Jim Cramer joins us fresh off of his monthly investing club meeting where I love this, Jim, and I watched it. You recap lessons learned this year and the 2023 outlook. First of all, it's a great day to have you on. I think we have to just start with the sell-off that we are seeing, why and how people should interpret this.
Okay, I listened to Diana just a second ago, and it is amazing. You're supposed to be selling stocks that people are buying. But rates aren't going up. And the fact is that Stuart Miller, executive chairman of Lennar, said that there are not a lot of homes being built. They only have 800 homes in inventory. And I'm using that as an analog. What's happening is that things aren't going the way that the Fed wants. I mean, the Fed wants housing prices to crater, margins to go lower. Margins did go lower. The Fed wants you to be spending much less. The Fed wants you, if possible, to be fired, but they don't want to fire. Jay Powell said anything
but
heartless.
Less tight job market.
Yes, I like that. Well, you are much more of a diplomat. That's because you're from Cincinnati and I'm from Philadelphia. But I do think that the problem with the market is a lot having to do with yesterday, where some people just don't seem to understand. He is not trying to get expectations beaten. Like he doesn't want, wow, it's supposed to be 4 and it comes in at +3. He wants -1. He wants to get back to where we were. He wants to go and hear people at the supermarket say, it no longer costs double to get cream cheese. I can now afford flank steak again. He wants people to be able to say, you know what? Housing is within reach. These are common goals that we usually have, that a president might have. But what we've done is created a juggernaut economy fueled by a lot of growth packages that make it so it's very difficult even if people got laid off, to not find a job immediately. So, Sarah, I mean, in this environment, the only thing that really kind of creates less purchasing power is what's happening on your screen right now.
Which is what?
Stock market going lower.
Yeah.
I'm not saying he's rooting against the stock market, but I'm writing a piece for tonight. Basically says, do you really think this man cares? Do you think he cares that Microsoft is down 9? He's not thinking like that. He's thinking, good, maybe something will slow down the purchasing
Financial
power
conditions
of America.
matter. It's a big part of his strategy with monetary policy.
Right. I mean, look, the stock market, he does not share President Biden's belief that the stock market is really the repository of only rich people. He actually thinks that there are a lot of people who saved through it. And President Biden, in the times I've met him, had almost scorn for the stock market because of how little money he had, and just
we know about the
rich.
wealth effect. We know that there's an impact.
But we are in a jam here. And we're in a jam because everything just keeps costing more. And he just has had it. And he does not want to hear, hey, we had some really good numbers yesterday, so we're okay. He's waiting for the big picture.
The pain. Pain that he laid out.
Bring on the pain. Unemployment is, say, 4.5. Okay. That'd be part of the plan.
Yeah.
4.5 historically would be great. He doesn't want to go down as the Fed chief that made it so that that we had Weimar, that we had Zimbabwe, that we only hid masterwork paintings.
Volcker gets remembered for taming inflation.
Right. I mean, when you go to have you been to Palm Beach?
I have been to Palm Beach. I prefer Miami.
Now, most of our viewers are down there, of course. Now, there are yachts there. And the first thing you always say is, we are an incredibly rich nation. And then you think for a second, we have incredibly rich people in our nation. And I think incredibly rich people watch our programs and they're saying, oh my God, are Sarah and Kramer talking about that it's okay if the stock market goes down? No, I think what we're saying is it's collateral. It may even be necessary collateral.
It's a side effect from the medicine that we need.
Exactly.
Okay, I do want to talk about your big call.
That.
Yeah. Well,
that's good. I'll use it on the 6th. I don't know how many people watch your show and my show.
Hopefully a lot.
Yeah, probably. We want that. We want that.
Okay, so can we
talk about Burrow and Jamar Chase all the time?
Burrow making a comeback.
Yeah, good for you. All right.
What I love about your call, Jim, is you started off by talking about your mistakes.
Right. And I'm going to go over
Which not everybody does.
And let me just tell you, here's how TV works. I heard that you watched the call. So I went to my executive producer, who Regina Gogan, who's unbelievable. I said, I'm going to go ask Sarah. She watches the darn thing. I went on. And I went on because I tell things like forget about market cap. I loved NVIDIA so much that it didn't seem to matter to me that it went to $820 billion. It shouldn't have been that big. I want people to take into account, should something have the market cap that it does? NVIDIA was 29 times sales. There's a time to buy. I mean, not that like it's Ecclesiastes, but there's time to sell too. Mm-hmm. And even though I loved NVIDIA at 29 times sales, no go. Second, does a company communicate to shareholders? Now, I'm not saying that companies should have individual communications with individual shareholders. No, but I'm saying, do you return the calls of shareholders? Who
did not do that?
A company called Bausch Health. I mean, I got an email yesterday from saying, hey, listen,
been a really weak performer.
Wish I could help you. No, really weak performer? How about one of the worst performers I've ever seen?
Sound like
they should be like hosting barbecues. But no, I mean, like I called them. At one time I left a message. My staff was saying, who are you leaving that horrible message to? I said, Bausch Health. I told them, basically like you were wrecking everybody's, whatever. You can't do what they did. Then how about this one? You will love, I read them what I call a riot act. Now you will love this one. You got to stop having lunches and dinners with management. The CEOs are such unbelievable salespeople that you come back and say, I gotta buy that.
You just gotta take everything with a grain of salt.
I'll come back from a lunch and I'll say, or even a $12 latte from Blue Bottle Dinner. I'll come back and say, I just had the greatest meeting. And Jeff Marks, who works with me, says, Jim, stop taking those lunches, please, because they're so persuasive.
From them.
Oh, but they're so Sarah.
But they sell
Sarah,
themselves.
have they ever said to you, you know what, my stock's a little high?
No, maybe you want to take it with a grain of salt.
Hey, maybe you buy it a little bit low, maybe 8% lower. No, it's like, oh my God, I can't believe it. This company makes semiconductors that go into cell phones. Holy cow! Bye. I mean, yeah, that's what it's like.
It's actually an important lesson for people who watch too, because we talk to a lot of CEOs.
Right, they're salespeople. When I worked at Goldman Sachs, I remember when the CEO explained to me, I said, what are you doing? He goes, I'm in the sales business. I sell Goldman Sachs. So when I meet with the CEO of Goldman Sachs, he's selling Goldman Sachs. Although they actually are a little bit better because we know that they're cutting some compensation. Now, this is one that's really important. We have a thing called TAM in our business.
Yes.
The total adjustable
We heard
market.
a lot more about it during the run.
The Smile Direct, I know one of your favorites. They said they had a $500 billion TAM because like everybody's teeth looks bad. I mean, right? But they had it at 15, and then when the stock went to 53 cents, holy cow, the TAM stayed at 500 billion. Don't believe
TAM is
the
the whole
TAM.
future concept.
Yes. And then I'll give you one more. When the Fed says that things are too high, don't say what do they know. Say, they've gotten hawkish. This is November of last year. Maybe we should temper our enthusiasm. And these were mistakes that now some of them I did better on others. But these are just things that I need people to know. That's what it's a lot of common sense.
But you had a lot right too, which you point out.
Oh no, but the call itself is usually about things that I've screwed up on. Because look, I've seen money managers from your show; they've never made a mistake. One day I'll be like that. One day I will never make a mistake. I'll bat 1,000. I'll throw 34 for 34. Chase will catch everything. It'll be all 100-yard drives, and I'll get 500 in my.
But then what would you talk about on Twitter?
You think I would be involved with Twitter if I didn't? No, I'm just saying that I want people to know my mistakes so that I can talk about how last November I said from now on we're going to buy companies that make things and do stuff profitably and return money to shareholders while also not paying too much for the stock in terms of price to earnings.
That was the theme of the year.
That worked.
Does that work in 23 too? Is that
yeah,
the
it was
strategy?
fantastic. In November we switched to that last year.
But does that continue to be the strategy?
Yes, yes, it really is. Then I added that you have to buy them when they're cheap as the Fed got more vociferous. We didn't fall for fads. Like, there's guys who ring the bell, the SPACs, okay? I mean, like, why don't you just here, please take all my money and give me nothing. That's what a SPAC does. I don't know if you read the fine print. It says, we have every right to lose you every penny, and we'll return some of it. Terrific. We never took the bait on what Wall Street was selling. 4, we love boring.
Boring.
In the end, boring. I mean, if it was, the more boring it was, the better.
Hormel.
What?
Hormel.
Hormel's very, look, no, that figgy pudding spam juice. Let me tell you something. That was a hit all over my Ferragamo tie when I got home.
Gross.
And then finally, don't panic. I mean, like, look today. People right now are trying to think about, wow, Meta down 6. I got to get the hell out of that. No, I mean, like, maybe it's an opportunity. Have conviction. Have conviction. I really ran through this. I'm sorry I went so fast.
But it was instructive. So given that, on a day like today, are you in buying?
Yeah.
Would you be?
We bought Emerson today. I've been waiting for Emerson to come down. They're reinventing the company. This guy, Lal Karsenbach, is doing such a great job reinventing the company, making it so it's getting out of housing and sold incinerator. Hey, we all should be composting. And it bought, I didn't mean to point. That's very rude.
No, it's fine. I use an incinerator.
You do?
Yeah.
All right. Well, maybe you ought to rethink your game plan. And
it's very convenient. Everything goes
But what
down
he's
there.
doing is he's making this company into the company that you call if you want to be carbon neutral in 2030. They know how to do it. You bring them in and they have fixed so many things. Emerson has always been one step ahead of everybody else. And I've been waiting for the stock to come down. I've met with the CEO a couple times. He is a no-nonsense guy. Unlike the other times when I come back and say, oh my God, the guy makes chips. I'm chips. I'm like, wow, this is so, and he's doing auto. I actually was, waiting. And then we get a day like today. So today can't be the day I say, oh my God, I'm afraid to buy Emerson. I have to say, you know what? Let's get started buying some Emerson. There's a lot of good things. It's not expensive. It's a dividend aristocrat, which I still think matters. It's a changing stripes company that I think, only Honeywell has been very good at trading. It's not,
You'd like
most
to
people
stay for a
cannot
while.
change. It's really hard to change stripes. Lal's changing stripes. Honeywell changed stripes. Those
Much
are
more
winners.
software.
It's very,
that kind of
yeah.
company.
So what else are you working on?
I mean, I think we're just trying to figure out the outlook for next. My biggest question, honestly, is the outlook for next year as the focus shifts from inflation this year
Right.
to growth next year. What are the earnings expectations telling us? Are we not pricing in a hard enough landing? A soft landing appears to be priced in. I hate to sound negative, but
No, you're
is
not.
there downside because the market is actually looking at the economy as not falling into a deep recession?
I'm running a piece right now about how there's two economies. There's the economies, people who are from the East Coast, Midwest, and they know how to fire better than anyone. They fire. It's like the day that they got their job, they said, let me teach you how to fire. And then there's people out West, and they're like, what do we do? Do we like call them in? What do we say? Like, I'm sorry? Do we like give them a raise? Because they don't know how to fire. And they're part of the problem, not part of the solution. We have to have stock-based compensation. People realize, look, things got too inflated. I'm sorry. You're going to have to fire. Like, it is amazing that they fired. It was incredible.
And it was a turning point, I think, for investors.
I think so, because it shows you that if you fire, if you get your expenses in line with your revenues, you're going to have a win. Not today. I mean, today's a day. Yeah, people got too excited yesterday. Remember, we were up 500 earlier this week, and everyone kind of feels like, well, wait a second. Things got out of control. I will tell you, though, that after today, people are going to forget. It's like the market doesn't have a lot of memory. Like by tomorrow, we'll be thinking, maybe get out for the weekend. But by Monday, we'll forget what the Fed said, and people come in and look for things to buy. So you want to be ahead of those people.
Well, Jim, always valuable.
That's it.
They're wrapping me.
That's it.
That was
no, I'm supposed to be the co-host for the second half.
For more,
Everyone told me I was the co-host.
We got to go to the market zone. You know the market zone? Final 20 minutes.
My feelings are not hurt.
No, it was a great summary. The lessons are good. Thank you for coming on and sharing them here.
Well,
on Cloak
I
and Valve.
appreciate that.
And for all of you out there, be sure to sign up for Jim's Investment Club for more great analysis and strategy. It's a 1 hour presentation, and I highly encourage you.
I tried to make it funny. I mean, I talked about my partner's dog dying and stuff.
Yeah. You talked about NVIDIA, your dog, I remember.
Just talked the good part. I mentioned Lisa a lot, that she's my CEO a lot. It's my wife. I try to make it interesting.
You do that. You do that very well.
Well, I appreciate that. That's why I was so thrilled that you told me I could be on your show.
I'm so thrilled that you're here on the show. Also, don't miss Jim's great lineup tonight. Mad Money, 6 p.m. Eastern time on CNBC. There's the QR code. Doug Peterson. Oh, that'll be good.
Yeah, he doubles as the coach of the Jags. Not having a great year.
Yeah.
No, that's the name of it. He's S&P. I'm sorry.
Sorry. Are you throwing out sports references that I don't understand?
No, I know, but I couldn't.
I got the Burrow.
You knew Burrow was really dynamite.
Yeah, it's my
that was really Chase. You probably know Chase, not the bank, the player.
Yes. Jim, thank you. We'll see you later.
Thank you.
Jim Cramer. We touched on chips a bit just now with Jim. I want to point out they're getting wrecked today. The VanEck ETF down more than 3%. Names like NVIDIA, Intel, Qualcomm, they're all down sharply as well. Let's bring in CJ Muse from Evercore ISI, who published a note this morning with his top semis picks for 2023. So is this a group you want to be in 2023 if the concerns are about growth and it's been so cyclical?
Yeah, Sarah, thank you for having me on. I think absolutely. If you look fundamentally, we're looking for a bottom in the March-April timeframe. And if that's the case, then the time to buy semis is between now and February. So, we're not sitting here saying that there isn't a number cut ahead in January. There absolutely is one coming. But typically on the second or third cut, you want to buy semis. And that's our view here. We think the stocks bottomed October 14th. We've run 30+% since then. As you pointed out, we're down roughly 4% today. We don't think we get back to the October lows. And we think, the time to be short was, in 2022 for semis. But now's the time to start doing your work and start to accumulate into that inflection, which we think will come in the March-April timeframe.
I do wonder how much sentiment and positioning factors in here, because you say in the call that you think it's a very under-owned group.
It is. I would say, looking at our investor polls over the last 4 quarters, we've gone from 70% overweight to 70% underweight in our latest poll. I would say, very interestingly, in polling investors who they thought within TMT would be the best performer in 2023, and semis came in first. So I do think that you're right. Positioning is very important for semiconductor stocks. And in fact, you've been paid really to do the opposite of positioning thus far this year. And I do think that, investors are underweight. But I think that will change. And I think the window for that to change is obviously, I believe in the next 4 months. We'll see if I'm right. Obviously, today, highlighting an inflection has not proven to be right. But I think over the next 4 months, we will be proven right. But, time will tell.
I want to get into the names with you. We're showing on the side of the screen some of your top picks. NVIDIA, ASML is on there, Wolfspeed. Why did you pick the names that you did?
So I think that there's a group of names that offer both offense and defense. So ADI, ASML, Broadcom, those are names that'll do well in a down tape, but also in a recovery, cyclical recovery, they'll do well as well. Now, part of our call here is that we want to move more offensive. And on that front, we point to Marvell, NVIDIA, Wolfspeed, and those are really names that offer compelling growth. And that's why we're positioning there.
CJ, we appreciate you joining me. Thank you.
Thank you.
Very much. With a big call today from Evercore ISI, chips going higher in the next 4 months. Let's stick with tech because the mega caps are getting hit pretty hard, harder than the rest of the market in this sell-off. Steve Kovac here with a look at some of the biggest movers as the NASDAQ, Steve, drops 3 1/3%.
Yeah, that's right. So shares of all these mega cap tech names falling with the rest of the market, Sarah, and the losses have been extending into the afternoon. Let's start with Apple. Those shares are down more than 4%. Look, this week we got the report from Bloomberg that Apple is working to allow third-party app stores on the iPhone in compliance with a new law in the EU that'll go into effect in 2024. Now, if more countries impose similar regulations, Apple's lucrative app store business could be at risk. Let's move over to Microsoft now. Shares off 3.5%. The FTC sued Microsoft a week ago today in that attempt to block its $69 billion acquisition of the video game publisher Activision. Now, that deal could take longer to close than Microsoft's initial target of June of 2023. Also over at Amazon. Amazon is down as well, off nearly 4%. But it's the two names relying on the digital ad market that are getting hit really bad so far today. We got Meta and Alphabet both down around 5%. Meta really taking it on the chin, though. Look, it's the worst of the group here, Sarah. And look, it's also perhaps a sign investors are more worried about the ad-supported social media companies. I want to point out one more bonus here. Roblox down about 15% as it put out some weaker than expected user numbers for the month of November, Sarah.
Got it, Steve Kovac. Thank you for running through some of those big losers today. We're going straight for you, commercial-free, into the closing bell market zone. The Dow is down 800 points right now. Ariel's Charlie Bobrinskoy here to break down these crucial moments of the trading day with us. Plus, we've got Wedbush's Dan Ives on his new note on Tesla and Kate Rooney on the fintech movers. We'll kick it off broadly, Charlie Bobrinskoy, with this deep sell-off reaction to the Fed, to the ECB, got some weak data on retail sales. What do you make of the selling today? What does it tell you?
Unfortunately, this time it's pretty simple. One of the old adages in the market is don't fight the Fed. And Chairman Powell has made it clear that despite all the data that's come in the other direction, he was proven wrong before in underestimating inflation. And he's going to make everybody sure that he doesn't miss that again. And so now he is, in my opinion, ignoring the data showing that inflation is getting better. And he's made it clear that they're going to be higher for longer. And the Fed has real power to bring on a recession if they want to. I think he's fundamentally wrong about wages in the labor market being the cause of inflation. Wages are up less than inflation, but he's stuck on this idea. And if he wants to cause a recession, he can.
So we've heard a number of times today on the program. We started off with someone who said that the consensus is too bearish on the economy. We had Kramer, we had Jeff Solomon from Cowen saying good opportunity for long-term high conviction buys. Are you buying today?
Yeah, but I want to be careful. I'm absolutely long-term bullish. There's some wonderful values. We calculate our portfolio versus our calculation of intrinsic value every day, and it's at a big discount. But in the short run, there is no doubt that a recession is not going to be good for the stock market. And some of the information coming out from retailers, some of the consumer data has not been great. And so I agree, long term, we absolutely like the market a lot here. Short term, it's going to be bumpy.
What does that mean in terms of what you're buying?
Unfortunately, what I'd love to say is in something like this market, you should buy more defensive names, but those defensive names are more expensive. Right now, what's on sale are things that are going to have a tougher time in a tough economy. So the great names, we have some, for example, Borg Warner, I always talk to you about, which is the auto supplier, extremely cheap. But if there's a recession, people are going to buy fewer new cars. The expensive stocks in my portfolio, Lockheed Martin and J&J, are both very stable, not cyclical, but they're not very cheap. So I think this is a tricky time where you are going to have to invest for the long run. We think that's what all good investors do, but know that, again, I'm not making any promises, nor should anybody else, about in the short term.
A lot of caveats there, Charlie. Stay with us. Let's talk Tesla. Hitting a 52-week low, I should say, today, and then edged a little bit higher. It's actually now in the green, bucking the overall downtrend, but it has been a big underperformer in the last few weeks. Elon Musk revealing in an SEC filing he recently sold another 22 million shares of Tesla, valued at about $3.5 billion. Let's bring in Wedbush research analyst Dan Ives. Your note getting a lot of attention today, Dan, because you think this is a really big issue for Tesla. Does it change your view of the stock?
Look, we're still bullish long term on the Tesla story, but Sarah, I mean, Musk is essentially using Tesla as his own ATM machine, to fund Twitter and the losses, and it's really been a boy that cried wolf. I mean, continuing to say that he's done selling, yet you continue to see Form 4s. And this has really been a black eye for Musk in terms of the overall Twitter situation. And it's cast a massive shadow on Tesla. And I think the clock struck midnight. Investors are frustration building.
So why are you maintaining outperform?
Because on the fundamental thesis, my view of where Tesla goes in terms of one of the most transformational names in electric vehicles. I think fundamentally the stock's oversold in terms of where this thing could go in terms of 2023. But in the near term, it's a Musk-driven sell-off. We think that's 75, 80% of the sell-off here. And now it's about course correcting. But I think it's a moment of truth for Musk and the board to ultimately get through this, because this has just been a train wreck situation that continues to get worse.
What is the fix for it? He owns Twitter now. He's focused on Twitter.
Well, I think that's a big part of the problem, because right now the attention's focused on Twitter, not Tesla, but also in terms of selling stock. I mean, it's 40 billion over the last year. Come out with some sort of 10b5 plan, communicate what those sales are going to be like, need to be more transparent. And that's why this has just been agita for investors in a risk-off market. And I think Musk has really gone, in the eyes of many investors, from a superhero to almost a villain on Wall Street. And that's really something that he needs to turn around pretty quickly here.
I guess what I'm wondering is that overstated? In other words, is there a real fundamental risk besides, selling Tesla, which that's a real risk, and not paying attention as much when it's actually think it's going to affect the sale of Tesla vehicles?